cool off. So what triggered this rise? It was about 7 basis points rise in the US 10-year. And even the, the other sort of notes, the 2-year, etc., they were all moving higher. So what triggered it? There was a 5-year note auction and the demand was lower than anticipated and lower than the average for an auction typically of that size. And that kind of got people worried. In any case, we've had some hawkish commentary from the federal officials this week. We have the PCE inflation data that comes out tomorrow, and all eyes on that because that is the Fed's preferred inflation gauge. And not just this, the dollar also moved higher. So you've got the US 10-year surging to 4.6%. By the way, we started the year with hopes of those 3 rate cuts at 3.8%. And now the 10-year is at 4.6%. So the rise and the repricing of, rate cut expectations, that's been a telling story so far in the first half of the year. The US dollar is back above 105. It's about a 1-month high on the dollar, about a 1-month high on the yield. And that seems to be complicating the picture overseas. Now, add to this, of course, issues over here, like, you guys have also been pointing out. Saturday evening is when we get the exit polls. So you have today and tomorrow to decide what positions you want to take ahead of that. And then, of course, Monday is a reaction to exit polls and Tuesday is the real deal. So, plenty of volatility. And I was just looking at the FII positioning. So massive selling in the cash market. Thankfully, as usual, DIIs are offsetting it. They bought almost all of that sell down. But the interesting aspect also was while FIs have sold off quite a bit in cash yesterday, they're really building up positions in index options. The net buying in index options was almost 7,300 crores. And Nigel will tell us more about what's happening in in the options arena. But as I say, I mean, strap up for for a fair amount of volatility. But maybe because we've fallen for 2 days on trot. Maybe the brave hearts come and buy the dips. I don't know who those brave hearts are, but good luck to them.
Well, that's right. We've got a hands full actually today because today the global headwinds, as you all have been mentioning, well, they're against us. The dollar's a little bit stronger. The yields have moved up as well, and Brent crude prices as well hasn't really corrected any big time overnight. Now we've got the monthly expiry today, so brace yourself for volatility. All the futures contracts for the month will expire in today's session, but the Nifty Bank rollovers, well, they are relatively lower in trade today. And just, if someone is positioning for a comeback and the continuity of the current ruling government, which the entire market is, then in fact, maybe we could see a pre-exit poll rally. So maybe that happens today, maybe that happens tomorrow as well. So I'll be interested to see what happens from the low point of the day. The Nifty Bank, as I said, the rollovers are relatively low on D-1. That's getting into expiry day. Well, it's at 68%. On an average, we've seen that rollovers for the Nifty Bank is closer on 78%. So the positioning is relatively lighter on the Nifty Bank itself. What did the FIs do yesterday? Well, they lighted positions, both on the long as well as on the short side. But the key reason for seeing yesterday's fall, I think, was the amount of long unwinding that we saw in trade yesterday. And that's why now you have the long-short ratio, which is even-Stevens, at around 50% apiece. The PCR as well has come down to the lower end of the range. A few sessions ago, it was at around 1.3. That's come down to around 0.79 odd. Remember, normally bottoms out at around that 0.65 odd mark. So we've got some distance to go. But it appears the bears are getting very confident because we saw aggressive writing yesterday. 22,800 call, 22,700 call. Well, out there you saw a big amount of open interest build up yesterday. 22,900 call as well did see a fair bit of build up. So between these two, there was close to around a crore shares that were added there. However, on the downside, you have the 22,750 put that's giving the bulls a glimmer of hope out there that maybe lower levels can get defended. So let's get to the levels. The Nifty Bank, the reference point you have on the downside is around that 20 DMA approximately. And then, in fact, you're looking at this 50 DMA. So that 47,900 to around 48,300 becomes an important mark. But on the Nifty, going by the options data, which, we just pulled up, that's telling you that this should be the important support zone. You don't want this number to get violated in today's trading session. That's crucial on the downside. While, otherwise, you're looking at around that 50 DMA or thereabouts. Moving to the stocks that we're looking at in today's trading session, well, Tata Steel, that stock should open up in the green because those numbers look rather good. The European losses were lower. Can they move into the green? That's one key monitorable out there. So we'll keep an eye on Tata Steel. And the other one is Cummins. Yesterday as well, we highlighted this stock that maybe it was seeing a good amount of delivery-based buying. Ended in the green while the markets were under pressure yesterday. But those margins look very, very good. So both these two numbers look good. But both those two con calls are during market hours. So commentary will be tracked on both these two names.
Okay, thanks a lot for that. So we'll watch out for these stocks very closely, right? Let's quickly get you some market opinion as well, because the GIFT Nifty is suggesting another weak start. about 100 points lower. But on the equities front, we have Lawrence Belanco of CLSA, who says that the snapback in the US 10-year yield back above its 50 DMA has created a headwind for global equities, leaving the majority of regional and global equities they track weekly remaining range-bound. He says a break above the 4.7% mark in the US 10-year yield would add further downside pressure across these markets. Speaking specifically about the election outcome in India, Lawrence says looking at price action of the Nifty running into next week's election results, he sees that it has managed to break out of its narrow March to May trading range that formed between 21,700 and 21,735 and 22,768 and 22,800. He adds that from a pure pattern perspective, this breakout supports an upside target of 23,745 to 23,750. And he says that they recommend taking some profits into the 23,745 target area in anticipation of a broader consolidation/correction taking shape in a similar fashion to the 2019 action. Okay, that was really a mouthful. But the moot point is that there's some volatility that you can expect.
Perhaps, right. That is the CLSA view as we're running into the event now. Let's move to some money market action as well and some news coming in here. On the rupee, Parul Mittal Sinha of Standard Chartered Bank says the USD INR has moved higher this week on dollar demand from importers and custody-related outflows. However, inflows related to MSCI rebalancing due on Friday should support the USD INR pair this week. The market will, of course, closely watch the election outcome on the 4th of June for any further cues. For larger moves in either direction, it is likely to be contained, though intervention by local banks. She expects the USD INR pair to trade in a range of 83 to 83.65 for the time being.
Okay, and on the bonds, Parul says Indian government bond yields drifted lower last week on larger than expected RBI dividend, which raised expectations of a narrower fiscal deficit and revision of India's rating outlooks to positive by S&P. Higher global rates and profit booking, however, partially offset some of these gains. The market will very closely watch the national election results on the 4th of June for future directions. She expects the benchmark 10-year bond yield to trade in a range of 6.95 to 7.05% in the very near term.
Well, we've got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. For the time being, we're running through the list. You have Tata Steel, Hero MotoCorp, Cummins, GMR Airports, Lemon Tree Hotels. All of them will be reacting to positive news flow. We also have RR Kabel. While on the flip side, you have 4 stocks that will be reacting to negative news flow. Bata, Alchem, IRB and KFIN.
Okay, all right. So all of those stocks in the focus today, and we will get to them in just a bit. But first, let's talk about all the big cues that we've been getting in over the last couple of hours. Jahangir Aziz, Global Head of EM Economics at JP Morgan, is with us. Jahangir, great to have you with us on the show. I don't even know where to start. The rise in US yields, S&P, upgrading its outlook on India or the elections. So let me throw it all in. I mean, we're running into a lot of major data points and events. But let's start with the US, actually, where the 10-year yesterday moved to 4.6, and then we're getting inflation numbers tomorrow. How do you view this rise? And do you think this is just the market repricing a newer reality of rate cut expectations? Is it done, or could there be more to go?
So look, I mean, I think the move yesterday was, or this morning, was largely a reflection of the issuance, of the heavy issuance that took place. And I think it is much less to do with any repricing that the market has done over the last 24 hours. I think the market clearly has moved away from expecting too many rate cuts. I think the market is now probably has one and a little bit more for 2024, mostly in the second half of the year. We continue to believe that the economy is probably going to show enough signs for the Fed to tick the boxes it needs to start cutting somewhere in the second half of the year. We have a July rate cut, the rate cuts starting in July, and we still have 3 rate cuts for 2024. But clearly the risk is on the other side, right? That you could, if the core PCE numbers do not pan out or do not show a continued softening, and if we do not get, and if we get another upside surprise in non-farm payroll, then clearly, the July rate cut gets pushed down, and we're probably, closer to 2 rate cuts rather than 3 rate cuts. But for now, we do expect the activity to slow down, not slow down any precipitously, but slow down sufficiently for the Fed to feel comfortable that they could start cutting rates.
Okay, Jahangir, hi, good morning. Well, that's about the US Fed, right? Back home, we have our own issues to deal with. There's the MPC meeting on the 7th of June. There is, of course, the election results as well. Post the election, there's a big union budget perhaps coming up in July. So what is the expectation this time if the RBI does maintain interest rates in this policy because of, a stable inflation scenario? When do you expect the next move on rates to come, and what should investors look forward to?
So we have pushed back, rate cuts in India. Part of the pushing back of the rate cuts is probably to do with that we've also pushed back the Fed, right? So the view has been that not just India, but India, Indonesia, the Asian central banks did not raise rates as much as, let's say, the Latin American or the European emerging market central banks had raised rates. So their margin that they have to cut rates is actually pretty slim. And given the fact that the dollar strength hasn't really ebbed, in fact, the dollar has continued to be on the strong side. You've seen a steepening of the U.S. rate yield curve, as we spoke about it earlier. I think the concern is that you do not really want to start cutting rates before the Fed does on concerns about financial instability. So our sense is that if we have a July rate cut, then probably August, September is the time, or August is the time when the RBI could start cutting rates. But look, the rate cutting cycle in the case of RBI, as in the case of other Asian central banks, is going to be very shallow, unless, of course, the Fed surprises out with a significant easing in 2024. But if the Fed is going to give you 50, 75 basis points of rate cuts, then the amount of rate cuts in India or in other Asian central banks is going to be, probably about 25 to 50 basis points.
Hi, Jahangir. Good morning and good to see you. How are you reading the Chinese data that's coming out of there? We had the IMF yesterday going ahead and upping their growth guidance for China. Do you think China's coming back or do you think you're not really convinced?
We are not really convinced. We are not really convinced for the fact that if you go back 2017, 18, 19, 20, 21, 22, 23, all these years, right? You typically had in the previous year, in the fourth quarter, the Chinese providing a significant amount of stimulus, and that stimulus would carry through in the first half of the year. First half of the year, the growth numbers would be reasonably strong. Q3 would be the time when the growth would slow down, and the Chinese authorities would come back in Q4 with another round of stimulus. That happened in 2023. And the amount of stimulus that was provided in fourth quarter of 2023 was reasonably high. And as a result of that, we got a very strong growth surprise in the first quarter of this year. The problem this year has been is that 2Q already looks pretty soft. And 2Q softness is, mostly on the demand side, which has been the Achilles heel of China. And I think unlike previous years when the slowdown would take place in the third quarter of the year after the stimulus impact would go away, surprisingly, this year, the stimulus impact is already fading in 2Q itself. And if you look at Chinese growth, the bright spots just happen to be exports, which has very little to do with China itself, but has to do with much stronger European growth and continued strength in the US economy and industrial production. And so we are not very convinced that we are going to get Chinese growth above 5% or near 5% without another round of stimulus coming through reasonably soon.
Okay. Jahangir, let's come back to India then. What did you make of the S&P upgrade to, not the rating, but the outlook? The fact that it's coming before the electoral results. They cited a couple of reasons. They said that they're very happy with the continued commitment to fiscal consolidation, the quality of government spending. So what do you think about this? And then, we are running into the mother of all major events. And how do you see India? We have GDP numbers coming out on Friday. That's just tomorrow. How do you see the entire juggernaut, the Indian juggernaut, rolling out?
So I think the fourth quarter, the last quarter of the fiscal year, is going to be a strong year, a strong quarter. It's going to be a strong quarter. Apart from anything else, there's been a significant amount of election-related spending that has happened. The question is what happens once that election-related spending fourth quarter boost that we get fades, and what happens in fiscal year 25. And we have a view that the economy clearly is going to slow down from what we had in the previous year, probably somewhere around 6.5%, 7%. That's where the range of growth, the ranges on the growth front in fiscal year 2025. But I think much will depend on two factors. One is, does the government, keep to the fiscal consolidation with a very tight spending, or does the fact that the RBI has provided them with, a reasonable amount of space to keep spending up and still make it to the consolidation target, does that become in reality in the July full year budget? I think that is critical in trying to figure out how growth is going to pan out. And clearly, the other factor happens to be what happens to the global economy, particularly what happens to rate cuts in the Fed. Without rate cuts, I think real interest rates will remain high. Real interest rates in India, given the fact that inflation, at least core inflation, has been coming down or has remained very, very, very benign. Real interest rate in core terms has been much stronger than what you would expect for an economy, going into fiscal year 2025. And I think these two factors will sort of decide whether we are going to break 6.5, 7, or we are going to go below that. So I think it's the fiscal will the government manage to keep to the fiscal budget target without having to cut down spending, given, as I said, given this, the space has been provided to them by the generosity of RBI. I think that becomes the key, and we'll have to wait and see what the July budget holds.
Okay, Jahangir, thanks a lot for that. So that's really a lot to look forward to, and major events coming up for the market. But let's do one thing. Let's take a quick commercial break on that note. On the other side of the break, our list of top 10 stocks is lined up, so do stay tuned in.
Investigation. So this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station. But parallelly, when you speak of the blood samples, crime branch is looking at that case. Details in this very case emerge, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. So that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom the father of the accused had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out who that middleman actually is.
Welcome back. So global cues are a little challenging, but we have plenty of stocks to talk about. Lots of result reactions coming through, and our team is standing by with the list of CNBC-TV18 top stocks to watch for the day. Nigel, kick it off. Tata Steel looking good?
Well, Tata Steel's numbers actually were good. So you look at the absolute revenue terms, well, that was a little better than what we were working with. We already have the volume. So in all probability, the realization decline was not as much as expected. And even the consolidated EBITDA number was much better by close to around 8 to 9% in comparison to what most on the street were working with. But for Tata Steel, as I always mentioned, the segmental breakup is most important geographically. So the India business, well, the EBITDA per ton was mildly better than what we were working with regard to the poll that we threw up. And the European business, that's where the pleasant surprise came in there. The losses that came in from there were half of what we were working with. Focus on India first. On a year-on-year as well as on a sequential basis, yes, it was lower, but actually it was a little better, in absolute terms at more than 15,000 rupees in comparison to the poll. And guess what? In quarter one, things will be even better because steel prices have moved up and costs have moved down. Moving to the European business, the UK as well as the Netherlands business, the losses came down on both of them, and that's encouraging. What played out? There was lower change in inventories at Tata Steel, Netherlands, post the completion of the alignment of the blast furnace 6, so that was good, and the decline in bulk gases as well as emissions with related to UK. So both those two factors resulted in UK as well as Netherlands. The losses did come out there, and the debt number was maintained despite having a capex of close to 4,500 crores. These numbers look good. We'll wait by for the management commentary, but the stock will open up well in the green.
Okay, the stock will open up well in the green. We'll wait by for more commentary from the management. In fact, today at 1:35 p.m. is when you'll hear out from TV Narendran, the MD and CEO of Tata Steel. So you'd perhaps want to stay in and listen into that one. That's when you can hear it. And of course, through the course of the day on CNBC TV18. Well, the other stock that we're looking at this morning is Hero MotoCorp, and we're going with green over there. Finally, after months of speculation, the news is out that Hero FinCorp will be filing for an IPO. Now, the IPO will be a mix of a fresh issue and an offer for sale. The fresh issue will be about 4,000 odd crores. Ahead of the IPO, Hero FinCorp has been doing a lot to clean up its books. It wrote off bad loans worth almost 1,200 crores. The growth for the company has also been good. So it is a lender which has a presence in over 4,000 cities and towns across India and nearly 2,000 retail financing touch points as well. If you look at the growth, right, 9 months FY24, the asset under management saw a growth of 25%, sitting at a little under 50,000 crores. Now, Hero MotoCorp owns about 41.2% stake in Hero FinCorp. So we're going with green on Hero MotoCorp today. But one of the stocks of the day undoubtedly will be Cummins. Very, very strong set of numbers coming through. Vamakshi's here to give us the lowdown. Vamakshi, morning.
Well, good morning, Sonia. Well, yes, it's a big beat across the board. The revenue, margins as well as EBITDA have come in much higher than what the street was expecting. In fact, revenue has come in nearly 6% higher. It's seeing a growth of almost 20%. And this growth could largely be attributed towards demand for CBCP2 products before the new norms come into picture from 1st of July. But apart from that, the standout this time around is the margins. EBITDA margins have come in at a record high. 23.5% is where they stand at. It's up nearly to 657 basis points on a YOY basis, and this improvement is largely being driven by an improvement in the gross margins, which are up nearly 328 basis points, as well as lower other operating expenses. The EBITDA has come in nearly 41% higher, and the net profit has come in nearly 58% higher as compared to what we were expecting. The management says that the CBCP4 range of products have been well received by customers. Keep in mind that Kirloskar Oil also had similar commentary. The exports might see impact in the near term due to global economic uncertainties, but they're striving for a recovery in exports. But it is important to understand whether these numbers are sustainable or not, and we will be waiting by for the con call at 10 a.m.
Okay, thanks a lot for that, Vamakshi. That's the big one of the day, Cummins. But let's move to Vivek. He's here to tell us about GMR Airports. Hi, Vivek. Morning.
Well, good morning. So GMR Airports will be the stock in focus. Company declared a healthy set of numbers as far as Q4 is concerned. Operationally, quite a sound quarter. However, on the bottom line, the losses continued. However, it's narrowed quite significantly on a year-on-year basis. Revenues higher by 30%. EBITDA very, very strong. 3.2 times higher, coming in at over 815 crore. Margins, 33.4%, almost versus just 13.5% on a year-on-year basis. So very strong over there. Finance costs, however, in shy, 823 crore is what the finance cost was, versus just around 672 crore on a same time last year. A loss narrowed significantly, 167 crore loss on the bottom line this time around. Now, talking about the key highlights, passenger traffic growth was almost 11% higher. One important update, the street was waiting by as far as the tariff hike was concerned for the Delhi airport. Currently, the current tariffs will continue for another 6 months, and a representation will be made. And as far as the merger of GMR Airports with GMR Airports Infra is concerned, likely to conclude by Q1 FY25 is what the management has said.
Okay, all right. Got it, Vivek. Just 11% increase in passenger traffic. When you see the queues at the airport, you believe those numbers should have been even higher. But got it. Good quarter for them. Thanks very much. Manglam's here to tell us about Bata and Lemon Tree. How are those numbers, Manglam?
Well, in light of what happened with Campus yesterday, you would say Bata is tepid. But, Street wasn't expecting much anyway. So 2.5% revenue growth is what the company has reported this time around, just under 800 crores on the top line. Gross margins did see an improvement, but the company plowed that back into marketing, etc. as a result of which EBITDA was absolutely flat, around that 22.8% in terms of margins, and the net profit declined by about 3%. The company did say there are sluggish demand conditions, and they've added 24 franchise stores during the quarter, increasing their expansion through the franchise route, and they're hopeful of some recovery. So let's see, for starters, see some red on the stock, maybe there could be some recovery. For Lemon Tree, it's a good performance that has come in, 29.5% revenue growth. The EBITDA has grown 22.5%. Now, typically, you would say that for a hotel company, EBITDA has to grow higher than, the revenue. But that's largely because the company has started a new hotel in Mumbai, Aurika, and at the same time, they are renovating some of their hotels as well. So some of those operating leverage benefits are spent into renovation, and Aurika is yet to stabilize. And in light of that, the net profit growth of 42% and occupancy of around 72% despite a higher room base is a positive. So see green on Lemon Tree, mild red on Bata.
Okay, thanks a lot for that. Well, Sudarshan is with us to talk about Alchem and why you should be watching that one. Sudarshan, good morning.
Morning, Sonia. So Alchem Labs had reported earnings during market hours and headline numbers were below estimates. But important to note is the con call takeaways. Con call happened post-market and takeaways are looking muted. FY25 revenue growth is seen at the current level of 10%, and companies looking to maintain gross margin and EBITDA margin within the current range. And it's optimistic about biosimilar business, but refrains from giving guidance. Brokerages too are negative on the stock. Jefferies has an underperform rating and target is cut to 4,200 from 4,470. HSBC has a hold rating and target is cut to 4,880. And JP Morgan has a neutral call and target is cut to 5,445 per share. That's the reason I'm going with red for Alchem Labs.
Got that. Thanks a lot for that, Sudarshan. Well, moving back to Vivek. Vivek, you're here to tell us about IRB Infra. Tell us more.
Well, IRB Infra, expect some pressure on the stock today. The promoter entity is selling almost 4% of the total equity. We had access to the term sheet, which was launched last evening. So IRB Holding Private Limited and Deepali Virendra Maheshkar together are selling close to 4% equity. The offer price range is in the band of 63 to 72.7 rupees a share, which is almost up to a 13.3% discount to yesterday's closing price. So at the lower end of the price band, the offer size is a little over 1,500 crore, a significant and steep discount. And remember, there's a lockup of close to 180 days after the sale of this particular block that the promoter entity will be selling, and they will continue to hold a little over 30%. We are talking about IRB Holding. So expect some red on the back of this large block today.
Okay, block season is back, and how, Vivek? Thank you for that. Abhishek is here to tell us more. Abhishek, you're tracking some more potential block trades today?
K-Fintech over there, sources tell us that there is a block which has been launched. Base issue size is about 500 crores, which can be upsized to about 833 crore based on the demand. So equity on offer in terms of base issue is about 4.1%, which can be scaled up to 6.8% depending on the demand. The seller is General Atlantic Singapore Fund. They hold about 38% stake over there. Price is around 712.5 per share, which is at a discount of more than 4% to yesterday's closing price on NSE. The lock-in is about 60 days post this transaction for the residual stake sale if they intend to. General Atlantic will hold about 31.2% stake post this transaction. IIFL Securities is the sole book running real manager to this issue. Now, sources do tell us that TPG Asia that will sell stake in RR Cable as well. Floor price is about 1,700 per share. The discount is very low at just 1.1% to yesterday's closing price. Offer size is nearly about 958 crore. Equity on offer is 5%. It is a clean out trade from TPG in RR Cable. IIFL Securities is the banker to the deal. Back to you.
Okay, thanks a lot for that. Plenty of stocks to watch. So here's a quick recap. Stocks with positive news flow: Tata Steel, Hero Moto, Cummins, GMR Airports, Lemon Tree Hotels, and RR Kabul, while stocks with negative news flow: Bata, Alchem, IRB Infra and K-Fintech. Let's take a quick break. On the other side of the break, Dipan Mehta, director at Elixir Equities, will join in to discuss some fundamental analysis. And we will also be joined by Vidya Shankar Krishnan, who is the chairman and managing director at Forgings, to discuss their Q4 numbers and the way forward.
కూడా.
Welcome back. Hope you're having a good morning. Well, as we've been telling you, the global Q is a little bit muddled. Explains why the GIFT Nifty suggesting that we pull back a little bit at start itself. But plenty of stocks are going to be in focus. Deepan Mehta, Director at Alexa Equity, joins us to help us out with a quick analysis. Hi, Deepan. Good morning. Tata Steel's numbers. Europe is showing signs that maybe a turnaround could be around the corner. Maybe by Q2, we could have a positive number just going by the trends. And the India business EBITDA per ton as well will improve. Last quarter's numbers are good. What's your view on the stock from here on?
Well, good morning and thank you for having me on your show. I think the numbers are better than what Street is expecting, and the key factor, of course, is how Europe performs. And I think they have made a lot of effort in trying to turn around the European operations, and gradually the uncertainty around that is reducing. So therefore, going forward, we will have the full benefit of, and the full growth rates will come from the domestic business where they are expanding capacity. And as I heard you on the show earlier, saying that prices have gone up and costs have gone down, so we can expect very good numbers for the next 2-3 quarters or so. From that point of view, I think there could be a good trading rally in Tata Steel. But as I said, I'm not very optimistic on commodity stocks in the longer run. But I think these are traders' delights, and there's so much of information keeps on coming as regards raw material costs and finished products and volume. From that point of view, it's easier to make an estimate of what the profitability could be. But it's a cyclical business, and one should be careful what valuation you pay for such a business.
Okay, by the way, I was just looking at Edelweiss's response on a separate note. I mean, the RBI order that came in yesterday, and it's a cease and desist order on two of the Edelweiss entities, including ECL Finance. So looking at the responses coming in, for one, Edelweiss simply seems to be saying, this particular response is from Edelweiss Asset Reconstruction Company, that they will comply and they'll try and uphold the highest governance standards. That's on the asset reconstruction bit, where they can't take any more assets on board. For ECL Finance, where there were a lot of very serious issues raised by the RBI, Edelweiss is saying that this is with respect to the company's wholesale exposure. Last year itself, the company passed a resolution to discontinue this business going forward. So just some updates coming in. Deepan, hi, good morning. So RBI is as active as ever. I mean, actually, Edelweiss as a stock has kind of fallen off the radar as well. Any thoughts here or on any of the other NBFCs that still are yet to remediate some of these issues, whether it's a JM Financial or it's some of the gold loan companies?
Good morning and thank you. No, I think that it's when such action takes place, it's best to just wait and watch and see how it actually plays out. Edelweiss Finance per se is an extremely attractively valued stock. Recent performance also has been exceptionally good. And asset reconstruction is a good business, very high operating profit margins, good prospects, but volatility is always there in those earnings. And that business was scaling up pretty well. But as I said, I think whenever you hear of RBI action, it's best to just stay away from such stocks for the time being. Let the air clear out, let the company get back into resolution mode. Then one could look at it. At this point of time, I think it's better to go to the safer stocks. So amongst the NBFCs, what comes to mind is companies like Bajaj Finance and Cholamandalam, I think, which have proved the mettle, and they have survived a lot of vagaries and volatility in the NBFC space. And now valuations are pretty reasonable. These stocks have really gone nowhere for the past several months or quarters, and numbers have come through. So we are seeing that the price to book and price to earning multiple also has certainly compressed. So I would go with the all-time performers, the bluest of blue chip NBFCs, considering that our entire outlook to the market is to be a bit cautious and go towards defensive.
Okay. Well, stay on. We'll come back to you in a bit, right? We have our first management joining in. Forgings is the first company on the radar. Now, the company for many quarters has been reporting a sluggish set of numbers. Q4 was also quite weak. In fact, they've barely seen a single-digit growth. And by the end of FY24, they haven't even managed to meet their lowered guidance for the full year. The guidance was 1,600 crore rupees, and they have barely managed to just, ended below that. Vidya Shankar Krishnan, the chairman and managing director at Forgings, is joining in to talk more about that. Mr. Krishnan, thanks a lot for joining in. I want to first start by asking you, how is the situation on the ground? Are you seeing any improvement at all? And you have lowered your guidance to 1,600 crores, but you could barely meet that as well in FY24. So what is the outlook for FY25? What kind of growth are you looking at? When do you expect to see a recovery?
Good morning, and thanks for having me on your show.
Sure.
We have almost touched our lower guidance number. The reason for slightly falling short was probably a very weak CV market in Q4 of FY24. The CV market almost went silent during that period. So as a result of that, we saw weaker numbers. Otherwise, I think we could have easily crossed the guidance that we had given.
So you ended with about 1,550 crores in FY24, which is a growth of about 9%. Are we looking at double-digit growth in FY25? Is that a reasonable assumption? And have you seen any pickup at all in the CV market in Q1?
Yeah, we have seen a significant pickup in the CV market, though not as high, but compared to Q1 standards, Q1 for the CV market has been reasonably strong. The reason is bus orders have been coming in to CV makers quite strongly. So that's been driving up the market. Yes, this year we do see us knocking on the doors of 1,800 crores, which should be a growth in the region of around 15%.
Okay, all right. Hi, sir. Good morning and good to see you. But you're sure about this 1,800 crores, right? Because the street gets a little bit skeptical. They say things are volatile, so the management should be a little bit more cautious when guiding. 1,800 crores is doable, you're sure?
Nigel, everything depends upon broader economic fundamentals. So any performance is subject to market conditions, and that cannot be overridden by any management.
I agree. I agree, sir. But evaluations have been in your favor. You have the capacity as well. So scaling up of these revenues are going to be important. Be that as it may, give us a couple of numbers. What volumes are you factoring in for this year? I think last year you were getting for around 85,000 tons. So what did you end up with? And what are you factoring in terms of a volume uptake? And more importantly, margins. You've been telling us that machining is something that you're focusing on. That's what's going to help your margins. Is there further scope to increase margins from around this 20% that you've already delivered?
Yeah, few questions. So let me go about it one by one. First is we see margins upwards of 20%. I had said earlier that we would be looking at that by Q3 of this financial year. We are on target. If you see from last year to now, we've gone knocking on the doors of 20% almost. We're at 19.4%. And I would expect margins to improve in the next 3 quarters. That's number one. On the back of products that we've been developing, we do see growth coming in from the domestic market as well as global customers, where we have bagged a couple of new customers, particularly in the EV space. So all that augurs well for the organization.
Okay, but you didn't give us the numbers on volumes.
Yeah, sorry. Last year we had said that we would achieve about 85,000 tons. We produced 84,800 odd tons. So almost, touching the mark. This year we expect to cross 95,000 tons.
Okay,
Sales to be about 77,000 tons, and that would be going up by about 10 to 15% this year.
Okay. Actually, your body language, your guidance has picked up a lot compared to when we chatted last time. So it's good to see that there is a recovery in the market and it may translate to your numbers. So you said margins upward of 20% and you expect the margins to improve in the next 3 quarters. How much can it improve to in the near to medium term? I ask you because, I've asked you this question before as well. Some of your peers, like say a Happy Forgings, trades with margins of 28, 29%. So is there scope to get above the 25% mark now that things have recovered?
25 is a bit of a stretch. We have to walk the talk. We said that we would go beyond the 20% mark in this year. And that would be where I would so far stick to. And thereafter, we have to go about it step by step. Yes, we are very much in the job.
All right. Also, earlier you had guided for 2,000 crores revenues from the EV business by 2030. Are you on track to do that? And in the very near term, to FY25-26, what kind of scope do you see in EVs?
Yeah, our subsidiary Abhinava Rizal has yet to take off the mark in terms of sales. We are still at a development stage. Of course, We're handling several customers very closely, and we expect to bag a few customers in the next few weeks and start our sales journey. Once we start, I think we have a lot of potential. As I've said earlier, we're one of the rare companies in India who can design motors from 3 kilowatt to 300 kilowatt, and there are not many who can make that claim.
Okay. All right, sir. We'll leave it on that note for this conversation. Thank you very much for joining in, and good luck. And, hopefully this time around, you will be meeting all of those expectations that you've laid out. Thanks very much. Well, let's move on now, and time to say hi to Anuj, talk about how perhaps, traders are going to be navigating this. Anuj, morning. So, you've got all the jitters before the event here, the local event, and now throw in higher yields and weak global markets in the mix. What do you make of things?
Morning, Surabhi. Well, you know what, there was a bit of a relief here yesterday in terms of rains in Delhi. I hope there's some relief for the market as well. But as you said, the combination is quite a heady cocktail of weak global cues, exit poll nerves, and throw in the monthly expiry on the Nifty. And of course, the Wall Street's been showing some nervousness because of the rates going up in the US, 4.62 on the 10-year, and of course the Fed speak as well. I think it's better to focus on individual stocks. That's where you're getting, good trades, especially with the ones where the numbers have been very strong. One more thing which happened yesterday was that FIs went net short again yesterday. Only by a snitch, but they have become net short again. Yesterday, 65,000 longs were covered and 13,000 shorts were covered. Net now, we are at 49.5% long. We were at 54% long when we started trade yesterday. So that, in some sense, is good news. India VIX as well was down a bit, and put call ratio is now at 0.79. So if the market has to bounce, perhaps today intraday or midday could be a good place to bounce. Also because, very close to crucial levels, 22,600 to 22,633 is the put base. But after that, will be very close to the 20-day exponential moving average. 22,500 to 22,580 is that zone on the Nifty, which is very crucial support, especially 22,580 being the 20-day exponential moving average. On the upside, the resistance comes in at 22,825 to 22,850, and then 22,900 to 22,926, which is the call base. Bank Nifty yesterday fell excessively due to expiry. Now that's out of the way, and it's very close to, in fact, yesterday's low was exactly the 20-day exponential moving average. So in that sense, there's quite a bit of support here, and my sense is that should hold out. And then the bigger support is 47,970, the 50-day exponential moving average. Let's see if those levels hold out or not. Today's quote of the day is actually something which is very close to the heart. The most difficult decision is the decision to act. The rest is mere tenacity. That comes in from Amelia Earhart to start your day.
Okay, push yourself to action. Stop being inactive. Got it. Thank you, Anuj, so much for that. You have a good day too. Back to Deepan for a couple of other thoughts as well. Deepan, I want to talk to you about shoe stocks because it's really, two very different steps, different pace, call it what you want. Look at Campus and what's happening over there. The market's obviously latching on to perhaps, maybe the worst being behind the company and the improvement we're seeing. And look at the wealth destruction on Bata. It's a telling story from levels of about 2,000, about a year and a half back or so. And again, we've got really lackluster numbers. What about the two?
Yeah, I think that clearly, makes a study for management consultants and management students of what went wrong in Bata and what is Campus Activewear. And you can add one more company to that list, Metro Brands. So Metro Brands and Campus Activewear clearly have captured the imagination of the investors and the consumers. And they have gone from strength to strength in terms of expanding their retail network and in terms of design, and especially focusing on the segments in the footwear which are done exceptionally well. And Bata, which had a good run for several years until maybe about 2-3 years ago, seems to have lost its way around. I think brand also is getting a bit old and is not resonating with the consumers, is what my assessment is. But Bata remains extremely overvalued according to us. And the better way to play this particular niche retail investment theme would be through either Campus Activewear or Metro Brands. But our preference would be for Metro Brands because it has a more diversified, I would say, product base. Campus Activewear is focusing just on sports shoes and athletic shoes. So there's that narrow segmentation over there. But these are great long-term stories, and if you buy them at reasonable valuations, they could turn out to be great multi-baggers as well.
Okay, well, I'm going to give you some time to think about the next stock. It is Samvardhana Motherson. Very good set of numbers, Dipan, but I'm going to ask you your view on the other side of the break. We'll come back. Kush Bora and Sudarshan Sukhani will also be joining in for some technical trades, so do stay tuned in.
ಮೊದಲನೇದಾಗಿ ನನ್ನ ತಂದೆ ತಾಯಿಗೆ ತಾತನಿಗೆ ಹಾಗೂ ನನ್ನ ಕುಮಾರನಿಗೆ ಮತ್ತು ನಾಡಿನ ಜನತೆಗೆ
That is coming back, is going to cooperate with the law enforcement agency. That's a way forward. Everybody should respect the law of the land, and by complying with the law of the land, the truth will come out. Who created the video, who distributed the video, all these truths should come out. But we can't expect from this SIT. Instead of this, SIT should be monitored by a court. Court monitored SIT.
Welcome back. Well, as we've been telling you, it's going to be a bit of a challenging start to begin with, given those global cues and the fact that most Asian markets are also lower. The GIFT Nifty is telling us that, we could be down by about 80, 90 points at the start. So how do you negotiate this? Kush Bora is joining in along with Sudarshan Sukhani. Gentlemen, good morning. Good to have you on. Sudarshan, so what would the advice be? It's anyway, very nervous times. And then we have weak global cues today.
Good morning. See, the weak global cues have to be set aside because we are having a major internal event in India. So that's what will control the markets. As yesterday I explained, and today it's the same theory, the same theme, that markets get nervous before any big event. This is a sign of nervousness. Traders should take advantage of this dip and be long in the market. There's something else. You cannot change your position till you get to Monday, because there is no sense in saying, okay, the Nifty has gone up 50 points, gone down 50 points. What should I do now? You are taking a trade for Monday, not for today, not for 1 hour, not for half hour. So if you are prepared for that, stay long.
Okay, if you're prepared for that, stay long. Kush Bora is also with us. Kush, a couple of days ago, we were discussing how it's a no-brainer to stay long in this market. But then things changed dramatically, right, in the last 2 days. But I think that's how the market works. What do you do now?
Hi, Sonia. First of all, very good morning. Well, this market has been full of surprises, hasn't it? I think it's not just the wicks, at 20 plus levels. It's perhaps, as Sudarshan said, the nervousness as well. I think what will happen is at around 22,600 on the Nifty and 48,000 on the Bank Nifty, the recent rally that had begun, a few sessions ago will get wiped out entirely. Even the FNO data is suggesting that an even-Steven, a long-short ratio on the FII side. So I think what you should do in this market is perhaps look for long opportunities, but not on the index just yet. If you have long positions, perhaps you could maintain those. Any fresh long positions on the index should be taken above 22,800 on the Nifty and 48,800 on the Bank Nifty. Interestingly, the Bank Nifty has a put base at the 49,000 strike as well. So perhaps some indication. Also, just a quick insight. This rally actually, the lead indicator for this rally has been the mid-cap index. Even before the indices shot up to 23,000, the mid-cap section was doing well. And before this crack, the mid-cap index gave way. So what we are seeing there is some sort of, a reduction of pace of the fall. So perhaps that is what will be the order of the day. The indices could, as you said, open lower, but we may not see a big downside from there on as we saw yesterday. So perhaps some long opportunities will crop up.
Okay, what about individual stocks then, Kush? If long opportunities are going to crop up, what are we looking at in terms of individual names?
Looking for those long opportunities on the stocks. India Bull Real Estate, has been doing well. Yesterday's close was also very encouraging. So from a near-term perspective, 138, 142 are the targets to look at. 139 is where you can place your stop loss. The railway theme is doing well. One stock in particular, Jupiter Wagons, JWL, that stock too has been seeing an up move even in the market that's seeing some sort of correction. So 596 and other near-term targets. 555 is where you should place your stop loss.
Okay, all right, got that, Kush. Sudarshan, what about you? You have some individual stocks for us as well?
Well, no, not this time, because the markets are a little confusing to most retailers. The trade is to be long in the index and look for shorting opportunities only intraday. So that's what I have. IRTC is an intraday short with a stop above 1106. Indigo is an intraday short with a stop above 4335. And Info Edge, which is Naukri, that's an intraday short with a stop above 6371. The idea is to look for weak stocks intraday and stay long in the Nifty. AU Small Finance Bank is my only buying opportunity. That's a positional trade. Go long with a stop under 608.
Okay. All right, Sudarshan, got it. Thank you very much. We'll come back to you and let's see how this day progresses. Chandan Taparia is now joining in, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, good morning. Tell us, trades for the day. Tough and interesting day perhaps lined up ahead.
Good morning, Surbi, Sonia, Nigel. Thanks for having me. So I'll say that fasten your seatbelt as India VIX is at 24 and expecting more volatile and wild swing in the market. However, the good part is we witnessed some recovery all the way from 21,800 to new lifetime high of 23,110. But witnessed some profit booking decline in last 3 trading sessions as market has exactly taken hurdle at the upper band of the rising channel. So major bias is intact to positive, but because of the 24 weeks, the movement of 300, 400 points on either side cannot be ruled out. So be ready for more volatile swings as we are heading towards a key event. But as of now, as per the data and the price internal, major bias remain intact to positive with buy on decline stance. As of now, the major support for index is at 22,222. And we believe that any volatile swings of 300, 400 points could provide the opportunity with support of 222 for again upside move towards 23,110 in higher zone. Looking at the entire volatile swings, we also advise to go with hedging activities by buying the protective put and being with bear put spread to hedge the long portfolio. Talking about the Bank Nifty index, here the IV has seen the spurt to 34, and because of that 1,000-1,500 points movement will be new normal for the next couple of days. But as of now, the major support for banking index is in between 48,000 and upside hurdle will be at 49,500. So we have to play the wider range between 48,000 to 49,500. I know it's going to be very tough to go with only buying and selling, looking at the market wicks, but it's advisable to be with option strategy to navigate and deal with the market volatility. Looking at the stock wise, first is buy on Motherson Samvardhana. We have positive view on Nifty auto segment, and most of the auto stocks are looking strong. We have more positive view on the auto ends. So here we are recommending to buy on Motherson Samvardhana. It has given a consolidation breakout of last 7 years, few points away from its lifetime high, making higher tops, higher bottom on the weekly and the daily chart. So expecting further run up towards 157, one can buy with support of 142. Second trading idea, there is buy on Hindalco. We have seen resilience at the time of market decline. It is holding well and supports are shifting higher. We are witnessing positive rollover with higher roll cost, which also indicates the positive move. So one can buy for an upside move towards 735 with support of 690 level. Last trading idea, that is sell on Bajaj Finserv. A weak structure, every small bounce is being sold. Weakness persists. Negative price pattern indicates a breakdown can be seen. One can sell with a stop loss of 1605 and stock can drip down towards 1500 zone.
Okay, thanks a lot for that. Let's take a quick break on that note. On the other side of the break, we'll have the pre-opening rates. Also, Rishi Anand, the Managing Director and Chief Executive Officer at Aadhar Housing Finance, will be joining in to discuss the company's performance for the quarter gone by. Stay tuned.
Is the only way forward for us to get justice.
Welcome back. We're just heading into the pre-opening race. It's going to be interesting next couple of days actually as we head into the exit poll results on Saturday night. So it's going to be a hectic one. Sunday, everyone's going to be reacting to that. But Dipan Mehta is still with us. Dipan, while all this chaos plays out, there are still companies which are reporting very strong numbers. And one of them, as I said earlier, is Samvardhana Motherson, right? I mean, good set of numbers, a lot of brokerage upgrades as well on the stock. But how are you feeling about that name now?
Yeah, Sonia, I think exceptionally good set of numbers. And what is the best part of the company is that it is totally de-risked, irrespective of whether EVs take off or internal combustion engines do well. So because the products are such that they go in both type of vehicles. And clearly, I think all the acquisition which they've done over the years, that is paying off very well for the company. But look at 36, 37 times, a lot of the upsides have got captured. And one thing one needs to keep in mind that it operates largely in the mature markets. And their automobile sales kind of, don't grow at the double-digit growth rates which we see over here. So there could be a bit of a challenge in terms of growth rates going forward. Also, copper, which is one of their most important raw material, that those prices have zoomed up. I think last term I checked 30% up 30% year on year. And that could act as a bit of a drag on the margins going forward. But with the time lag, the management does tend to pass on these cost increases as well. Great company, but I just feel that maybe if it's available 15-20% cheaper on a correction, that would provide some amount of margin of safety and better returns going forward.
Okay, all right, Dipan, we're just getting some initial rates coming in, in pre-open, and Cummins is a stock that's going to be in focus. Those margins look blowout, at multi-quarter highs. They have a con call at around 10 a.m. But for the time being, I think the stock has opened gap up. It's already seen a big rally, but that stock as well is higher. Any view on Cummins? It's never been a cheap stock. The stock has already run up a goodish bit, but the stock, in fact, will be in focus because of those margins. Your take?
Yeah, Nigel, I think we've clearly seen this trend that all these MNC engineering electrical companies like Cummins, ABB, Siemens, Honeywell, 3M, they all have reported exceptional numbers. And clearly, the stock prices have zoomed up because not only are the numbers good and the investor sentiment has improved, but there's very low liquidity in these counters as well. These companies have very loyal shareholders. So, a little bit of institutional buying or concentrated buying does tend to drive these stock prices higher. But look, at 60, 70 times you buy on an up cycle, stock like Cummins, you really can't expect to, make great returns over the next 3-4 years or so. So better to buy them at a correction, no doubt, exceptionally good set of numbers, but wish you had bought the stock maybe a year ago or so. When there were anyway, it was quite evident that the business is starting to pick up and valuations were far more reasonable.
Okay. All right, Dipan, good talking to you today. Thank you so much for coming out and sort of sharing your thoughts with us. By the way, before we move on to our next management, need to point out the market reaction to Edelweiss and those very, very serious issues that the RBI has raised with two entities, ECL Finance, as well as the asset reconstruction arm of Edelweiss. So the stocks right now locked in 20% down circuit. They issued a clarification. Clearly, the market's not sort of reading too much into it. It's focusing on those RBI concerns, and they're very serious in nature. Let's move on now. Speaking of the lending space, let's actually talk to a different company. Aadhar Housing is in focus. The numbers came out. Net interest income and disbursements came in at a healthy growth rate. Assets under management also surged by over 20% on a year-on-year basis. To talk about the outlook for the business, we have Rishi Anand, Managing Director and Chief Executive Officer at Aadhar Housing Finance, with us. Rishi, thank you so much for being with us. So let's start by looking at the AUM growth, the growth in disbursements as well as the AUM. That looks pretty healthy. I mean, disbursements were up about almost 20% year on year. AUM, even sequentially, is up about 6.3%. So just tell us how are you looking at the growth trends and what's the anticipation for this year? By how much do you think you can grow the book?
Thank you so much, Sonia. Good morning to all of you, Prashant, Nigel and Sonia. Thank you for having us back.
This is Surabhi, sir. Prashant is missing in action today. But yes, Surabhi, Sonia and Nigel are very much here.
Good morning, Surabhi, also. Yes, the team has done a wonderful job. The results are out yesterday. YOY 23-24, disbursement 20% up, AUM 23% up, profits 33% up. On a sequential basis, you are right. Disbursements are 25% up, AUM 6% up. That's how it has panned. On a quarter-on-quarter YOY basis also, disbursements are about 11-12% up, 23% AUM, and a PAT of about 25-26% up. With respect to giving any guidance, I would rather take you back to how we performed over the past 2 years. Past 2 years have been in the range of about 20% growth on disbursements and about 23-24% on AUM. I don't see any reason why we should not be able to maintain these matrices.
Okay, got it. But I think the reason my colleague Surbhi was asking you the question, and this is Sonia here. Hi, good morning.
Hi,
is
Sonia,
because,
good morning.
the affordable housing segment, which you cater to, has been seeing a bit of a slowdown, largely because of the recovery in Tier 3, Tier 2, even rural, right? Has taken longer than perhaps what was expected. Do you see any kind of hindrance over there? And just in terms of, you can't give us quantitative numbers, but in terms of qualitative moves, what are you expecting from this segment?
One, I would wish to clarify that we don't serve the rural segment at all. What we serve is semi-urban and urban locations. And I don't see any reason why, industry data would show a shortfall on the growth here, because the way we look at it in the segment that we cater to, there is more than sufficient demand. And I remember quoting one RBI report in every forum that I go to, which was published by RBI in 2019, which shows a total unit shortfall of 10 crore units in the country, out of which 9.5 crore happens to be in the EWH LIG segment, which is the segment I cater to. And if I translate that into housing loan requirement, then we're talking about a huge number of 35 trillion. So I don't see any reason why there should be a dip or why people are talking about a dip. On the other side, there are too many government initiatives that have been taken, right from PMAY subsidies to giving GST benefits to giving registration benefits to consumers. So for us, we've recorded good growth in the past couple of years, and I don't see any reason why there should be a dip in numbers or in demand for the matter.
All right. Hi, Rishi. Morning and good to see you. And Nigel on this side. What about the NIMs? Oh, could you tell us how is the incremental cost of funds in comparison to what you have incurred in the past? And what does it mean in terms of NIMs? You raised some money as well sometime during the last fiscal. Please go ahead.
Yes, in terms of NIMs, Nigel, we're very comfortable. Last year, if I can quote some numbers, last year FY23 we were 8% NIMs. Today we stand at about 9% NIMs FY24. Cost of fund, if I were to look at, there has been a slight surge about 1%. The exit cost for FY23 was 7.1. FY24 is 8.4%. So yes, there has been an upsurge on cost of fund. But the way we look at our business is, are we able to maintain our spreads? Our spreads are quite healthy, and the exit spreads that we posted is 6.2%. And if you recall our last interaction and discussion, we had indicated that the management is very comfortable maintaining anywhere between 5.7 to 5.9 kind of spreads. So we are in the good space, so-called, right now.
Just to repeat the numbers, sir, you mentioned that FY24 net interest margin was 9%. Is that right?
That's right.
And Q4?
Q4 FY24 is 9.3%.
Net interest margin at 9.3%. And how does the 9% for FY24 compare with the previous year? And then an outlook, if you can still hold on to a level like 9% then for the current year.
Okay, the previous year exit FY23 was 8% and FY24 to repeat is 9%.
Okay, so just some thoughts on this. What makes you confident that you can hold on to these levels? I mean, sure, overall in the market there are expectations of lower rates, maybe rate cuts as well, and lower yields. That's the market dynamic. But otherwise, how do you have the confidence of maintaining at least 9% for this year as well? And what's the expectation on cost of funds?
So the way we look at NIMs is it's an output of the spreads that we will be able to maintain. And as I indicated, a steady state spreads of 5.7 to 5.9% is what we will be able to maintain. And historically, we've maintained slightly higher, but as we go ahead, the management feels that 5.5 to 5.7 we can maintain. If we are able to maintain that spread, which we are very confident, then I would, from a perspective of future, I would indicate that anywhere between 8 to 8.5 kind of NIM should be very comfortable.
Okay, 8 to 8.5%. Got it. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. Well, we have a market to trade as well in just about 5 minutes from now. It's going to be a weak start. There's no two ways about that. But what happens from there, time will tell. For now, 22,600 looks like it's going to be hit today. Sudarshan is joining in with a call at 9:10. Sudarshan, what are you looking at?
Well, consider buying AU Small Finance Bank with a stop under 608.
Okay, AU Small Finance Bank, got it. Let's also focus on some brokerage views now. This is a bull versus bear view on Samvardhana Motherson. Now, all of us saw the numbers yesterday, very, very strong numbers, but there are some mixed views coming in. Let's go with the bulls first. Jefferies has retained a buy. They've actually raised their target price on the stock to 175. They called it a stellar set of numbers in Q4, better than expected performance in the polymers business, and they talk about how the margins are at a 28-quarter high for Samvardhana Motherson at 10.8%. Motilal Oswal is the other one. They have a buy with a target price of 170. They say it's a healthy beat in earnings. The reduced gross debt is a big positive, and there's significant growth potential in the non-auto business like aerospace and consumer electronics. Nomura maintains a buy. They have a target price of 165. They've raised their FY25 EPS estimates by 5 to 8% and talk about how acquisitions could potentially bring further upside. But there are two bears on the street. There's CLSA that has downgraded the stock to a sell with a target price of 130. The only reason they're bearish is because they believe that the stock has rallied quite a bit and valuations are expensive now. And they also talk about how there could be a slowdown in the European auto industry because of the tough macro environment. And finally, Citi has a sell with a target price of 85 on the stock.
Okay, so that is Samvardhana Motherson. Good quarter gone by. Let's actually look at Alkem as well. Alkem came out with numbers and they don't look too great. We have, I think, we have Sudarshan with us for the details. Sudarshan, what are the takeaways?
So after Q4 earnings, most brokerages have turned negative on the stock. JP Morgan has a neutral call and it has cut target to 5,445. It says there was a big miss on revenue and even guidance for FY25 appears lackluster. It reduces FY25-26 earnings estimates by 3 to 4% and it believes tax rate will inch higher to 25% by FY27 from current level of 13 to 15%. And as per JP Morgan, even valuations at current levels appear expensive. BofA Securities has an underperformed call and target is rupees 4,130. It says FY25 guidance implies consensus earnings cut. Macquarie has an underperformed call and target is 4,500 per share. It says there was an all-round miss in Q4 and guidance for FY25 is muted. Jefferies has an underperformed rating and target is cut to 4,200 from 4,470 per share, and because of this, it has cut FY25-26 EPS estimates by 5% to 6% on subdued FY25 guidance. So total, most of the brokerages have turned negative on the stock after company has missed estimates in Q4 earnings.
Right, got that. Thanks a lot, Sudarshan, for that. Just a couple of minutes before the markets open, so let's get to Cummins. Vamakshi is here. In case you missed out on that one, Vamakshi, over to you.
Well, absolutely. It's a big beat across the board for Cummins India. Revenue, net profit, as well as the margins have come in well above the street's expectations. Revenue saw an uptick of almost 20%. This is 6% higher than what the street was expecting. And this growth in revenue could likely be driven by demand for CBCP2 products before the new norms come into place from July 1st. The margins this time around were a standout. They are sitting at a record high at 23.5%. This improvement is largely being driven by gross margin expansion of 328 basis points as well as lower other operating expenses. The net profit for the company has come in nearly 58% higher as compared to our own expectations, standing at 561.52 crores. The management said that the CBCP4 range of products are well received by the customers. Keep in mind that Kirloskar Oil also had similar commentary going for it. Exports, however, they might see near-term impact, and this is mainly on account of global economic uncertainties, but nevertheless they're striving for a recovery as far as exports are concerned. But it is important to understand whether these stellar set of numbers are actually sustainable, and we will be waiting for the commentary that comes through from the management at a con call that is scheduled today at 10 a.m. But nevertheless, it's a strong set. Expect the stock to open higher today.
Absolutely, Vamakshi, got it. Thanks. And let's see even how sort of things turn if the market mood picks up and then if there's any additional buying on Cummins. For the time being, the pre-open is absolutely in sync with what the GIFT Nifty was telling us, that we'll start almost 80 to 90 points lower. A lot of the index heavyweights are obviously on the downside. So you've got your TCS, ITC, Infosys, ICICI Bank, the works, all of them are down. The reaction to Tata Steel is interesting. Maybe also has to do with the fact that it's anyway a sluggish market. We're dealing with too many overhangs in terms of elections and those weak global cues. Otherwise, as Nigel has been telling us, it's been a very, very solid quarter for the company. Some more selling on the life insurers, by the way. On HDFC Life, for instance, there's been very consistent selling on this one stock. Not sure if the market's reading something. And remember, I think the last word on those surrender value norms is still not out. Yash tells us there's still some back and forth between the companies and the regulator. So let's see. This is a stock that, again, at least looks like it could start negative.
You know, Tata Steel, just one word. When it came out with this previous set of numbers, it was 135 rupees. Now it's around 175 rupees. You know, so from quarter to quarter, the stock has already seen a big rally. So it's trading close to around a 52-week high. And the other problem is sustainability of these numbers. So I think, you know, once we get commentary from the management, we could see some bit of a move even post that commentary. So that's going to be important.
You know, I'm just watching out for these stocks like which have been the big gainers this month, right?
Yeah.
The biggest gainers in May have been auto names, M&M and Hero MotoCorp. They've gained anywhere between 13 to 17%. In the last couple of days, little bit of shaving off of positions is what you're seeing. So clearly there's a wave of profit taking in some of these large pockets that have done well. Whether it's M&M, Hero MotoCorp, Divi's Labs have also been one of the big gainers this month, coming off a little bit over there. So maybe that's the order of the day, right? Where you see some pressure in these names.
Absolutely. The question is, will this dip get bought? Because we're starting at those levels where the supports kick in. With the Nifty down about 40 points. So the first tick was lower by about 80. It's already reduced to about a 35-point downtick. And that's how it's trying to find some stability. The Bank Nifty is already looking at some green now. So very, very volatile at the start. Tata Steel down about 3%. That's the first reaction. Nigel, as he explains, probably the stock's already run up and factored in a lot of the good news. What else is weak? Titan starts lower, about 1% down. Tata Consumers, a lot of Tata Group stocks actually on the lower side of the screen as we start off things. Asian Paints is down about 0.5% as well. Wipro, JSW Steel, these are some of the early names. So early trends, one is tech. Tech is slightly weak. LTI, Mindtree, Tech Mahindra, Wipro, a lot of these names are lower. And then you have some of the heavyweights also on the lower side of the screen, like L&T. What's counterbalancing it? The reason why the Bank Nifty is higher because of the big banks. Look at SBI, look at Kotak, look at ICICI Bank, Axis. It's banks to the rescue this morning, negating a lot of the weakness in the rest of the market. And some other stocks, Hindalco, for instance, is finding a bit of positivity. ONGC is slightly positive. But Nigel, it's really all about the banks, and let's see if they can continue. Sonia, looking at the screen right now, about 50 points lower.
Absolutely. You know, you were pointing out the banks, right? But let me take it to individual stocks and how things are shaping up. I think what, investors really want to see is how Tata Steel is shaping up this morning. Strong set of numbers, but the stock is coming in for some profit taking. So down almost about 2.5%. I think Cummins is the one that you need to look at because very strong set of numbers. It's a beat across the board. So given the way the market is moving, Cummins is not bad. Down almost just about 0.5%, outperforming the market right now. Samvardhana Motherson is the other one. There have been upgrades post the numbers, but the stock is coming in for some profit taking. It's had a very steep run up as well. Bata, the numbers were lackluster this time, so the stock is down almost about 1.5%. Edelweiss Finance, we were talking about that one. It's under pressure. The RBI has imposed business restrictions on ECL Finance and Edelweiss ARC. Just look at this, 10% knockdown on Edelweiss Financial right now. Clearly one of the biggest losers in trade. GMR Airports, the losses have narrowed to 168 crores for GMR Airports, and the stock is looking pretty good this morning. It's flat in a market which is down. Lemon Tree Hotels, revenues up 30%, EBITDA up 22%. Clearly the star of the show this morning, given that we have such a weak market in the last couple of days. Lemon Tree Hotels up about 5%. Aadhar Housing, good AUM growth. Disbursements have risen about 20%, so looking good over there. IRB Infra, the promoters may sell up to 4% via a block deal. I think they have, yes. About 5.5% equity has changed hands at 65 rupees a share. So IRB Infra is the one that you need to look at right now. But overall for the market, folks, it's not bad. Of course, we've seen, a bit of a downtick in the last few days, and that continues the downtrend. So let's see how the rest of the day shapes up. I think the saving grace this morning is the Nifty Bank here, down, up about 140 odd points. So really buttressing the fall in the market right now is the Nifty Bank. But otherwise, it's holding on to 22,600. Back to you.
Well, thanks a lot for that, Sonia. A few more stocks that are, the top buzzers today. Edelweiss, as Sonia said, one of the top volume losers on the downside, post that RBI wrap on the knuckle. So that stock's down close to 10%. But to be fair, it's recovered 6% from the low point of the day. KFIN as well, we see a large trade out there. That's just taken place, 6% equity changing hands. So that explains why that stock is down close to around 6% to get the block out of the way, as is the case with the IRB Infra. Paytm moves into upper circuit again, one of the top volume gainers in trade today. So that's up and about. Jyoti Structures as well came out with its set of numbers late last evening. And that as well in terms of volume movers, up close to 5%. Genius Power had opened up higher. Let's see where that stock is gone, because the numbers appeared was a bit of a turnaround quarter. The stock has already seen a big rally for the time being as well. I think Genius Power, it's actually done a U-turn. From the top, the stock is down close to around 5%. GMR Airports, that's another one of those big movers today. The stock has already seen a good move, but those numbers are good. But that's the market for you today. Good numbers. Stock opened up 3%. Now it's as flat as can be. SJVN is another stock that's down close to 5%. I think it came out with a set of numbers overnight, and that stock, in fact, is lower. But as we speak, the Nifty is staging a bit of a recovery. It's down only around 20 points. We started off with a cut of close to around 70 points. So some bit of a recovery. The Nifty Bank, that's the one that's fighting for the bulls as we speak. That's up 250 points odd. So
absolutely. Look at Imami, 9%. So that's a huge mover as well, along with Lemon Tree. Lemon Tree is up 5%. Lemon Tree's story is just great growth and margin compression, but that's because they're growing the business. Like Mangalam was telling us, that they're expanding in their brands like RHI, etc. So that's one stock of the day, and the other, also one tracked by Mangalam, actually is Imami. The gross margin expansion, I think, is something that the market really likes. It's over 200 basis points of gross margin expansion, along with decent growth. And that stock's up about 8-9%. But otherwise, the mid-cap screen is not bad at all. You've got lots of stocks, bouncing around here and there. CG Power is finding some takers as well this morning. There's Paytm, which is up. RR Kabel, which is also in focus on the back of block trades, is also up and about. By the way, the Nifty is now looking like it wants to break even. Look at the charge of the Bank Nifty. 300 points on the upside, and this dip. That first big gap down has been bought along expected lines. The question is now what happens in round 2, round 3 and the subsequent rounds, considering today we also have expiry to contend with. But right now, superb moves on SBI, Kotak Mahindra Bank, ICICI Bank, IndusInd, Axis, the entire lot. And it has offered a very nice counter to the overall weakness. So that's the shape and the scope of the market. Adrian Moat, sorry Nigel, you're making
just one word. As we said, when we wake up to all the negative cues, the markets are nervous. You'll be surprised in 5 minutes the market's almost moved into the green.
Yeah. Somehow that ends up happening, right?
On the Nifty itself. Global cues were weak. The market was nervous yesterday. A lot of unwinding, expired-related factors.
Yeah.
And that was the first few words that we said when we started off the show as well.
Absolutely. But like I said, this is round 1. Yeah. I mean, this has just begun, right?
This has begun.
Yeah. This is the first set. We have a long time to go before it's game, set, match. So let's take it up with Adrian Moat, who is joining in. Is a veteran watcher of emerging markets and, of course, India as well. Adrian, great to have you on the show. There's so much going on, right? There are elections. There's S&P sounding more optimistic on India. Yesterday, we are getting the GDP print. And here is a market which is practically at all-time highs. How do you feel about India as we get into the big election outcome event next week?
I'm a little bit cautious on India at this point. We've had a very good move over the last couple of years. Valuations were up sort of 23 times forward if you look at the MSCI India level, and that compares to around 10 times forward for MSCI China. And we've had significant outperformance of India versus China, but more recently that's beginning to reverse, and I think that's putting pressure on the international funds, particularly the EM funds, to perhaps adjust those levels. I think the perspective on the election as an event is the expectation that the incumbent government will win a majority. Maybe the size of that majority has been moderating in terms of expectations. But it sort of looks like an event that probably wouldn't generate much upside if the consensus view comes through, and perhaps would have an asymmetric downside if the BJP majority was very narrow, which I think is very unlikely. So I don't see investors looking at makes sense. And then when we look through how the market has been performing, you've got a really big spread of returns, and the things that have driven the market, the index, have been relatively narrow, and maybe not some of the traditional stocks that international investors would have held, such as the private sector banks or IT names.
Okay, so you're a bit cautious on the market. Got that, Adrian. It's good to see you after a while. It's been a while since we've chatted. But overall for the market, right, it's quiet, you'd have to say, but the Bank Nifty is really pulling in the punches right now. 230 points higher on the Bank Nifty, making its presence felt. And lots of banks actually batting for the bulls, whether it's SBI, which is your top gainer, Kotak Mahindra Bank, ICICI Bank, IndusInd, that whole lot is up in the green. Adrian, I wanted your thoughts on banks, because now we're suddenly seeing some of these underperformers come back into the fray, whether it's something like an HDFC Bank, where there has been large delivery-based buying in the last few days. PSU banks are coming back in a big way. You know, notwithstanding what happens with the election outcome, do you think for a long-term investor, the time has come to put more money to work in banks?
I think it's still a little bit premature. So if you look at HDFC Bank, it's about 2.4 times tangible book value. Its forward P multiple is significantly lower than it used to be. But on a price to tangible book value, it remains one of the world's more expensive banks. Perhaps you find some of the faster growing Indonesian banks with similar price to tangible book levels. So it superficially looks interesting on a forward PE, but there is still this debate about, India is a place which runs a current account deficit, so it has a savings deficit. Deposits are a key ingredient in the banking industry. And in the past, the private sector banks are incredibly good at accumulating deposits much more rapidly than the broader banking system. That's now not the case. I think they've probably caught the sweet spot in terms of the customers that would move towards them. And we're seeing the PSU banks benefiting from, the significant reform that you had with the bankruptcy code, the recapitalization of these banks. And so this trend of SBI outperforming, which it even seems to be doing today, probably continues versus the traditional blue chip private sector banks that the FIs would hold, such as Kotak or HDFC. So I think it all comes back to this competition for deposits in an economy that's growing rapidly and has good uses for capital. And this issue with availability of deposits is a broader issue for the global banking system. And what we see in places like the United States is people putting money into money market funds rather than leaving on deposits. So I think there's a broad global story here that even the top quality banks with high return on capital employed are struggling a little bit when it comes to deposit growth.
Hi, Adrian. Good morning and good to see you. And Nigel on this side. Yeah, the way SBI has outperformed HDFC Bank in the last year or so has been phenomenal. But we started off this conversation by talking about India as well as China. And in China, there are some various policy measures that are helping them and in turn helping metals as well. How do you approach this entire metal basket? Because in all probability, you'll get a couple of rate cuts. It'll soften the dollar. Demand hopefully comes back. And, some of these metal stocks have already priced in most of that. Your view on them?
Yeah, I think people have got a little bit too optimistic on China's demand for commodities. They are doing policy actions with regards to the property sector. But remember, the big issue in the property sector is vacant properties plus partially finished properties. And as they resolve these issues, which are really issues around the financial system, the banking system, in themselves, I don't see them as being a source of significant demand for commodities. So I still expect things like the iron ore price to remain relatively soft. We have seen some strength in things like copper, but that seems to be partly a function of some supply disruption. We've also broadly, we've had a bit of excitement when it comes to M&A in the metal space with BHP putting in a bid for Anglos, although that now seems to have been withdrawn. So that'll be interesting, that dynamic. So I would caution people that are thinking about buying more into the commodity space. I'd be more on the camp that you should be reducing after making some pretty decent year-to-date profits.
Okay, it's a little cautious on metals and on commodities. Adrian, let me just pull out for the bigger picture again. I mean, speaking of China, this year started off with the hope that foreign investors will double down on India because, they didn't do much for the bulk of last year. But that has not played out. I mean, in equities, foreign investors have pulled out close to 20,000 crores of Indian rupees. They've pumped in a lot more money, double that amount in bonds, actually, Indian bonds, ahead of the JP Morgan index inclusion. Earlier, it was about Japan. That was a hot market. Now, what is it? I mean, what do you think is behind this disenchantment that foreign investors seem to be having with India?
So I wouldn't say it's a disenchantment specifically with India. The emerging markets as an asset class have been extremely disappointing, and a lot of that has been due to the weakness in China. But we've also had significant weakness in markets like Brazil, South Africa, which also has elections at the moment, has been very disappointing. That's all going on while the S&P and NASDAQ have continued to make new highs. And I think what we've seen is this global equity money moving out of emerging markets. And India, unfortunately, suffers from that move, even though India's fundamentals are much stronger than the balance of emerging markets.
And do you see that reversing? That's the point, because US markets up until very recently, I mean, look at Nvidia, look at the way the market's moving. So do you see this trade continuing because some other markets just doing so well, or do you see a reversal at all in the second half?
See, I do think there's going to be a reversal, and I'll go back to talking a bit about what's happened in China. So if you look at the large cap names in China in the index, these all tend to be in the tech enabled spaces. So you've got gaming companies like Tencent, you've got the e-commerce names like Alibaba, JD. These companies are announcing significant increases in dividends and big share buybacks. And it reminds me a little bit of the tech names in late 22. Remember, NASDAQ had a terrible 2022. You had significant declines in the major tech names, stocks like Meta being at record low valuations. And in response to this, you got a real focus from the board of directors on shareholder value. And that was the start of the recovery in NASDAQ. I think we're seeing some evidence of that in the big Chinese names. And although we talk a lot about Chinese property stocks and banks, they're a very, very small part of that benchmark. So if you've got these large cap tech names, which tend to have quite a lot of cash on their balance sheet and are more focused on reducing costs and generating more free cash flow, they start to look like attractive financial instruments and can be sufficient to drive the China index higher.
Okay, Adrian, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. By the way, for the market, it is not bad at all. It's the bank Nifty that's really batting for the bulls this morning and making sure that the Nifty stays afloat above the 22,600 mark. The bank Nifty now up almost about 400 odd points. But let's shift focus to Tata Technologies. Reported a steady Q4. The EBITDA margins expanded. Profits after tax slipped by 27% because of higher taxes and lower other income. We have Warren Kevin Harris, who's the Chief Executive Officer and Managing Director of Tata Technologies. Mr. Harris, thanks a lot for joining in and appreciate your time here on the channel. I wanted to talk a little bit about the growth, right? X of VinFast, your revenue growth has been about 10.5% in Q4 and 30% in the full year. What can you guide for in terms of growth in FY25, both with VinFast and without?
Well, good morning, and thanks for the opportunity to join you again. And we were very pleased with the full year results last year, and certainly the momentum that we maintained through Q4. We're very excited about the opportunity that we've got in FY25. There will be a slight overhang from the runoff that we've seen at VinFast that will continue in Q1, but the full year we are very bullish. And despite some of the guidance that are peer group companies have provided in terms of the full year tapering somewhat. We don't see evidence of that. Demand continues to be very strong, and we continue to convert a significant number of the large deals that we have in our pipeline. So we're very confident about the year that we've just entered.
So do you have any numbers that you can share with us in FY25? What are you guiding for in terms of growth?
We don't provide specific guidance. All I can say is that the momentum that we established last year has continued. We continue to position that we expect to meet or exceed the growth expectations for the full market.
So you may not, sorry, the reason I'm asking you repeatedly is because, we are seeing some signs of a slowdown, especially in pockets like electric vehicles, which is passenger vehicles, right? I mean, if you look at Tesla, they've sort of cut down their guidance. There's a large amount of their workforce that they've laid off. So are you looking at some slowdown because of these, cautious pockets?
No, I think somewhat counterintuitively, the ER&D cycle, the investment in new product, does not align specifically with the volatility that we sometimes see in terms of consumer demand and unit sales. So companies are investing today in support of their competitive position in 3 or 4 years from now. So we've not seen the impact of the slowdown in the EV growth that is being positioned for markets like the United States. And one of the things that I always remind everybody is that despite the rhetoric that's coming from some companies, the expectation this year is that the EV sales will grow from 14 million units last year to somewhere close to 16.7 to 16.9 million units this year. So although growth is tapering, the transition to alternative propulsion systems continues as expected.
All right. Hi, Warren. Good morning and good to see you in. I wanted the outlook on the technology solution segment because that is a smaller part of your business, but it grew at more than 20%. I think around 23% to be precise. Could you tell us, can it continue to grow at more than 20%? And that's only for that segment. And overall for the company, are there levers in place to improve margins for the coming fiscal?
As far as technology solutions are concerned, we were very pleased with the performance of specifically the education division within that part of our organization. The public sector education proposition that we built here in India continues to grow in a very pleasing way. The central proposition that we represent in that area is the work that we're doing with state governments in and around the deployment of innovation centers for the ITIs. One of the things that we're actually doing is deploying our e-learning platform, I Get It. We are educating students in terms of how to develop concept through the production launch of an electric vehicle. We're partnering with Tata Motors, and we're taking electric vehicles. We're cutting those electric vehicles into sections, and we're able to show the student how the digital product is developed, and also compare and contrast that with the physical manifestation of the product. That approach has been successfully deployed at states like Karnataka, and we've won business over the last 12 months with Tamil Nadu, with Assam, with UP, and the order book continues to grow. So we expect the growth that we enjoyed last year to continue, not just this year, but we have an order book that gives us confidence in terms of our prospects over the next 2 to 3 years.
Okay. So just to expand on this further, what are the kind of tie-ups perhaps that your investors and stakeholders can look forward to? Because you've been announcing several of them, right? There was one with Airbus, there's been one with BMW. I mean, what part of the business do you think will drive the growth that you're alluding to?
Well, I think if we look at the different industry sectors that we support, our primary focus is automotive. That represented over 85% of our services mix next year. Much of the growth and the tailwinds that we're seeing there relates to the transition from internal combustion engines to electric vehicles, and the investment that's been made in software-defined vehicles and connected capabilities. We expect that transformation to play out over the next 10 to 15 years, and so the growth that we've seen over the last couple of years, we expect to continue. And one of the things that we're very proud of is the work that we've done for both traditional OEMs and new energy vehicle companies. And one of the things that's unique about Tata Technologies is the end-to-end capabilities that we have. We still believe that we're the only engineering services organization in the Indian private sector that has developed a complete electric vehicle. And that reputation is affording us the opportunity to build partnerships such as we've recently announced with BMW. We'll be standing up a joint venture here in India with BMW that will be focused upon automotive software and also the development of digital technologies that will help BMW optimize the way in which they run their global operations in the future. So automotive continues to be very strong for us. We're also very bullish about aerospace. Just to give you some numbers, there's about 23,000 aircraft in productive use today. In the next 15 years, that's expected to almost double. And so the likes of Boeing and Airbus can't produce enough aircraft at the moment to satisfy the demand. And so we are very much providing services and capability to accelerate manufacturing throughput within those organizations. And we're also partnering with the group companies, Tata Group companies. As you know, the Tata Group has made a very big investment in aerospace with the acquisition of Air India. It's also invested in capabilities in and around what TASL does, and we're partnering with both of those organizations. So those tailwinds are certainly reinforcing the confidence that we've had in that sector.
So, Mr. Harris, coming back and sort of to wind up with the big picture view, right now, the services part of your business is about 77% of the revenue, right? Technology is about 23%. How do you see this mix evolving over the course of for the current year, FY25? And I'm just trying to understand which business typically perhaps fetches you better profits and better margins. And you're at, I think, just about $600 million in revenue, 618 at the end of 24. Slightly longer term roadmap, but when do we see Tata Tech hitting $1 billion in revenue?
Well, in terms of our expectations for this year, the split in terms of mix will continue to be about 80-20. The services business is the center of gravity as far as our value proposition is concerned, and as I've referenced before, we continue to be relatively optimistic in terms of our prospects, not just this year, but in the future. But we are addressing through technology solutions a very challenging part of what it's going to take for the manufacturing sector to evolve, which is the development of new skills. And so the investments that we're making in the public sector here in India, we expect to inform content and capability that will reinforce the work that we're doing with many of our customers in the private sector as a complement to what we're doing in services. So we're expecting both of the businesses to grow at about the same rate next year, and we certainly are expecting to continue that as we move into follow-on years. As far as margins are concerned, services continues to provide a much more generous operating margin than tech solutions. But the convergence of our of the business mix is providing again the confidence that we'll continue to improve margins as we move forward.
All right, Warren, thanks a lot for joining in. Wishing you all the best for the coming fiscal. Next time around, we'll try to pull you on some numbers. Till then, wish you well and look forward to chatting up with you. For the time being, slip in a short break. On the other side, we'll focus on RHI Magnesita. Well, I think instead of going into that break, I think we have the management who's standing by itself. Well, we have Mr. Parmod Sagar, the MD and CEO of the company, who joins us. Hi, sir. We didn't want you to wait even for the break. So let's get straight to the action then. One good factor in these numbers is that the margins have improved on a sequential basis. So good on you. Could you tell us, how do you see things panning out for the coming year? In the past year, you had the benefit of a couple of inorganic acquisitions coming into your fold. What is the volume growth you're looking at for this year? And also, you have a peer here in India, which is Vesuvius, which is growing at a rampant pace. What is the market share you have, and do you see that increasing?
Okay, so actually India is growing at about 6% CAGR, and we are expected to grow more than 8%. This means we want to grow with the industry, but also the areas where we are currently underrepresented. Our current market share is about 30%, and we aim to achieve more than 35% by penetrating underrepresented segments like iron making, DRI, pellets, etc., with the technological support from our parent company.
Okay, got it. All right. The problem pocket, sir, for you is that asset you acquired from Dalmia. If I just do a rough back of an envelope calculation, it still appears that you're functioning at 50-55% approximately. And margins, I think they are in low teens, maybe 10 to 11% odd. Could you tell us what is the revenue outlook just for this acquired asset? Because the margins are relatively lower. So revenue outlook from this asset and margin outlook just for this one. Yeah.
Okay. As you are aware, there is a significant overcapacity in global refractory market, not just in India. This is due to the broader global macroeconomic factors, like in steel and cement production. Globally, whilst there is a huge pressure on geopolitical factors, there is a bit of stalling in policies of production due to election in Europe, US, even South America. Until there is a steel and cement production and consumption, this global overcapacity in our industry is going to persist. This will lead to significant price escalation due to overcapacity. As we are not guiding on revenue, but on volume side, we are comfortable with a growth of for Dalmia plants around 14-15% and overall around 8%. Our focus is to control controllables, which is our cost, operational excellence, ensure that the margin are similar. At present, our margin is 11.4% of last fiscal in Dalmia plants, whereas when we acquired it was 6.9%. So it is significant improvement in margins, and we are expecting that it should be further improved to that level of 12 to 13% in Dalmia plants.
Okay, got it. So Dalmia, just to get it right, the volume growth you're guiding out there is 15%, right? While for the entire company it's around 8%.
Absolutely.
All right. And for the blended margin, then what would that mean? Because you're going to grow, so operating leverage will play out to some extent. Dalmia will improve as well from around that 11% to around 12 to 13%. So on a blended basis, what should the consolidated margins look like?
I still maintain 14 to 15% on consolidated level.
Okay, all right. What about exports? As you're telling us, the globe itself is going through a bit of a tizzy, geopolitical tensions, demand is not strong enough. Exports, you have plans to scale it up drastically. For this year, what will exports contribute as a percentage of your mix, given the headwinds that we're already seeing?
Our export prior to this last fiscal was about 14% on consolidated level, and now it has come down to 10% in this year. And in the short term, I don't see any, growth in export business because of the reasons I mentioned earlier. So I say maybe after midterm 2 to 3 years time, the growth will come back, and we are expecting around 20% to 25% growth in export in midterm 2 to 3 years from now, not in this fiscal.
Okay, all right. So this year will be a bit of a dampener, but going ahead, you're expecting exports to pick up. Final question before we let you go. Besides the operational performance being a little bit subdued, the other worry for the market is that the Dalmia group has more than 10, 12, I think 13% of RHI Magnesita. and they're wondering whether or not that block is going to hit. Have you heard from them?
No, whenever I had happened to talk to them, they never said they wanted to, offload this.
So you believe that
I think they are happy with that.
So you believe that they'll hold on to this 13%? Is what you're telling?
This is my perception, but Mr. Puneet Dalmia is the right person to answer this question.
Yeah, but we need to ask you as well, since you're saying off and on you speak to them. So I need to put this question to you. And if they are sellers, will the parent look at buying?
I think we are open for any and everything. If it's opportunity comes, we will definitely look into it.
All right, Mr. Sagar, thanks a lot for joining in. We wish you well. For the time being, in a market that's quite wobbly, the stock actually has been an underperformer the last year. But today, at least, the stock is outperforming because your margins have improved both on the standalone basis and on a consolidated basis as well. The stock is up close to 3% as we speak. For the time being, we slip into a short break. On the other side, we have the management of Samvardhana Motherson, who's waiting for us. Stay with us.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Welcome back. As promised, we have the management of Samvardhana Motherson with us. Very strong numbers by the company. Over 42% rise in EBITDA, 20% improvement in revenues. We are joined by the Chief Operating Officer Pankaj Mittal and the Chief Financial Officer Kunal Malani, who is with us. So, gentlemen, morning to both of you. Mr. Mittal, I want to start with you. You know, overall in FY24, right, the year has ended and the consolidated revenue growth has been 25%. Can you tell us what is the outlook for FY25? Can you do this kind of growth? Can you do better? And what are the demand trends looking like now?
Well, if we look into the basics, you will see that we have been growing both organically as well as inorganically. So this year, both the organic growth and inorganic growth contributed nearly similar amount, 12.5% coming from organic growth, 12.5% coming from inorganic side. And moving forward also, we are on a very good path, setting up 18 greenfield sites, which will come into operations. We have the acquisitions which have been closed, which are not in the P&L this year, like Yachiyo. We have done ADI, Lumen, all put together. They will contribute, if we look on a full year basis, all the acquisitions which we have done, they should contribute another 14,500 crores or something like that in FY25. So organic, inorganic, and we are on a very good way towards our Vision 25, which has been for $36 billion. So more things to come in. We see a good future being a powertrain agnostic company. So we don't get so much impacted with the changes which are happening in the market. We supply to all kinds of vehicles.
Okay. So you're saying that the acquisitions will contribute 14,500 crores in FY25. What would that be in terms of growth? What are you looking at? And what will the organic growth be in FY25?
Well, being an OEM supplier, we can't exactly put a number to that. But as I mentioned, that the basics are in place. We are a deleveraged company with very good ratings. So, you know, being acquisitive in nature, customers give us many more opportunity. And that's why we look at acquisitions to also grow. And the companies which we have acquired, they also have very good future in terms of their organic growth. Because when you look into the market, like Yachiyo coming into the fold, both their main products like the sunroofs, as well as plastic fuel tanks, they would see a very good growth. We have very good technologies which came into the fold in terms of our interiors, exteriors. Vehicles are getting premierized, and that holds very good in terms of providing solutions to our customer. And most of these greenfield sites have also come in the emerging markets. most of them in India, and China, which are high growth markets.
So just a couple of questions. You said $36 billion continues to be your revenue target for FY25, correct?
That's the 5-year vision which we had set for ourselves. So that's a visionary target which we set, and we always move towards that without, just driving towards the top line. So always you would find, Motherson, keeping a very good balance in terms of how we can be value enriching to all the stakeholders and do the acquisitions at the behest of the customers, where we have the blessings that it gives global solutions to them.
Got it. You were talking about Yachiyo. Just to follow up there before we head to Kunal. I mean, you have sort of this acquisition has helped you get into different spaces, right? Whether it's sunroofs, fuel tanks, resin products, etc. Are you looking to expand your product portfolio further? And in the on the acquisition side, where would your sights be set now?
Of course, we are always wanting to do something which our customers want us to do. So that's how the whole product portfolio has expanded, and we would not hesitate to do more wherever the customers would want us to get into. Also, you would see that our emerging businesses, they are doing very well. This year, they contributed more than 8,000 crores of revenue, and that's another area. So aerospace, the health vertical, lighting and electronics, all those areas are also growing at a very healthy pace, and we see a good growth in those divisions as well in the coming years.
Just want to sort of also talk about the cost factors. Kunal, if we could sort of come to you. Margins have expanded in Q4, and that's great. But how sustainable is that expansion given the rise that we're seeing in a lot of material costs, particularly metals? What do you envisage going ahead? And what's a steady state margin that you would hope to maintain for the year as a whole, FY25?
I think, firstly, as we have always said, please look at Motherson on a longer term basis. A quarter is not necessarily reflective of much. So if you look at an annualized level, yes, we have improved our performance. And we've always said, please look at the absolute numbers. And on an absolute number, we will continue to grow going forward as well. The number to really focus on is ROC, which we have expanded from 11% last year to 18% this year, if you were to exclude some of the M&As and greenfields that we have set up. If you include them, we are still at 17%. And here we see a lot of traction in being able to further grow this in 25 as well. I think Pankaj mentioned some of the acquisitions which are yet to be embedded into the P&L side. They are there already in the balance sheet side, but the P&L, the full impact is not there. And hence, the 14,500 crores is the minimum that is going to come on the top line side. Other than that, I think the business performance has done reasonably well. The outlook seems decent, and hence we've been able to also recognize deferred tax assets of some of our past losses in this quarter. And that is again reflective of a longer term change that's occurring where many of our units which had challenges in the past, I think a number of the teams done well to kind of improve the performance on a fairly consistent basis. And that's what's driven our ability to then recognize some of these deferred tax assets. So I think all the ingredients are there that we should be able to further propel from here on ROC. Our target is 40%, so still a long way to go in that regard. But I think directionally we should certainly be able to improve this very well in 25.
Okay. Just a word also on the capex and debt levels and how you're looking at sort of that management. I think the capex plan for this year is 5,000 crores. In the previous quarter, you also pared down some debt. So what's the guidance that you can provide in terms of the debt levels that you'll hope to maintain, the debt to equity, and just maybe a little more color on the 5,000 crores of capex? How will you put it to use?
So out of the 5,000 crores, we've announced 18 new greenfields, 6 of them in this quarter, 12 we had already announced in the previous quarter. So on these greenfields, around about 2,000 crores is what is going to get spent. The remaining is the normal maintenance capex that occurs, or program capex that occurs. So we are looking at something like 5,000 crores plus minus 10% is what we are aiming for, at least in FY25. With this capex, together with some of the cash flow generations, improved performance of the business and so on, I think we will still be on a deleveraging path. So from a debt perspective, if we do not consider any incremental inorganic growth that we do, in our view, the leverage ratios or debt to EBITDA should be somewhere in the 1x odd levels, give or take, by FY25. So overall, I think there are again many levers of cash flow generation with some big, greater degree of stabilization coming on the working capital side. Stuff like commodities, etc. to us is a pass-through. Yes, they have gone up, but from a lag perspective, they become pass-through. So overall, I think again all the ingredients are there that we should be able to deliver from here on an organic basis, in spite of all the higher capital that we are doing for growth.
Okay, so you said debt to EBITDA should be in the range of 1x, right? Your net debt is now at 10,300 crores. That's a drop of almost 18% quarter on quarter. What do you expect the net debt to be by the end of the next year?
As I said, we don't want to hazard a guess on this. As I said, it is 1x, so it becomes very easy to look at what it is likely to be. But I would just say that it's a direction where, in spite of all the incremental capexes, in spite of, inorganic growth opportunity, the sector that we're looking at, our leverage ratio remains fairly, good and has the necessary, let's say, the firepower now to go after the incremental growth that we are looking at in FY25. The direction on 1x is to highlight the fact that there is a lot of headroom, and for sure we are inundated with a fair amount of M&As, and hence it is, and that's the reason why I don't want to give necessarily a number out, because inorganic growth will still be part of the puzzle as we move into FY25.
Okay. So, the strongest growth, Mr. Mittal, I want to come to you on that. The strongest growth has been in the emerging businesses, and it's interesting there, not just revenue growth, which has been about 18%, but EBITDA growth. The operational performance has picked up a lot in the emerging businesses. I want to understand 7% of your revenues comes now from emerging businesses, both auto and non-auto. How much can you grow that to, and is there scope to grow margins further in that space?
Oh, of course. I mean, these are emerging businesses and they are poised to grow at a much faster pace as we move forward. As you know, we have also announced the acquisition of ADI, which is into the aerospace side. So we do see very good traction from our customers for these emerging businesses. And you will see that the next 5-year plan will also see a huge growth coming from these.
Okay, got it. So when you say huge growth, how much can you take it up to? I mean, can it contribute 10%, 15% of your business?
No, I mean, it'll be much faster in years to come because these were the new businesses which were embedded. So obviously, when they are smaller and then they grow, they will definitely grow at a good pace.
Okay. And, I wanted to know on EVs as well, right? That's been the mega trend where the share of hybrid, share of EVs has gone up in the portfolio, not just for you, but for the entire industry. 23% of your automotive booked business is from electric vehicles now. How much can you take that up to, and will that help you further with your operational performance? Kunal, I want you to come in on this.
Look, I think on an EV front and on hybrid front, we've been, so number one, I think we are powertrain agnostic. So irrespective of whatever powertrain sells, from our perspective, it works well. Obviously, in an EV or hybrid, the content increase is much higher, and hence it is helpful to see the transition happen. Having said so, I think from an EV perspective, while the growth continues, the pace of growth clearly has ebbed lower. And hence the share of revenues that were being expected from EVs, I think that share hasn't happened as much as what the expectation was. But from our perspective, ICE hybrids continue to sell, and hence it really does not matter from an aggregate perspective. Hybrids, on the other hand, in our view, seems to be catching a lot more fire now, and hence, we expect that share to move in many parts of the world as an intermediate point between becoming completely zero emission from an ICE engine construct. So overall, I think all three is likely to do well, at least in the shorter term. And then I guess we need to see how the technologies evolve to see what other opportunities exist. But again, just want to highlight we are powertrain agnostic, so really does not matter in the aggregate scheme of things. And the other piece I think which is worth noting is clearly the premiumization on the developing part of the world continues to be much, much higher. Places like India, China, I think continues to rocket higher on the premiumization front on SUV usage and so on. And that again carries a lot of content increase for us. So overall, our portfolio and geographic mix should be able to propel the growth from here on as well.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18. Well, let's do one thing. Let's slip into a quick break. On the other side, we'll have the metal analyst Rahul Jain put focus on Tata Steel's Q4 numbers and what you should expect from there. What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com.
Show you the car. We are in fact here at Yerwara police station. There are 3 FIRs right now which have been registered in the Pune Porsche drunk driving case. One of the FIR is by the driver's family, who would allege it that that he was kept illegally confined inside the staff quarters at the family household. He was in fact he had also mentioned that he was
Welcome back. Well, the markets have taken out the 22,600 odd mark. So that bit of a bounce that we saw, that quickly got sold into. The Nifty Bank, though, that's holding one end up with a gain of around 250 points. Positioning is very, very light over there, as we were telling you earlier. Rollovers are much lower than what we've seen in the past. So that one's a lighter index for the time being. It's doing a bit of an outperformance. But Tata Steel, that's one of the top losers on the Nifty, in fact. But the numbers look pretty okay. We have Rahul Jain, who joins us on the show. Hi, Rahul. Good morning and good to see you. Well, the stock is pulling back close to around 4%, Rahul. What did the street like about the numbers? Or do you think it's market sentiment that's swaying? Because that's not the only steel stock that's down. The other ferrous names as well have come in for some profit taking. Your take?
Yeah. Hi, Nigel. The numbers were pretty slightly weakish, I would say, because largely due to pricing. So steel prices on a year-on-year basis for Tata Steel is lower by about 8%. And QOQ is about by 4%. So that is actually dragging the numbers lower. Volume, they've done fine. They have shown some growth. Obviously, the next kicker will come from when the new 5 million ton expansion that they're doing. And on the cost side, also things were pretty all right. So if you see, despite weaker pricing, they've managed to hold on to the EBITDA. The EBITDA per ton is only slightly weaker. So in that sense, the numbers are not that bad, obviously, but pricing is the key element. And we have seen prices go up in the recent quarter. In the Q1, we can see a significant, or almost about, companies have been talking about 5 to 10% kind of a steel price increase, and costs are kind of benign. So the outlook in going forward is much better.
I'll be speaking to the management in a couple of hours from now, or maybe 90 minutes from now. And if that 5% price increase comes about, I don't know whether demand's strong enough, but that'll be music to the ears of the bulls. But you mentioned that the numbers are a little lower than your expectations. We go through a lot of brokerages with regard to the India EBITDA per ton and the Europe EBITDA per ton. And in comparison to that, actually the numbers for India was more or less in line at 15,000 rupees per ton. And on Europe was much better. What were your expectations?
Yeah, Europe, actually, they have managed to cut down the losses. Over there, things are slightly better. India, obviously, because if you go by what the numbers other companies have reported, they have done slightly weakish in the sense the pricing hasn't been that robust. So that I think that taken care of by how market moves from here. So I think the key commentary here is when are they going to commission the 5 million ton? They've done a lot of capex. So how that shapes up here.
So you're not going to be a buyer into this dip on Tata Steel, right?
Yeah, I think their growth profile for some of the other companies is a lot better, largely because of the base level, especially, for example, if you see Jindal Steel and Power, their capacity expansion is almost doubling from here, So the profile is very different. Tata Steel, certainly good. They have their issues in terms of, getting the UK operations on stream and reducing the losses in the international operations. Debt level also continues to remain a bit on the higher side, about more than 75,000 crores. So Tata Steel has a lot to work on the balance sheet as well as the international operations. So those are the slight issues which I see over here.
All right, and JSPL, they've got a couple of triggers for them as well, right? Capacity is going to be increasing. They're getting some coal from their captive sources as well. And that political uncertainty for the time being seems to have been put to rest. And that explains why that stock has moved up. A quick word on the non-ferrous space. A couple of calls you have got bang on with regard to Vedanta as well as Nalco. I think you were quite bullish on both those two names. Both those two have seen some bit of a pullback, particularly Vedanta from the recent peak.
Right.
Any view on that name?
So Vedanta, especially the one is that they are going to announce a breakup. The details are yet to come out, and non-ferrous prices have been very robust. So if you see across the board, the key metals for them, aluminium and as well as zinc, both are more than 5 to 10% in the last quarter. So that is a very strong driver, and also the if you see the change in earnings is far massive, because what happens is they also have coal, captive coal coming in. They have the bauxite integration is going up. So things are improving very significantly over there. And obviously they were trying to raise some money so that they can lessen the debt burden much faster. So that the balance sheet change is very fast, and commodity price drive also is quite strong. So they have two massive tailwinds coming in their way, which can really alter. So if you even look at the value today, it's about 450, whatever order the stock is trading at. Hindustan Zinc holding itself is at a similar price. So in a sense, they're getting all the other businesses at kind of a very discounted price. So with over time, will get discovered. I think they've had issues in the past. So as things get resolved, we can see a significant uptick from here as well.
I just wanted to get your sense on, from here on, what would be perhaps one or two of the best metal stocks to play? Because if we just look back at historical trends, some of the PSU metal names have done very well because they have the added tailwind of, the PSU buzz. So SAIL, for instance, has given double the returns of Tata Steel in the last 1 year. And then this underlying sort of, trend on aluminum, which has been very, very bullish, that's really helped Nalco, along with the fact that it's a PSU. So going forward from here, what would you bet on, ferrous or non-ferrous?
So the characteristics of ferrous is actually a lot better because you have costs which are going to come down, especially see ferrous, see for example, Hindustan Zinc is a cost leader, right? They're more than 50% EBITDA margins. So really can't do very dramatically over there. But for aluminum players, the swing can be quite significant. The costs don't go up. For example, in steel, the slight issue is that whenever you see steel price going up a lot, you see coking coal, prices also start moving higher. So the bargaining power is much lesser in that extent. Whereas in case of aluminum, most of the coal is sourced domestically, or even if it is imported, the costs don't move, in line with the end commodity price. So you end up keeping most of the margins. So that is a positive trade we have over there. And in case of non-ferrous, the drivers are also similar, but non-ferrous in case more so for EV replacement and, for climate change transition. Those things are, and aluminum has come as standout metal, especially after COVID, due to the very high, the recycling capability it has. So that has done well. The underlying drivers obviously remain very similar. Transportation and construction is more than about 50-70% of the demand. So that those remain the same for steel as well as non-ferrous. But non-ferrous metal companies in India are definitely slightly better placed compared to the steel producers. Obviously, steel individually stock specific, like I said. For example, you mentioned about PSUs. So in case of PSUs, the lot of inefficiency is there. For example, if you see the EBITDA per ton for SAIL, it is far lower compared to JSW or Tata Steel. So even if there's some small improvement which they're able to work through, that makes a huge difference. And see, on terms of the physical assets, SAIL is unbeatable. They have 5 locations. They have full captive iron ore, but obviously they have not been able to ramp up the production in the same manner. They've taken far longer to increase the capacity. Now they're talking big numbers, but the faith of the market is less in terms of the timelines, obviously, because they have not been as efficient in terms of adding capacity. But those things can change. Obviously there is, as you have better management drive, more accountability, things can look better. So PSUs are definitely, they have very positive characteristics. For example, in case of even Nalco, they are the only one which have, adding alumina capacity. So those things are definitely there. Yeah.
Okay, thanks a lot for that. Thanks for taking the time out. By the way, for the market, the Bank Nifty is still holding up, but the other, part of the market is not. So the Nifty is now down 140 points. Sensex is down 420 points. It is getting worse by the hour. Just keep an eye out on that. Very, very volatile right now as we speak. But Imami is firing up in trade. Mangalam is here with more details on that. Mangalam, over to you.
Well, the company reported their numbers around 310 yesterday, and as a result of the volatility in the market, the street did not pass through these numbers. But some overnight assessment and commentary from the management, and that's taken the stock higher today. It's extended winter in the fourth quarter that aided sales in their winter portfolio. Domestic business for them grew 8% with a volume growth of 6.5%, which is among the highest that we've seen in the FMCG industry so far. Gross margins improved, and the company ramped up their ad spends as well to about 20% of sales versus 15.5%. All of that doing well for them. So overall, the revenues of the company grew around 6.5%. The EBITDA grew 5.5%. That's because they spent a lot more on advertising this time around, and the net profit too was stable at around 147 crores. The categories that did well for them, the winter categories. So you had Boro Plus, which showed a growth of 33%. Healthcare, which has Chawanprash, that is typically a winter product, grew about 10%. And we saw some weakness in Navratna and Dermicool because Jan and Feb were still colder than what usually it is. So, and that brings us to the big trigger to track now will be the performance of summer products as we are talking about the heat wave. And it's the first full summer that the company will have for its acquisition of Dermicool, which it made in March 2022. And thereafter, the March 2023 summer was largely impacted by them scaling that business up. So all these factors coming together, the future looks good for Imami, and the stock trading at 28 times is a lot lower than all the other consumer staple companies as well.
Okay, all right, Mangalam, thanks very much indeed. Imami is doing very well in an otherwise extremely weak market. The fall, by the way, is now a whole 150 points on the Nifty. We're at the morning lows. So that opening sort of dip happened, then the buying of the dip happened, but then we've got a second dip. And this one's looking pretty significant at this point in time. In fact, the Bank Nifty is also, the gains are getting shaved off a little bit. So that's the market for the time being. The Midcap index should pull that up. We haven't mentioned that in a while, that the broader market is seeing a fair amount of pressure as well. The Midcap index has fallen a lot more than the Nifty, and the advance decline ratio is quite weak. So weak morning is what we have. Quick break. We'll come back on the other side, and then we will be in conversation with Pavitra Shankar, MD of Brigade Enterprises, to talk about how trends look after Q4.
And was not allowed to speak to his family for a very long time. Now this car is the car which was used to pick up the driver. Cops have now taken this vehicle into their custody. In fact, my Vijay Vasant will show you visuals of how there is a notice that has been put in the car as well. In this very car was where the driver was taken, following which he was kept illegally confined. Now cops have taken this very vehicle. They've seized it and kept it in the custody at Yerwara police station. Along with that, the Porsche car also, in this case, has been kept just a few cars away from this vehicle. Yesterday, at this very spot was where technical analysis of the car had taken place. This is a part of the investigation, so this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station. But parallelly, when you speak of the blood samples, crime branch is looking at that case. Details in this very case emerge, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. Through that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom the father of the accused had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out who that middleman actually is.
Welcome back. As promised, let's get that conversation going with Brigade Enterprises. Pre-sales for the company zoomed 46% sequentially, came in close to 2,150 crore rupees. Volumes jumped by about 58% as well. Realizations, however, now that was the only sort of, you could say, maybe a bit of a dampener in the numbers because they were down about 8%. Pavitra Shankar, MD of Brigade Enterprises, is with us. Pavitra, morning. Great to have you on the show as always. So looking very, very strong to round off the year. Just tell us a little more about the quarterly trends and also this dip in pricing. How should we read into it? I mean, is this some sort of a top or what sort of led to it?
I'll address that first very quickly. So the realization that we shared for the quarter is reflecting the product that we sold this quarter. This quarter, we launched a plotted project in Bangalore, pretty much sold out the entire phase in the same quarter itself. So that is why you see a slight dip in the realization only for this quarter. But if I look at it quarter on quarter, in terms of the previous year, Q4 FY23 to Q4 FY24, the overall realization has grown more than 30%. And in the annual year realization, it's a growth of 23%. So it was really just a quarter, effect because of the product that actually got launched and sold in Q4.
Okay. Fair enough. So it's more of a product mix issue. Just talk about the Q4 pre-sales. How much of it was from new launches and how much from existing ones? And just give us a sense of the inventory levels as well now.
Yeah, so our Q4, similar to FY23 and FY24 as well, a lot of our launches got sort of back-ended into the last couple of quarters and specifically Q4. So overall for the year and as well as for the quarter, about 50% of our numbers came from new launches. And I think that's just something we've been seeing across our portfolio and maybe across industry as well. A lot of the launches tend to come towards the second half of the year. But overall, we're seeing a really strong demand from customers. We see that continuing. We do have a very strong pipeline for the coming year as well. We have some launches coming up in Q1 itself that RERA's come in and we're working on that right now. So we are seeing very strong demand from customers, even in terms of acceptance of the pricing of the product, not just in terms of projects that have already been launched, we're able to take up pricing there. But in terms of the product that also Brigade is going to launch over the coming year, there is some much higher end product and therefore we intend to see the increase in average price realization as well for the year.
Okay, so since you were mentioning yearly trends, let me just sort of get there. You ended the previous fiscal at a sales volume of about 7.3 million square feet. Sales value was up 49% and your realizations anyway improved even in FY24. There's a big jump in realizations and now you're saying that more premium launches perhaps will improve that. So some numbers, maybe some guidance on any of these counts, sales value, realizations and overall volumes that you're hoping to do this year?
So I'll just give you an indication of maybe the new launches that we're coming up with, the average price realization for those on average as a total product should be around 10,000 rupees a square foot on average. Currently, we're showing around 8,200 for the portfolio. So that's where we see the pricing levels, they should increase. But naturally, the numbers that come in every quarter will depend on the inventory that has moved in that quarter. But when we're looking out in terms of the new projects that are launching, we're seeing at an average of 10,000 rupees a square foot. This is driven by the upcoming launches that we have in Bangalore, Chennai and Hyderabad, where we have 3 marquee projects coming up where each of them will be launched at 10,000 rupees plus. And in Chennai, possibly 20,000 rupees or more.
Okay. So in terms of expansion plans, what are we looking at over the next, say, 1 to 2 years? What are the various partnerships that you have perhaps signed or are all set to sign? And where do you see the scope geographically as well?
So, we've always been communicating our focus on the South Indian markets. We're going to continue doing that. A lot of our new acquisitions in land bank are in Bangalore, Chennai, Hyderabad, a little bit in Mysore. We are going to reiterate our focus on these markets. We can get into them not just from residential, but also office, retail and hospitality as well. So we like these 3 markets because they're very strong from an economic perspective as well. We know there's a lot of chatter about other markets, but this is our strategy and what we'll be focusing on. on. In terms of partnerships, we're looking at both JD, so joint development, as well as outright purchases for our land banking strategy. Approximately, give or take, we're around 50-50 between both of them. Currently, in terms of other equity level partnerships, we have one partnership with GIC, but looking out, we are fully and well capitalized to continue doing things on our own, but always open in case terms work out with any private equity or any other partners in case we're looking for growth on that front.
Okay, and in the retail portfolio, I want to understand, in the office rentals rather, what is the kind of exit rental that you did in FY24 and what is the scope of growth in FY25?
So for our leased portfolio, which includes office retail and the revenues that we did was around 940 crores. And we expect to see that maybe on an exit rental basis of around 1,050 crores, but that would require lease up of some additional space and some of that rental to come into the cash flow stream as well. So we're looking at something like an FY26 exit rental of and stabilized rental of around 1,050 crores.
Pavitra, just to go back to the, the housing segment, I believe you had put out a guidance of doing 10 million square feet by FY27. But looking at the launches, the whole pipeline and the buoyancy in the market, could you achieve that earlier? What's the expectation for FY25?
So we're working towards that. Look, it's heavily dependent on launches coming into the pipeline. If that happens, I think current market conditions definitely support, getting to that 10 million number sooner than we had originally indicated. It is dependent on when we get these launches coming in. But once that does happen, we are quite confident that we'll be able to move the inventory, but also at a pricing that makes sense for us so that we're not simply, selling to get to some kind of number, but it makes sense from a project profitability standpoint as well. So hopefully sooner than FY27, but a lot of things need to fall into place for that. But we do have the projects and the land bank for us to get there.
Okay, and just on pricing, because you mentioned that some of the new launches that you're doing are over 10,000 rupees a square foot. So blended level, again for the year as a whole, last year you ended close to 8,000, just under 8,000. So overall blended pricing, what should we expect? 9,000 for this year? I mean, everything put together?
Yeah, I think it will heavily depend on how much inventory is being moved from the high price launches. So again, I think we will be aiming north of 9,000, but we'll have to see how that works out in terms of when the launches come in and which quarter they start hitting. But even in Bangalore, where predominantly the market was maybe, like a 6,000 to 8,000 rupees square foot kind of market, it has dramatically increased. And maybe across all our projects, we're able to launch at least 2,000 rupees more than that. So I think overall, we can push for a quarter-on-quarter above 9,000, but it will heavily depend on that inventory mix that gets transacted in each quarter.
Okay, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here. Well, with that, it is curtains down on this edition of Bazaar from the entire team. Thanks a lot for watching. The Nifty is down about 100 odd points, but the Bank Nifty is the one that's supporting the most this morning. Chart Busters coming up in just a bit.
ಮೊದಲನೇದಾಗಿ ನನ್ನ ತಂದೆ ತಾಯಿಗೆ, ತಾತಂಗೆ ಹಾಗೂ ನನ್ನ ಕುಮಾರನಿಗೆ ಮತ್ತು ನಾಡಿನ ಜನತೆಗೆ
that is coming back, is going to cooperate with the law enforcement agency. That's a way forward. Everybody should respect the law of the land, and by complying with the law of the land, the truth will come out. Who created the video, who distributed the video, all these truths should come out.
Imami surges on a strong fourth quarter performance and extended winter aids sales while margins expand by 270 basis points at the gross level. Brokerage Jefferies issues a buy call with a target price of 630 rupees, citing improving outlook and attractive valuations. IRB Infra slumps over 7% after 4% equity worth nearly 2,000 crores changes hands. Likely promoters have been the sellers, whereas KFin Technologies also corrects in trade after over 6% equity changes hands at 720 rupees per share.
Lemon Tree Hotels gains after posting strong set of numbers in the fourth quarter. EBITDA rises 22%, although margins slightly lower in the fourth quarter.
Edelweiss Financial corrects over 12% after the RBI imposes curbs on two of its arms over supervisory concerns. Edelweiss ARC and Edelweiss Finance clarified that the measures will not have any material impact on the business.
Alchem Laboratories slumps on weak fourth quarter numbers. The brokerage Jefferies, Macquarie and BofA all issue underperformed ratings on the stock. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangla Malu. Well, it's that sort of a day, right? Getting into a big weekend where you'll get cues coming out of the exit polls. You'll have the OPEC meeting and you'll have inflation data from the United States as well. Ahead of that big weekend, it seems some lightening of positions is taking place. Explains why the markets are now virtually at the low point of the day. The good news, though, is that the Nifty Bank, that's holding one end up, still up, closer around 200 points odd. Mangla.
Nigel, Nifty Bank is holding up. The second half will be extremely crucial to watch out for. With this 125-point decline that we've seen, we've all but eroded the little gains that we had seen for May series itself. Going into today's trading session, the Nifty was up around 134 points for the May series, now down 126 points in today's trading session. But, just this move does not capture the entire volatility that we saw in the May series.
Well, that's right. And just keep an eye on the bottom of the screen. Positioning was such, getting into Cummins numbers. There was delivery-based buying, there was long build-up as well. But now the commentary is not matching those numbers. The margins came in at 23%. The street liked it very, very much. But the management is saying that exports did not grow in any market in FY24. And they're saying there are signs of weakness even in the time to come with regard to their exports. So that's a bit of a problem pocket. And if I got that right, there was a bit of a one-off that took place in the past quarter, which explains why the margins went to around 23%. So the numbers still better than expected, but this commentary is not very, very great. And that explains why the stock is now at the low point of the day, Mangla.
Absolutely, Nigel. So that's about Cummins. But just keep an eye out on a new listing now. We have Office, that is the stock that listed the workspace solutions provider, made its debut on D Street, listing with gains of about 13% to its issue price of 383 rupees. Thereafter saw some extended buying, so now around 17% higher from its issue price. Amit Ramani, the chairman and managing director of the company, now joins us from the exchanges. Amit, congratulations. It's a big day for you and your team. We remember speaking with you here in our studio on the day of the issue open, and we asked you to give us more numbers once you start listing. You explained us the business, you explained the growth vectors of the company. Now let's drill it down to basics and talk about numbers. Your EBITDA has been growing. When do you turn bottom line profitable? Does it happen in this financial year or next financial year?
So Nigel, clearly I think we are headed in that direction, right? I spoke last time also that the profit on absolute basis is negative 18 crores, right, for the December quarter. And for the full year of 9 months. So I think we are headed in the direction. We are going to be coming out with our results in the next couple of weeks. So wait till now. I think there is, positivity, at least from our standpoint. We look forward to, presenting our first results.
All right, but give us, Amit, first of all, congratulations on listing on a day when the markets are under pressure. You have your stock that's up close to around 10-15%. So the start is good, but now you need to build on from there, right, in cricketing parlance. Tell us about revenue growth.
Absolutely.
You have grown at a phenomenal pace. Give us a rough number at least. Yes, we know you're going to come out with your published numbers, but what do you aspire to grow at in the coming years?
So, clearly, I think the historic numbers, as I mentioned, 75% CAGR, we look forward to obviously keeping the momentum going. The FY24 numbers should be along the similar growth journey. You've seen the 9-month number. It's at about 617 crores. We ended FY23 at about 545. So directionally, we are, maintaining the CAGR that we are looking at. Going forward also, I think the growth will be a key part of our strategy, but I think we have to balance it with profitability as well, which we are, looking to obviously achieve in the near future. But clearly, we will balance growth with profitability.
All right, balance growth with profitability. But last time you joined us, you said that, the money that you're raising for the IPO, you will be setting up 12 centers as well. By when do these 12 centers hit your overall books, and what is the incremental revenue that you will get from here?
Yeah, so we will do 45 centers this year, about 32,000 seats. Good news is a lot of those centers are already under fit out and will go live. Actually, as of March, many of those centers are live out of that 45. So we should see a large amount of growth coming from the new centers that are going to go live, already actually have gone live and will go live in the next, 3 to 4 months.
All right, Amit, how often do your rentals get revised upwards in your business?
So the rental basically is after 3 years. Every 3 years, there's about a 15% hike. That is only where there are rental properties. In cases where there's in our managed aggregation model, where there's a minimum guarantee, in some cases it does after 3 years. In many cases, it continues the same, because technically we would love for our landlord partners to make a higher number through the profit sharing.
All right. And what is the split of the leased out space in Tier 1, Tier 2 and Metro? Where are you focusing on now going forward? Is the increase in Metros Tier 2s or Tier 1s?
So 90-10 split, 90% is Tier 1 cities, which are the 9 Tier 1 cities, and about 10% is out of the 7 Tier 2 cities that we have. We will open new centers in Guwahati, Lucknow and Vijayawada, which obviously will bring us to total of about 19 total cities. The split will almost remain similar, because the large amount of opportunity we see is in Tier 1 cities. So the split will be similar to what we have today, around 90-10.
Right. And what about occupancy? You said that, your older spaces are 83% occupied. What proportion of your current portfolio is sub 65%? Because it's sub 65% where you don't make a profit. It's EBITDA break even only after 65%.
No, so the blended occupancy is currently 71%. The case of straight lease, we make at 60-65% occupancy. But in case of managed aggregation, where there is a minimum guarantee, we make between 40 to 45% occupancy. Where there is no minimum guarantee, which is actually 50% of the managed aggregation portfolio, we make money at 25% occupancy. So hence, overall occupancy portfolio-wise, I think it just depends on the center. But in a managed aggregation, no MG 25, with MG 40-45, and where it's a straight lease at 60-65% occupancy.
No, what we're trying to get at is what proportion of your portfolio right now is EBITDA negative, and when does that break even?
So see, that's a matter of, building up the occupancy. It takes us about anywhere between 6 to 7 months to get to 80% occupancy across the board. That's how we did it in all centers that we had launched in FY22. Across the portfolio, I would say probably less than probably 15% of the centers which are younger than 6 months probably are, at a lower occupancy. But as I mentioned, in the model where there is no MG, right? For the first 5 to 13 months, there is no MG. At 25% occupancy, we start making money. So about 10% of the portfolio will be below that 25%.
All right, first 9 months of this year, 19 crore loss. You said that you will be reporting your numbers. So let's see whether the street sees you in the black for FY24, or maybe that would be for the next financial year. But a good day for you and a momentous one. Thank you so much for joining in. Looking forward to speaking with you after your numbers as well. All right, with that, let's move on. Let's take note of the market itself. Not moved much from where we started the show. The Nifty Bank still holding up with a gain of about 0.5%. But a couple of stocks are doing extremely well. And, they've surged as we speak. Imami, for instance, was doing well all through today and now has continued its move higher. Bata is the other one that stands out. The results were slightly on the softer side, and that's something that the street was anticipating as well. So maybe the commentary of improvement going forward has the street excited about prospects and the underperformance of the stock itself. The stock is down 12% this year itself, and from its 52-week high to it's corrected about 20-21%. So with brightening prospects going forward, is the street looking ahead for Bata or not? Well, that's for time to tell you, but as of now there's been a recovery from the lows. Z is the other one which too has recovered about 3.5% from the lows at the high point of trade, and the one that has been moving all through this week, Jubilant Foodworks, continues its march forward. Today's move is about 2%, making this entire week's move to about 12% odd. All right, we take a short break, come back, get you more on the markets and stock-specific action on the other side. Stay tuned.
Expect from this SIT, instead of this SIT should be monitored by a court. Court monitored SIT or CBI is the only way forward for us to get justice.
investing.
Welcome back. Well, the markets are under some pressure, but let's get to an exclusive then. Sources are telling CNBC-TV18 that the insurance regulator, IRDAI, has proposed a new framework to calculate surrender value for life insurers. Yash joins us to fill us in with more details. Yash?
Well, Nigel, it was only in the meeting which happened between the IRDAI chairperson and the life insurance CEOs, which took place in April 2024, where the conversation on increasing the special surrender value found its mention. In fact, CNBC-TV18 on April 30th had reported also that IRDAI's intention is to increase the special surrender value, essentially taking the total surrender value paid to policyholders by life insurance companies at a higher point. Now, in a fresh set of development, what we've been given to understand is that IRDAI has proposed a new framework around what it thinks special surrender value should be raised to, should be mandated at, and what should be the formula as far as this particular mechanism for calculating special surrender value is concerned. We are also told by our sources that life insurance companies are supposed to provide their feedback on this particular paper from IRDAI by May 31st, 2024, which is just tomorrow. Now, as far as the proposal of increasing surrender value is concerned, IRDAI in its paper has said that insurers will have to ensure that special surrender value is at least equal to or expected present value of paid up sum insured and paid up future benefits. Second point that it has said is that the rate of interest to calculate the expected present value of paid up sum assured shall not be more than the 10-year GSEC government security yield. Also, finally, it has said that special surrender value will be provided from the first policy year itself. Now, of course, these three seem to be very complicated just as you read these lines. But if you look at the calculation, and I'll take an example of a sum assured of about 1 lakh with a policy term of 10 years, policy bonus of 50,000 rupees and policy returns at the time of maturity to be about 1.5 lakh, which will have the bonus as well as the sum assured. Interest rate that I'll take for this example is about 7%, and I'm assuming that the policy is surrendered after payment of the first premium, that is the first year premium itself. The first element of special surrender value, the formula for which will be number of premiums paid by the sum assured received upon maturity into policy returns, which is 1 upon 10,000 into 1 lakh. That gives you about 10,000 rupees. Remember, there's a 5,000 rupees bonus also which the company or the insurer is giving, which means the present value of paid up sum assured will become about 15,000 rupees. Now, on this 15,000 rupees, one needs to calculate the discounting of the balance 9 years where the policyholder could not pay the premium. Now, according to the formula, if one does that, the special surrender value on a premium which has been about 10,000, which is paid by the policyholder, the special surrender value comes at about 8,196 rupees. This is as high as what was proposed in the December paper by the regulator, which spooked the life insurance companies. December proposal, which had come December 2023, that had proposed a surrender value of 8,300 rupees to be paid on a premium of 10,000 rupees, which is 83% of the premium received by the life insurance company. The March notification sort of mellowed it down, where the regulator said 3,000 to be paid on a 10,000 rupee premium, which is 30%. But again, this new framework which has come, it takes it back to those higher levels of December 2023, which is 8,196 rupees of special surrender value on a premium of 10,000 rupees, which is again 82%.
All right, Yash, thank you so much for that. This is something that we'll keep an eye out on. In fact, it is only tomorrow where we'll hear all these insurance companies will write to the regulator, and thereafter any sort of commentary coming in from them and the others as well. As of now, as we speak, alongside the markets, we are seeing some decline in all of these insurance stocks as well. Take a short break, come back. On the other side, we have the management of Rishab Instruments. Dinesh Musulekar, who's the group CEO, joins in to discuss the quarter gone by.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely
investing.
Welcome back. Well, Rishab Instruments, that's in focus on the back of its fourth quarter numbers. Revenues came in at the lower end of its FY24 guidance. Now, for FY25, we are bracing to see what exactly can they deliver. Mr. Dinesh, the group CEO, joins us on the show. Hi, sir. Good morning and good to see you, Ben. Well, give us a few details then. If you could tell us for FY25, what kind of revenue growth as well as margins can you guide? On the revenue growth, if you could give us a range.
Okay. Very good morning, Nigel, and nice to catch up with you again after the last quarter results. And if you look at our annualized results on the top line, we have delivered what we promised, about 20% top line growth, and the consolidated level for the whole group, we have delivered 21% growth. And on the bottom line, when it comes to EBITDA, we had one unit and particularly one sector was having problems, and that's why the margins were stressed. If you look at overall our business, so about close to 40% is aluminum die casting, about 61-62% is electronics business, where we have delivered EBITDA of 20 in excess of 20%. So 21-22% is our EBITDA for that segment. And on the aluminum die casting, we dropped from 15% to about 4%. That's from where we have got all of that. Aluminum die casting. Yeah.
Dinesh, so we have some of those numbers, and they're coming up for our viewers on the screen as well, as you tell us. But that's about the past year. As you said, the aluminum die casting business, there were problems, there were some pockets of weakness as well out there.
Yeah.
Now, going ahead from here on this sort of a base, what kind of a revenue growth can you do? And if things improve, then what kind of a margin improvement can we brace ourselves for as well?
Absolutely. I was coming to that. So going forward in this year, the top line growth for our electronics will remain in excess of 20%. Aluminum die casting, we are scaling it down from 20% to 10% so that we can focus more on profitability. So overall, I would say about 18 to 20% is close to that range is the top line revenue growth which we can expect this year, because we are riding on infrastructure which is coming up in India. India business is doing really good for electronics business. In Europe also have done extremely good last year, and that will continue to happen for electronics business. When it comes to die casting, we want to scale down some of those projects which are not so profitable for us because of old contracts that we have had, and we are negotiating these contracts with the customers, and we may let go some of the contracts which are not profitable. So the process is all that we need is a little bit of a time, and we will be getting back to overall consolidated EBITDA level of about 15%. 15 to 18% in the coming financial year. That's the guideline in which we are going ahead.
So 18 to 20% revenue growth with around 15 to 18% margins is what you are guiding for the entire year, right?
Absolutely.
All right. Let's talk about the future outlook for Lumil Alucast, because you said your die casting business, which had been under pressure, especially from the automotive industry, you were looking at price renegotiations, and you're looking to also, let go of some of the non-profitable contracts. What proportion of your portfolio are you looking at in terms of price renegotiations? If that does not happen, what's the kind of business that you're willing to let go of?
Yeah, see, our portfolio is about 45% of aluminum die casting is automotive, which we want to bring it down to about 25-30%. That's where we are going. And so out of overall business, we are talking about 20% of 40%. So it's about 12% is what we are letting go out. But that will be very well compensated by the growth that we are finding in electronics business. And we are focusing more on EMS business as well as solar. And so we have got, we added these two revenue streams in the last couple of years, which are going to get us much bigger growth perspective. So we'll be able to juggle around with all the different revenue streams that we have had. So on the top line, we are not really worried about. So all that we need to do is some action plan to get our profits up in aluminum casting, particularly automotive sector.
I remember you said that you are looking at closing 100 crore acquisition pretty soon as well. The target is in India, and the deal will close in FY24. Obviously, that did not happen in FY24. So FY25, something that we can hear is, are the talks still on?
See, what we did carry out our due diligence, and we have got CPs which we have identified, and we have asked the potential seller to go through them and complete those. It may take about 6 months. After that, we will relook at the whole situation again, and we may make a decision at that point of time based on the level of CPs completed as well as the financials then.
Right, and
so it's not off the table, but it's not confirmed yet.
And when you guide for 15 to 18% margins, I was just trying to figure out one thing, because gas prices peaked out at around 10% of sales. From there, we've seen a big reduction in gas prices. That is typically around 3% of your sales in good times. Where does it stand at right now? How much of a margin lever can lower gas prices be for you?
Yeah, gas prices have stabilized and going down. That's absolutely right. But at the same time, what has happened is electricity prices have gone up substantially in Europe, and also the big problem has been the inflation and high wage revisions which were forced by the government. So we had 2 wage revisions last year amounting to more than 20% of minimum wage increase. So that's been a bit of an issue. So it's generally the inflation and energy cost and labor which is driving these cost pressures at the moment. But what happens is, we have other electronics business in the same environment where we are able to transfer this to our clients, because we have our own brand and we have our own products, and so we are able to drive those very swiftly. And in fact, our Lumel SA electronics business from Poland has been the most profitable of all our big 3 companies that we have. So unfortunately, aluminum die casting is OEM type in nature, so very tight contracts with big automotive giants, and so it becomes really difficult and takes longer time and much higher efforts to renegotiate and change things in aluminum die casting, particularly with automotive. So we are working on that. It may take about 2 to 3 more quarters. So how I can see is this year, FY25. We still will continue to have prices on, pressure of margins on aluminum die casting. Otherwise, everything should be okay. And next year we will come back with the same guidelines which we are having in the previous years.
We'll hold you at these numbers, Dinesh. Appreciate you joining in. Wishing you all the best. Look forward to chatting up with you as the year progresses as well. Well, for the time being, we'll slip into a short break. We'll come back with news that the markets are trying to attempt to pull back, but that's getting sold into. Stay with us.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year, with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates
on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18, weeknights at 7 p.m.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated.
Good morning. Welcome to Trading Hour. It's a Thursday morning. I'm Reema Tendulkar. With me, Surbhi Upadhyay, and the caution, the nervousness ahead of the big day continues. Markets are down close to about 0.5% on the benchmark indices. The Nifty down for the 5th day in a row. And lots of sectors are weak today, Surbhi, whether it's metals, it's IT, FMCG. I think the only pocket of green today, surprisingly, is banks, right? Yeah. Banks were underperforming for the last 2 days. But today there is a bit of a reversal taking place. So the Nifty bank is up close to about 0.5%. The advanced decline ratio, though, continues to be fairly negative, 1:2 on that.
No, absolutely. I think, this the whole talk was whether the market can withstand the negative global cues. And because we are close to critical support levels, whether the dip will be bought. The dip was bought, but guess what? I mean, given the intensity of the events lined up, the exit polls, the final outcome, there's still plenty of volatility and nervousness. So a lot of stocks facing pressure, actually. Just to pull up the Nifty contribution chart today, it's not about just 3 or 4 big Nifty stocks pulling the index down. It's a pretty broad-based sell-off, you'd have to say. Tata Steel, of course, after numbers is down about 4%. Lots of other names: Nestle, Shriram Finance, Titan, Power Grid. A lot of the financials, anyway, non-bank financials are quite weak. I mentioned Shriram Finance, even something like a Bajaj Finserv, Bajaj Finance, SBI Life. A lot of the non-banking financial stocks are weak. So overall, it's a bit of a tough morning that we're dealing with. On banks, barring this 0.5% sort of increase, it's not enough, and then we're not seeing a build-up on it. And I guess that remains the only sole pillar in the market, which is finding some traction on the upside. The mid-cap market, by the way, is very volatile. The mid-cap index was down almost 1%. Now it's trying to recover from that kind of a drop to about 0.5% cut. But still, the advanced decline ratio is extremely negative, so you have to take that on board. And, we've still got over 700 stocks advancing, but over 1,500 stocks on the declining side. In fact, we'll be speaking to a lot of the buzzing managements as well. I think Imami will be with us in the next couple of minutes, because that's one stock, despite a day like today where there's a lot of sentimental weakness. Imami, look at the stock, 12-13% higher. 15% higher now. Look at that. So let's not keep you waiting, and let's straight away dive into that conversation. Fourth quarter numbers have been looking good for the company, with a revenue growth of about 6.4%. Gross margin expansion is something that the market absolutely loves. 270 basis points is the kind of year-on-year increase in gross margins that Imami has managed to put up. To talk about the outlook, we have with us Mr. N.H. Bhansali, CEO of Finance, Strategy and Business Development, and the CFO of the company, to take some questions. Mr. Bhansali, thank you so much for joining in. So you can see, I think, the market's thumping reaction on the screen. So let's talk about the margin expansion, actually. Growth in a bit, but first on margins. What sort of led to this kind of a 270 basis points increase? Because this is despite the fact that I think you're spending more on advertising. And what's the trajectory for margins going forward in terms of costs and the other pressures that you're looking at?
Yeah, the margins have improved, gross margins have improved substantially, and it is in line with our expectation. In fact, compared to the previous years, the costs had been benign, and we believe that these costs are going to remain there. And there could be slight improvement from further from here, but overall on a broadly on the gross margin level, it may remain at this level for the times to come as well. Because these had increased substantially in the previous period. And now it is in the last year and in the current year also, it has been reduced and is almost on a nominal level.
So are you saying that this 26% kind of a band, because you ended the year at 26.5%, are you saying that this is sustainable despite the rise in, ad spends?
Yeah, very much. If you look at our history of all these years, we had always been around this range, even in the pre-COVID levels. So these would remain. And while we keep on investing in the brands and also on the strategic investments and other companies, taking together all this, we believe that we would be nearer to this range itself.
Okay, so maintaining margins broadly is what you're expecting, right? So can you talk about the top line growth? What can we expect in FY25? Can you hit double digit considering the summer season is looking good? There is some recovery seen in the rural markets. In FY25, do you think your top line can hit double digit growth?
Yes, we hope so, and we are building our business and all our steps towards that. We expect a kind of a double-digit growth, and rural has also started picking up. In fact, this quarter has witnessed a 6% growth in the rural as well. All the channels have fired, including the general trade, which was still there. It was a very lull since few quarters, but that has also there has been a slight growth even in the general trade. And the new age channels have done very well. Both the new age channels taken together have delivered more than 25% growth. So all channels firing up, all the businesses, market shares intact. We are putting
all except Kesh King. All your engines are fired except Kesh King, which has been under pressure, and you've alluded to competition over there. When do you expect a revival? Is there any guidance you can share on Kesh King?
Yeah, even in the Cash King, no, the market share has not declined. So it has more to do with some discretionary spends. And we believe that Cash King and the male grooming both would come back to its trajectory. And we are taking many steps there. But this being the discretionary items, so the growth comes later.
Mr. Bhansali, just on the summer products, Dermi Cool and Navratna Oil, considering we've had a blistering summer, right? Records being hit across the country. Should we expect, more than usual volume growth in Q1? How have these two products done? And also, what is the contribution of summer in your total mix right now? What's the split between winter and summer?
Yeah, so there are winter, summer, and also the around the year products. So broadly, the seasonal products contribute around 40% plus, 40-45% kind of sales comes from the seasonal products. And in terms of the growth from Dermicool also and Dermicool and the summer products, we expect a substantial growth, and we feel that the trajectory is very good, given that the summer has been very scorching and season is favorable. And also on the top of monsoon forecasts, which are also expected to be good, we expect good growth to come in.
So can you, what is good? How good is good? Some idea, actually, some guidance, overall volumes, what you're expecting overall across the portfolio this year?
Yeah, it's very difficult to say, but I can just tell you the exact number as to what has happened in the secondary sales for the quarter, for the March quarter itself for the Dermicool. We have had a secondary growth of 25%.
Oh. Okay. This is in the March quarter, and April's looking better, the April quarter, because that's when the summer really picked up.
April, May, the current trajectory seems to be good.
Okay.
So what's the current trajectory then on your D2C brands? Because they've done very well, scorching growth seen.
Yeah, so the D2C brands constitutes many more things. It's not only about the summer products. So there are many others, and there are digital products specifically catering to directly to the consumers from our Zandu Care platform, and it's also doing exceedingly well. And in terms
so what about Man Care and Brillare?
Yeah.
The Man company.
These are our two subsidiaries, and they have also done exceedingly well in the past financial year and the past quarter. And they are also on the high growth trajectory.
What's the absolute sales and EBITDA from the Man company and Brillare? And what can you guide for in terms of growth for these two subsidiaries in FY25?
So they both would continue around 5% of our overall sales.
Okay. And in FY24, they grew at 59%. What's the growth that you're targeting, given the base?
We again see, because there is a strong potential for this kind of brands, and these are D2C as well as they are also targeting very high-end consumers in the modern trade, high-end modern trade, and so we expect good growth, even double-digit, higher double-digit kind of a growth from these two.
Mr. Bhansali, you're sounding quite confident and fairly optimistic, and that's great to see. So give us some sense. The FMCG sector for the last sort of year or so has struggled with low single-digit volumes, right? But a lot of your companies, peer companies as well, are talking about things picking up. So for FY25 full year, volume growth, even if you don't want to put a number, but at least some idea. I mean, will it be mid-single digits? Can it go to high single digits? What's the best sense?
So I would give a sense as to we expect kind of a 2 to 3% kind of a price growth. Rest would be led by volume.
So 2 to 3% price growth, but the volume itself is what I'm trying to understand. You grew 2% volume in FY24.
Right. We are targeting double digit.
Okay. So you're targeting double-digit top-line growth with 2 to 3% price growth, and the rest will be volume-driven, correct?
Yeah.
Okay, I think that tells us a fair bit.
What about the international markets? Are we expecting a double-digit revenue growth for the international business too?
Yeah, for the last year, no. There has been a lot of volatility. If you look at for the full financial year, constant currency growth had been at 12% for the full financial year and 9% for the quarter. Despite challenges in Southeast Asia and also in the CIS, Russia, Ukraine also. We expect the same kind of a growth to come in the current fiscal as well, FY25 as well.
Okay. And just two more questions. One, is there a number that you have in mind for ad spends in FY25? They constituted about 20% of your overall revenues. In Q4, what's the run rate on ad spends in FY25? And secondly, on promoter pledge, do you have plans to bring it down in this year?
So first, on the media spends would remain in the level as it was in the previous fiscal year. And the pledge percentage has been very, very low currently. It's around 13% or so of the promoter's equity. So for the overall, it is still half of that. And it's very much highly in control, and there are no worries about that. And we do not have plans to further borrow against the pledge of shares. So we expect it's a good, very balanced kind of management.
Mr. Bhansali, final question. How much cash are you sitting on at the end of FY24? And what do you plan to do with it? What's the outlook on CapEx? Will you be looking at acquiring any more brands or maybe even companies? What's the plan for this year?
Yeah, we have a net cash of over 300 crore, around 350 crore or so, and yearly EBITDA of 900 crore, 900 to 1,000 crore around so of an EBITDA. And we are always on the lookout for acquisitions as well as the strategic investments, and we keep on looking at the right opportunities which has a synergetic benefit and as a potential to grow. So always on the lookout, and this money besides dividends would be also spent for those strategic investments and acquisitions.
And anything specific on the radar, and in which category would you be looking a little more aggressively in terms of acquisitions?
Will be very meaningful rather than be aggressive. So pricing is a function of how does it make sense for us. And we are looking at acquisitions or strategic investments wherever we are already present. So kind of personal care and healthcare, more towards D2C kind of companies, and where we feel that the potential for growth is high and with an eye on the path to profitability.
Mr. Bhansali, we leave the conversation here. Thank you very much for joining in. That's Imami targeting a double-digit revenue growth in FY25, which will be driven by 2 to 3% pricing growth, and the balance will be volume growth. International markets too to do pretty well and margins should be stable. Get into a break. On the other side, we'll invite the management of EPL SL Propack. This is a company which manufactures tubes which are used by the FMCG companies like beauty companies, cosmetics, as well as toothpaste. Anand Kripalu will join in on the other side.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 120.
Welcome back. As promised, let's invite the management of EPL. This is a tube packaging company that provides packaging for oral care, beauty, cosmetics, pharma, health and food, and nutrition and home care. Now, they reported a good set of Q4 numbers. The revenue growth was up close to about 6%. Margins have expanded, though the profit has declined due to an exceptional item and a one-off tax refund. To talk about the way forward, we have with us the MD and Global CEO, Anand Kripalu. Anand, morning, and thank you very much for joining in. This is Rima here. First, if you could just break up your Q4 top-line growth of 6.2% in terms of volumes and even in terms of realizations. And secondly, for FY25, how is demand? What can you guide? Do you think you will be able to hit a double-digit revenue run rate?
Well, Rima, thank you for having me, and very good morning to all your viewers. Well, the thing is, we don't share volume numbers in this business because it is not a reflection of our strategy. In this business, you have huge differences in the cost per tube, depending on the dia of the tube, small dia tubes versus large dia tubes. Big differences depending on the categories, so beauty and cosmetics versus oral, and very different revenue per tube when you look at it in different regions of the world. What I can tell you, though, is that the 6.2% revenue growth that we've declared has some negative pricing in it because of the softening commodities compared to the base. And therefore, if I were to give you an indication, it is that the revenue growth is less than a simple aggregation of the volumes of our tubes, even though I must hasten to add that it isn't the right measure of our strategy and our performance at all. Now, as far as the outlook is concerned, I'm actually very confident about the business, both in terms of demand, therefore revenue, and our ability to continue to improve margins. Now, we have given an outlook of double-digit growth with 20% margin in the foreseeable future. Right? So I'm not going to comment right now whether it's going to happen next quarter or later in this fiscal. But what I can tell you is that we're seeing good demand, right, from all sectors, and actually in most geographies, we're seeing good demand. In Q4, our demand was actually better than the previous 3 quarters of last year. So actually, we're entering fiscal 25 with momentum. So both on revenue and our ability to continue to grow EBITDA, because we have delivered 6 quarters of sequential, solid double-digit EBITDA growth, right? And I'm confident that we will continue to grow EBITDA, right? And continue to grow margins. So that's our perspective.
Mr. Kripalu, good morning. Great to have you on the show, sir. So you mentioned that the 6% revenue growth, that involves an element of a price decrease as well, right? So this was a fourth quarter phenomena, I guess. What is the trend that you're seeing now in Q1, and what's the general outlook on pricing?
So as you are aware, our input commodities actually went completely haywire for almost 2 years, okay, post-COVID. That, coupled with disruption in global supply chains, put huge cost pressure on our business. In our business, the price increases tends to lag the cost increases, and therefore we saw a hit on margins in previous years. What's happened since then is that commodities have softened and started tempering, though I have to say there is a slight uptick on commodities in the most recent months. So what we're doing now is we are lapping lower cost commodities and therefore lower pricing from customers, because many of our customers are contracted and there's a pass-through with a delay of about 3 to 4 months, a pass-through. So when the commodities go up, the prices go up, and when they go down, the prices go down. And therefore we're comparing it with quarters in the past where the input costs and therefore the price per tube was higher. Having said all of this, as you can see, it has not impacted our margins. We have continued to recover margins and improve margins. And I think that just reflects the resilience of our business model and the relationship we have with our customers.
Okay, fair enough. You're also focusing on the sustainability proposition with recyclable tubes. And the contribution of that has been steadily going up. It was about 10% in FY23. It rose to 21% in FY24. And I remember somewhere you had said that it's going to grow 3x. So talk to us about this recyclable tubes. Are we likely to hit a 60% revenue contribution? If yes, by when? And how are the margins on this?
Yeah, so I think first and foremost, I want to say that our stated ambition is to be the most sustainable packaging company in the world. Okay. And therefore, a lot of what we do in our company puts sustainability and the heart and soul of our operation. So it isn't just a line which looks good. It actually works deep down into the depths of our company. Now, customers, many of them, who are the FMCG companies, which you would know globally, have made declarations about their conversion to sustainable tubes. We, from our part, have done two things. One is we are more ready than anyone else to start supplying sustainable tubes, because it does require back-end modifications in the business, right? And in our factories. So we are more ready than anyone else. And second, to your point on pricing, we actually think that trying to charge a higher price or higher margin may be good for the short term, but not good for the long term of driving a sustainable world and growing market share with big customers who are critical to our long-term success. So we actually don't put any barriers and hurdles when customers want to convert. For us, our quest is to grow our volumes faster and to grow our wallet share with those customers faster. And finally, to your point, yes, we doubled the contribution of sustainable tubes from 10% to actually 21% last fiscal. And we're exiting even stronger than that. 3x is a number that we will ultimately achieve, but that's a marriage of both the customers and when they want to shift, right? And our ability to supply. On our part, we are absolutely ready. And as I said, one step ahead of customers demanding conversion. And we are beginning to see shifts in wallet share because we are more ready than other players. So customers are coming to us and saying, hey, can you supply? Because we want to convert. And
you
we're
said
saying,
the
yes,
exit.
of course, we're ready.
Okay. You said the exit contribution of sustainable tubes is much higher than 21%. What's the number? And at least for the near term, do you think this 21% could hit 30% revenue contribution by FY25?
I think it will definitely hit 30% or more. Okay, so we exited a little above the average of 21 for last year. And I think the average of FY25, we believe will be 30% or even a tad higher.
Okay. All right, sir. We will leave it on that note for today. Thank you very much for joining in, and I wish you good luck with the year and all the plans ahead. That is EPL at the end of Q4. By the way, you've been seeing a lot of interesting flashes from the RBI Annual Report on your screen as well. Some interesting notes. I mean, apart from the RBI talking about the health of the economy and what lies ahead in terms of GDP growth, their commentary on the heightened RBI action and the sort of the vigil is what the RBI is noting in its annual report itself, saying preemptive regulatory measures aimed at curbing excessive consumer lending and bank lending to NBFCs and investments in AIF expected to contain build-up of potential stress. So the RBI in its report is sort of explaining or perhaps taking note of its increased scrutiny of a lot of the regulated entities. We'll have more on this after the break with Ritu. And of course, we also talk about that. We also talk about the hit to Edelweiss. That was, of course, the latest casualty with the RBI's moves coming through. But before we hit that break, here's a quick programming reminder for our viewers. Join us live tomorrow, that's 31st of May, from 5:30 p.m. onwards for CNBC TV18's Future Female Forward, the Leadership Circle, a transformative platform where leaders from diverse fields will venture beyond the traditional discourse and share stories of grit and determination and the road less traveled. This Leadership Circle is not just about business strategies and professional accolades. It's about delving into the depths of the personal journeys of these trailblazers.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines. 25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. As promised, let's go and look at what all the RBI has been doing. The flashes on the annual report are on your screen. We'll talk about that with Ritu in just a bit. But Ritu, first, the big story from yesterday. I mean, now the sort of the action on Edelweiss, two entities, right? EPL Finance, as well as their asset reconstruction arm. So just tell us what's the latest.
Well, Surbhi, the regulator continues to take a very tough stance against non-compliance, and now it has imposed business restrictions on two Edelweiss Group companies, and that is EPL Finance, which is their SME financing NBFC arm, and Edelweiss ARC, which is the asset reconstruction arm, because, again, of material supervisory concerns. So RBI has asked EPL to immediately stop undertaking any structured transactions relating to its wholesale exposures, and also directed the ARC arm to immediately stop the acquisition acquisition of any financial assets. Now, RBI found that these entities engaged in structured transactions with the point of evergreening the stressed exposures of ECL using the ARC and connected AIFs to bypass regulations. Now, how were they bypassing regulations? Essentially, ECL Finance acted as a conduit for loans from non-lender group entities to be sold to the ARC, thereby circumventing rules which permit ARCs to only acquire assets from banks and financial institutions. In the case of Edelweiss ARC, for instance, RBI said it failed to place the FY22 supervisory letter before the board. It shared non-public client information with group entities and so on. In the case of ECL, there were KYC breaches, etc. And despite opportunities for remediation, RBI said these entities continue to find new ways to circumvent regulations, which prompted this action. However, RBI is going to review these restrictions once the companies are compliant. Both ECL Finance and Edelweiss ARC, interestingly, in their individual statements said that this action is not going to have any material impact on their business, with ECL Finance adding that it had discontinued the wholesale business in FY24 and that its wholesale exposure will continue to come down in the normal course of business.
While the financial impact may not be too much, the street is worried about the regulatory, the risk to the brand per se, and the stock is tanked close to about 15%. But Ritu, you were just going through the RBI annual report, and again, there is a lot of reference to the supervisory initiatives undertaken by RBI, the clampdowns that we've seen in the last couple of months on various entities. What have you picked up from the RBI annual report on that, and even on the frauds bit? Because that number looks pretty high. I think it's tripled the number of frauds last year versus the prior year.
That's right, Rima. It's a 300-page plus report and there's a wealth of information in there. But yes, on the supervisory measures that you were speaking about, again, you have the regulator highlighting that these measures that have been undertaken are preemptive. They're not waiting for the rot to happen. And the idea is to curb any excessive growth that may lead to some sort of financial instability. For instance, the investment in AIF circular or the increase in risk weights for consumer lending or the bank lending to NBFCs. They also say that all the recent events and these actions that they've undertaken, it underscores the importance of vigilant risk and assurance functions. Again, something that the Reserve Bank of India has been highlighting for a while. For banks, they say, yes, the balance sheets are strong, but they may have to address trading and banking book risks, especially in light of the moderating NIMs that we've been seeing, from all the banking results in the last couple of quarters. They also say that these supervisory initiatives are aimed at identifying risks and vulnerabilities early and to increase the focus on the root cause of these issues, which is why you're also now seeing very detailed press releases from RBI, not just restricting to a line or two like we used to see earlier, as to what the reasons for these actions are. On frauds, yes, in terms of the amount involved, there's actually a 46% plus decline in FY24 compared to the year before. But in terms of the number of frauds, of course, that has increased significantly. 36,075 frauds were reported in FY24 compared to just about 13,000 odd frauds in FY23. And the amount involved this year has come down, though, to 13,930 crores. Most of these frauds, in terms of volumes, are in digital payments, and in terms of value, they are, of course, in loan payments because the amount involved is higher. Private sector banks have reported the maximum number of frauds in the last 3 years, but of course, again, in terms of value, it is the public sector banks. Interesting to note, not all of these frauds occurred in FY24 itself. There's a very significant time lag in the reporting of frauds as well, something that the RBI has been trying to fix. In fact, nearly 90% of the frauds that you're seeing reported in FY24 actually happened in the years before. So that is just some of the highlights. We'll, of course, keep bringing you more updates through the day.
Okay, all right. That's a big report, Ritu. You have your hands full. Thank you very much for getting us some of the interesting highlights there. Well, with that, let's move on. Yeah, actually, the market's also slipping quite a bit. Should just take that on board. The Nifty Bank gradually, that gain is sort of petering off. And for the market, there's no let up in the selling pressure. Still 150, 160 points down on the Nifty day's low. Okay, let's focus on a couple of stocks. Speaking of lows, the reaction to Tata Steel has been very interesting. That stock is the biggest loser on the Nifty right now, down over 4% as we speak, despite the fact that on most parameters like EBITDA per ton, the numbers looked pretty okay. Let's bring in Nigel to understand what could be causing this and, what the sense is. Is it just the sentiment of the day, Nigel, or could there be more?
I would say this is a good set of numbers on a bad day. And that explains why the reaction is down, because you can't follow these numbers actually. You know, the top line is a little bit better. The EBITDA number is much better because of lower losses at Europe. And if you look at the segmental breakup as well, the India EBITDA per ton came in at more than 15,000 rupees, which is par for the course, or even a little bit better. Europe EBITDA per ton loss, I don't think anyone on the street was working with a number below that $75 per ton. So the number coming in at less than $40 per ton in terms of an EBITDA loss, that's heartening in fact. Let's run you through the data points. Yes, on a year-on-year basis, the India business, the EBITDA per ton did see some contraction. But the good news is in the coming quarter, it should see an expansion because input costs would cool off. So that's about the India business. On the European business, Netherlands in all probability should turn around. They are done with their realignment of the blast furnace 6. That was done in February itself. So for the coming couple of quarters, they'll have optimal utilization levels. So Netherlands had delivered a negative EBITDA number of around 2,000 rupees. That should turn around. And that should help the entire Europe business as well to turn around from around that $40 per ton, negative $40 per ton. The net debt number as well, it held at around 77,500 crores odd, which is par for the course when you incur a capex of close to around 4,500 crores. So whether it is the India business, European business, or the net debt number remaining stable as well, no worries with the numbers. What could be plaguing the stock then? The stock is up, at the 52-week high at the start of today's trading session. So that was the issue. The weak market sentiment could be weighing on the stock price, and that explains why the stock is under some pressure. And the results, well, they are better than estimates, but the street must be fearing how sustainable are they. And I'll speak to the management in just a bit and try to get some further clarity out there. And finally, yes, the debt has managed to remain constant at around 77,000 crores odd. But the problem is they have a big capex here in India. In European business, in fact, particularly the UK business, they're revamping their entire facility over there from blast furnace to AAF. So the debt number could remain elevated, which could be a fear as well. Numbers good, bad day, and maybe pre-positioning is weighing on the stock. Back to you.
Okay, well explained, Nigel. Thank you very much for that. Let's talk about Alchem Laboratories slumping in trade. Sudarshan joins in with the conference call takeaways. Sudarshan.
So today Alchem Lab is one of the top mid-cap losers, and it has erased all the gains that it saw in 2024. And more than earnings, it's reacting to the guidance that company gave in the con call that happened post-market yesterday. And after that, most brokerages have turned negative on the stock. Starting with JP Morgan, it has neutral call and it has cut target to 5,445 from 5,640. It said there was a big miss on revenue and even guidance appears lackluster. And in that process, it has reduced FY25-26 earnings estimates by 3 to 4%, and it believes tax rate will inch higher to 25% by FY27 from the current level of 13 to 15%. Even valuation it finds expensive at current levels. BofA Securities has an underperform rating and target is 4,130. It says FY25 guidance implies consensus earnings cut. Macquarie has an underperform call and it has a target of 4,500. It says there was an all-round miss in Q4 and even guidance for FY25 is muted. Jefferies too has an underperform rating and it has reduced target to 4,200 from 4,470 per share, and it has cut FY25-26 EPS estimates by 5 to 6% on subdued guidance for FY25.
Okay, all right, got that. Sudarshan, thank you very much. So Alchem under pressure as well. Let's take a break. When we come back, we'll talk about market technicals. Vishal Malkan will join in with some trading calls.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC.
Welcome back. Some slip seen in the Nifty Bank. The Nifty Bank was up nearly 0.5% when we started the show at 11 o'clock and now is just about holding on to the green line. The Nifty Bank is seeing profit booking as the day progresses. Vishal Malkan is now with us for a quick technical check on the markets. Vishal, 22,550 on the Nifty, 150 points down. Per se, compared to our all-time high levels of 23,100 that we hit last week, it's not that the markets have corrected, but there has been a downward drift in the last couple of days. What are the charts telling you, and what would your stock picks be?
I think the way we had a breakout last week, about 23,000, was quite convincing with the candle and the volume patterns, but it did not sustain for more than 2 days, and it came back below those levels, which we call as a false breakout. So we are back into that range of 22,000 and 22,800, which was there for last couple of months. So now the room is open for another 200 points on the downside. So I would be very specific about stock picking rather than being more on indices. And I would avoid more of breakout trading rather than look for support-based trading. And my stock pick for today would be Bata India, which has come out of that support levels after a long time. And it's looking good at with a stop loss of 1380 for targets of 1480 and 1500 in the next few trading sessions.
Okay, all right, Vishal, we'll leave it on that note for today. Thank you very much for joining in and giving us a couple of trading calls. We'll take a break, come back on the other side, and then we'll get chatting with the management of Lemon Tree Hotels, also a stock that's reacting very well and holding up very well in a weak market.
Weeknights at 7 p.m.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
The car. We are in fact here at Yerwara police station. There are 3 FIRs right now which have been registered in the Pune Porsche drunk driving case. One of the FIR is by the driver's family, who would allege it that that he was kept illegally confined inside the staff quarters at the family household. He was in fact he had also mentioned that he was kidnapped and was not allowed to speak to his family for a very
Welcome back. You're with us on Trading Hour, and And as promised, let's get into the corporate conversation with Lemon Tree now. The stock has been holding up very well in a weak market after reporting a good set of numbers for the fourth quarter. The company posted a near 30% growth in revenue. Profit rose over 40%, aided by a tax credit. EBITDA came in slightly lower. That's because of some of the investments they're making in renovation and scale-up of properties. To talk about the performance and the outlook, we have with us Mr. Patanjali Keswani, Chairman and Managing Director of Lemon Tree. Mr. Keswani, thank you very much for joining in. So great quarter. The market absolutely loves what you've delivered. Let's start with the sustainability of this, right? Because I think overall, your average room rates in the quarter gone by, they went up in double digits. Now, what are the trends like, and what's the expectation as we look at this season, which is pretty much the peak of the holiday season?
Okay, good morning. Well, seasonally, Q1 is one of the, it's the off-season because H1 in the hotel business is off-season. And while it's holiday season, it's still to come up. So looking at Q1, I would say that April and May were as per our expectations. May is seasonally weak, and this year, of course, with the heat waves and with the elections, it deflated the demand. But looking at the entire quarter, well, I think the ARR, the occupancy, everything is going to be better than the previous year. And I think it is extremely sustainable because there is now visibly a structural shift in demand, and I reckon it will continue for the next 3 to 4 years.
Could you share, sir, the occupancy levels in April and May so far?
Well, that's unpublished. So okay. I don't want to comment on it. All I say is that it is better than the previous year.
Fair enough.
In spite of the fact that May is not going to be, or May has not been, a high demand period because of the heat wave and the elections.
Okay, but it's still better than last year, despite all these adversity. Can you talk about your Aurika, the Mumbai property? What was the occupancy level there? And what's the expectation on that going ahead? And even for Q4, the occupancy ex of Aurika?
So ex Aurika was higher than what we reported. Aurika was less. But in
and
Q4,
what would that number be?
Right, Aurika was about 66%. Remember, it's a new hotel, and it is nearly 700 rooms. So I'm very happy actually with the performance of Aurika in Q4. And my expectation is that once it stabilizes fully, it will be 75 to 85% occupancy. So around 80%, which means we will do north of at least 500 rooms a day on an aggregate basis, definitely from H2 onwards.
Okay. Mr. Keswani, let's talk about overall, additions. What is the number of keys that you'll be adding this year? And these will be across what categories, if you could just break that up into the portfolio?
So we have, we've crossed, well, actually, we will complete our 20th year on 31st May. And at that point, we will have grown to over 10,000 rooms and over 100 hotels. So what I expect is by the end of this financial year, we will have, so there are two aspects to what we add. One is what we add in terms of signings, which may or may not open in the financial year, mostly don't. And then there is what are the hotels that we actually open. So my broad expectation is that we will open, anywhere from, because this is other people's hotels which we manage. So we'll open between 1,200 to 2,000 rooms this year. Another, I would reckon 20 hotels at least. And we will add another 2,000 to 3,000 rooms to our pipeline. So aggregating, we will have 11,000 to 12,000 operating rooms and another 4,000 to 5,000 rooms in our pipeline.
Okay, all right. That's a significant addition in overall sort of volumes coming through. So again, the second part of my question was to understand at what price points, I mean, are the bulk of these openings happening, and also the share of the the managed properties. What is that at right now? Mangalam tells us that the management fee was up 48% in in the quarter gone by. So if we talk about the year as a whole, what's going to be the share of managed properties and, what can we expect at the operating level, given the profile of properties that you'll be adding?
So if I look at Q4, we did our owned hotels. Income was about 330 crores. And managed hotels, if I remember right, was about 180 crores. So if you look at it from the network perspective, our revenue was about 5,000 crores. 500 crores, of which the owned was over 60%. Now, when I look at also the actual inventory rather than the revenue, we own about, out of these 10,000 plus rooms, we own nearly 60%. I think 58% is what we own. But going forward, we are going to add more and more managed hotels. So my broad guess is that managed to owned, managed will cross, obviously, its current level of 42%. It'll go closer to 50% by the end of this year. And in 3 years, I'm pretty sure that our managed inventory will be about 70% of our total inventory. And the price points, of course, vary. So it depends on which hotel opens where. The maximum openings are with Lemon Tree and a few with Lemon Tree Premier, a few Auricas. And in the franchise side, we will be opening a lot of Keys hotels.
And through all this, you expect your EBITDA margins to sustain above 50%?
Very definitely. In fact, as we grow, our fixed costs get distributed. So I'm reasonably sure EBITDA margins will start inching up. In fact, my expectation is that in the next 3 years, they will be north of 55%. The net EBITDA for the company.
Okay. So in 3 years, EBITDA margins will be 55% plus. You'd also said last time that Q4 will be the peak debt year. All your capex would have been completed and you will start debt reduction from Q1 of FY25. That's the June quarter. What's the debt number right now and how much of your debt will you repay in FY25?
So our debt currently, the peak debt is a little under 1,900 crores on a gross level. Net is a little less because obviously we have cash on our books. My expectation is we are going to spend a large amount of money this year in renovations. So between 200 to 300 crores will be our debt reduction this year. But the following year, it will be, maybe 400 crores and so on. So broadly, as I said, in 4 years, we expect to generate enough cash to pay off our debt and be debt-free. That is assuming that we do not list Fleur hotels. Because if we list Fleur and raise, primary capital, then obviously we could be debt-free earlier than that.
And do you have plans to do that? Is it on the anvils before FI? Yeah, go ahead.
So Fleur is our joint venture with a Dutch pension fund, where about 80% of our debt resides. So if the broad point I was making was that if we list Fleur as an asset company, an asset cum development company, then my best guess is that our debt will become zero in the year that we list it.
So, but when do you plan to do that? That's what I think Rima's question was, that sounds great from a debt reduction perspective, but this year, next year, where are the talks right now on this?
Well, this is still being discussed, so I don't want to give you a timeline. But I'm saying that this will certainly happen in the next 3 to 4 years. If it happens earlier, then obviously our debt will be zero earlier. But if it happens later, then at worst, we will be debt-free within 4 years.
So either way, FY28 is when you turn debt-free. Could be earlier, depending on if Fleur lists. But anyway, your timeline is...
It's nearly certain we will list Fleur before that. So yeah. I gave a worst-case scenario. But I would hope that if we list Fleur then earlier, then obviously we will be debt-free much earlier than what I have said.
Got it. Thank you for joining in. That's Lemon Tree for you. The stock is up 1.5%. Here's a quick note for all our viewers. A daily wrap of the top headlines will hit your inbox before you call it a night. With CNBC TV18's daily newsletter on LinkedIn, featuring the top 10 stories on markets, corporate updates, economic insights, financial highlights. So subscribe now and get the CNBC TV18 edge.
car is the car which was used to pick up the driver. Cops have now taken this vehicle into their custody. In fact, my Vijay Vasant will show you visuals of how there is a notice that has been put in the car as well. In this very car was where the driver was taken, following which he was kept illegally confined. Now, cops have taken this very vehicle. They've seized it and kept it in the custody at Yerwara police station. Along with that, the Porsche car also, in this case, has been kept just a few cars away from this vehicle. Yesterday, at this very spot was where technical analysis of the car had taken place. This is a part of the investigation, so this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station. But parallelly, when you speak of the blood samples, crime branch is looking at that case. Details in this very case emerged, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. Through that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom the father of the accused had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out.
Welcome back. The gap between the advances and declining stocks is only getting wider, which basically means more stocks are now trading in the red compared to what they were about 1 hour back. The Nifty Midcap Index is down nearly 1%, while the Small Cap Index is a cut of more than 1%. 1.1% now gone on the Nifty Small Cap Index. But let's get to the stocks which are, in the news today for a variety of reasons. One of them are multiple block deals which have taken place. Cummins, the numbers look good, but in the conference call, perhaps the management has sounded a note of caution because the stock is down close to about 5%. So let me get on Vivek and Vamakshi to talk about both these two. Vivek, but first to you on the block deals which have impacted the stock prices today.
Well, that's right. Another day and a long list of block deals even in today's trading session. So today, there are 3 large block deals. The first one that we're tracking is KFin Technologies. Over here, almost 6% of equity changed hands. The seller was General Atlantic Singapore Fund. There's a lock-in of 60 days post today's transaction. But even after this particular block deal, they will continue to hold a little over 31% stake in the company, and that may continue to remain as an overhang of the stock down over 6% in the session today. The other stock on the radar, RR Cable, not so bad given the fact that of the 5% equity that changed hands today, the seller was TPG Asia Fund. Now, this was a clean out trade as far as TPG Asia was concerned, and IFL Sec, that was the broker who conducted both of these particular block deals. So as far as RR Cable is concerned, this particular overhang is done because it's a complete sellout from TPG Asia. But the third stock on the radar is IRB Infra. Over here, it's the promoter entity. So 2 promoter entities have sold close to 4% stake in IRB Infra. IRB Holding Private Limited and Dipali Virendra Mayaskar, both of them together have sold close to 4% in today's block deal. There's a lockup of 180 days on further sale of shares post today's block deal. And important to know that IRB Holding at the end of the March quarter held a little over 33%. That will now drop to 31%. So 3 large block deals today, RR Cable being the clean out trade amongst the 3.
Okay, thank you very much for that. And let's now talk about Cummins, a stock which is down 5.5% in trade. Vamakshi, numbers look good, but what is it that the management said in the conference call, which was taking place right now about an hour back, that it spooked the street?
Well, absolutely. There's no doubt that the company has posted a good set of numbers. Revenue has come in 6% higher than estimates. EBITDA is nearly 41% and net profit is nearly 58% higher than what we were expecting. The net margins have also surprised positively, but it is now important to now focus on the con call takeaways as compared to the numbers. The company said that they are expecting double-digit growth in FY25. On transition to CBCP4, they said that 1/3 of their sales in the 4th quarter came in from these new products. They're seeing very good traction out here, but they do not see the impact of pre-buying, which was working out well for them in terms of volumes playing out going forward. There will be some turbulence as the new reforms come in, is what the company has said, but they do not expect a significant impact. On margins, they did see a one-time advantage of nearly 60 crores this time around. Profitability was also better due to a better mix as well as better cost efficiencies, but the gross margins will continue to hold at FY24 levels, but maintaining them, the company said, could be a challenge, and that is mainly on account of higher metal prices. They aspire to improve margin with the introduction of the new CBCB4 products, but that will be a factor that they will be watching out for, considering how competition plays out in the market will be only known in the month of September or October. As far as demand is concerned, data centers, infra-related growth, investments in power gen continues, and they see reasonably strong demand across all segments. In fact, data center contribution to top line is expected to be over 10% going forward. On exports, they say that Europe is at an all-time low. Africa is struggling due to currency issues. The demand may remain weak until one more quarter is what they anticipate, and they believe that this is not the bottom of the exports, and in fact there could be a small correction before exports actually recover. The percentage of exports contribution is expected to remain stable in FY25, and they expect to revert back to the 30 to 35% contribution from exports beyond FY25. So overall, yes, a good set of numbers from Cummins, but the commentary on exports spooking the streets.
Okay, perhaps that explains the fall that we've seen. Thank you for highlighting that. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching. He is.
ಮೊದಲನೇದಾಗಿ ನನ್ನ ತಂದೆ ತಾಯಿಗೆ ತಾತನಿಗೆ ಹಾಗೂ ನನ್ನ ಕುಮಾರನಿಗೆ ಮತ್ತು ನಾಡಿನ ಜನತೆಗೆ
that is coming back, is going to cooperate with the law enforcement agency. That's a way forward. Everybody should respect the law of the land, and by complying with the team.
Stocks trade soft with declines far outstripping advances following weak global cues. Consumer durables and metals are the big losers, even as financials and capital goods buck the trend.
Tata Steel turns in a healthy performance with in-line revenues and higher margins even as it holds the line on the debt, but the stock slips on profit-taking after a recent run-up that we've seen.
S&P revises its rating outlook on 6 banks to positive from stable on the back of a revision in India's rating outlook. It also revises up its standalone credit profile for ICICI Bank and Axis Bank by a notch each. The revision boosts sentiment.
Hero MotoCorp's 41% owned financial services associate Hero FinCorp eyes a fresh issue of nearly 4,000 crores and offer for sale via an IPO. The move gives the stock a fillip.
And in its annual report, RBI observes that the outlook for India in FY25 is brightening even as geopolitics, commodity prices and the weather are key risks. Inflation is also expected to moderate.
Good afternoon. You're watching us here on Halftime Report. At the halfway mark, we have the Nifty Bank at the top of your screen, mildly in the green, but no such luck for the other indices. In fact, the Midcap index has it worst, down almost 0.9%, 500 points shaved off that index. The Sensex down 400 points and the Nifty down 145. I'm Mangalam Malu, with me Sonia. Sonia, we had seen a bit of a run-up, but from the top, we've seen a correction of almost 600 points. So maybe the street lightening positions ahead of the big events.
I think that's a good thing, right? I mean, it's always good to go with light positions ahead of the event, because if there is a positive outcome, then at least the market has that legroom to sort of move up. And there are some jitters definitely in the market. I mean, no two ways about that. So you're even at this point in time seeing a cut, not just in the Sensex and Nifty, but it's the broader market damage that is a bit disconcerting. Even in the broader markets, you have across the board, whether it's metals, whether it's banks, PSU banks, all coming in for profit taking. And it's not a healthy sign, but it's generally what happens ahead of the election outcome. But lots of stocks in focus, Mangalam, so let's get straight to it.
Let's get straight to it. We have the first corporate on the show. We have EMS joining in. Recently reported a good set of fourth quarter numbers with an over 41% jump in their EBITDA as well. We're joined by the founder of the company and the MD, Ashish Tomar. He joins in to give us the outlook for the year coming ahead. Give us complete details of your order book. I mean, what did you end FY24 at? What's the construction portion? What's the O&M portion? And what's the revenue visibility that you have with the kind of order book that you have?
Yeah, so our construction portion, let me check the numbers, please.
Yes, please.
Yeah. So the for standalone balance sheet, our construction portion was around 714.59 crores. And O&M contracts contributed around 2.15 crores. And some other manufacturing and stock transfer, etc., contributed to around 2.25 crores combined.
Okay. So what is the total? Sorry, what is the total order book now? What's the value?
Yeah. So the current order book that we have left unexecuted is around 1,625 odd crores, due to be completed in the next 2 to 3 years.
Okay, so 1,625 crores is the current order book that you will execute in the next 2 to 3 years. And what orders are you currently L1? Sure.
Yes, ma'am. This is the portion position on 31st of March 2024. And after that, we secured one L1 position in a contract costing around 148 crores. In Uttarakhand.
Okay. And Sonia was asking, what are the orders that you're currently L1 in? And what's your outlook for order wins in this year? What do you end this year with?
So currently we are L1 in 2 projects. One in Uttarakhand amounting 148 crores. And another in Vikas Nagar, also in Uttarakhand, of around 480 crores.
Okay, so those are the orders in which you're L1. Got it. This Uttarakhand and Meerut orders which you've won, what is the execution timeline, the recently won projects? When will it start to reflect in your books?
For Meerut, it is 18 months. And for Vikas Nagar in Uttarakhand, it is going to be around 3 years.
Okay. So, just putting all of this together, right? I mean, you're sitting on a base of around 800 crores of revenues in FY24. How much can you build on to this in FY25? What kind of a growth would it be? Double digits, high teens?
It all depends on the pace of the construction. But we hope to achieve and maintain the present trajectory. And we can't comment on the numbers right now.
All right. Present trajectory is what you can maintain, which is close to around 800 crores. You said that the order book that you have is close to around 1625 crores executable over the next 2 years. So that gives you an annual run rate of around 800 crores anyway. So which is why the question on what order wins are you expecting this year? Could you give us a sense of will you get orders worth 800 to about 1000 crores in this year? Because then that will give you visibility for the years after that.
Yeah, currently we have bid for orders worth around 4,000 crores. And considering our success ratio of around 10 to 20%, we hope to convert a fair amount of these into orders.
Okay, got that. So going forward, what is the kind of... Sorry, I didn't get that number. How much would you be converting?
10 to 15%, 20% is our success ratio.
Okay. Okay, got it. And your working capital cycle, I think the last time we checked, it was at 3 months, right? Where is it at currently?
Yes. Yeah, it remains the same, around 3 months.
Okay. Can you tell us, I just want to understand, you told us about your order book, your growth that you're expecting, but in terms of competitive intensity, has that gone up quite a bit? Is that putting pressure on your operational performance? Do you think you'd have to sacrifice margins as your orders keep kicking in?
No, we don't. I don't think we are going to have to sacrifice on margins, because we have managed to maintain the profitability ratio in similar to the last year, and the orders that we currently have in hand have been bid considering the same profit margin.
So EBITDA margins of 27.5% in the fourth quarter is what you've done. How much does that sustain in the next 1 year?
Yeah, it's going to remain in the same range.
So if I was to look at what you're saying, revenues at least you will do 800 crores next year. Margins would remain at around 27.5% for the next year. 27 to 28% would be a fair band to assess or assume?
No, revenue, what I was saying was that we are going to maintain the growth trajectory that we have shown on the year-on-year in the past 4-5 years. So it's safe to say that around 30 to 35% growth on the current revenue.
All right, 30 to 35% growth on the current revenue with margins around 27 to 28%. Would you need any fundraise for working capital or execution that you have? Could you give us a sense of your balance sheet right now?
Yeah, no need to raise any funds for the working capital. I think we have enough funds on our books.
Okay, we'll let you go on that note then. Thanks a lot for joining in and speaking to CNBC TV18. Let's slip into a quick break. On the other side, we'll be joined by B.S. Ajay Kumar, the Executive Chairman of Healthcare Global Enterprises, to discuss their Q4 numbers. Stay tuned.
The truth will come out. Who created the video, who distributed the video, all these truths should come out. But we can't expect from this SIT. Instead of this SIT should be monitored by a court. Court monitored SIT or CBI is the only way forward for us to get justice.
Welcome back to Halftime Report on CNBC TV18. Well, for now, the market is, it's the same actually. It's still down about 120 odd points. It hasn't moved. The needle hasn't moved much. It's just been ambling along the lines of about 0.5% lower. But there are, despite this market being lower, there are plenty of stocks that have been either closer to 52-week highs or at 52-week highs. Just want to name some of them. Imami is at a fresh 52-week high today. Of course, we've spoken about that stock ad nauseum, but it's the big mover today, so keep that in mind. Uno Minda is the other one. It's had a dream run actually in the auto ancillary space. Uno Minda fresh high today, up 30% this year already. So big moves coming in over there. Something like a Titagarh Rail. I mean, this whole railway space has been picking up so much pace ever since the government's focus on it. So Titagarh Rail is at a fresh 52-week high, but it's come in for a little bit of profit taking this afternoon. So keep that in mind. And, a couple of other names as well that stand out in terms of both price and volume action. That is KNR Construction is one, and Samvardhana Motherson as well is at a fresh 52-week high after a very solid set of numbers. But let's focus on Healthcare Global Enterprises. The operational improvement has continued for the company. In fact, margins are at the best level in the last 6 quarters. To discuss this and more, we have B.S. Ajay Kumar, who's the Executive Chairman of the company, who joins in now. Mr. Ajay Kumar, always good seeing you on the channel, and thank you for, joining in this afternoon. It's been a good quarter for your entire sector, but for you particularly, the RPOBs have gone up about 8% year on year. Margins have improved. Just give us a sense of which way things are headed, right? In FY25, what kind of growth are you envisioning for the business?
I think we are expecting a significant growth, primarily because of the consolidation period is over. Now, as we know that places like Calcutta, Mumbai are beginning to ramp up significantly. And because of this and the fact the Kolkata center is broken even and growing quite well, so also is our Mumbai region, including our South Mumbai, which is growing well. All the centers which are mature and also new centers are ramping up. Because of that only, you are seeing significant improvement in the revenue as well as improvement in the margin. We are focused on margin quite a bit now, as we have said in the past, and that is beginning to show the results. Even our PAT has shown an improvement, and I think all of these are sustainable and we will grow significantly in the coming quarters, primarily because of the ramp up which is happening in our existing centers.
So if you could give us a sense of 3 numbers then, Mr. Ajay Kumar, the first one is what are the kind of margins that you're expecting in all of FY25? Because this quarter, the margins were the best that we've seen in the last 6 quarters. So what's sustainable? The second number is what is the RPOB that you're penciling in terms of growth for the next year? And the third one, of course, would be the occupancy. So occupancy, RPOB and margins for FY25.
Now, as we know, as far as the margin is concerned, I think the fact the mature centers already have a margin over 21%. I think our goal is to catch up with the 21% with the non-mature centers also ramping up, which are now at almost at 14%. So I think in the next 2 to 3 quarters, we will see upside of this margin. And my hope is that we will be reaching close to 20% margin towards the last part of the year. Regarding the RPOP, I do see a significant RPOP growing. One of the most important things we have seen, even the tier 2, tier 3 cities are showing good RPOP. The mature centers are RPOP of 42.5. Now the non-mature are catching up. Now there will be a growth of RPOP from 42 onwards. I think we see another 8 to 10% growth going forward. Regarding the occupancy is concerned, we are very happy with the occupancy of nearly 65%, and I think the occupancy is going to increase, and our expected occupancy will be somewhere closer to 70. But the most important thing to remember is more than bed occupancy in oncology, it is the footfall, because a lot of oncology is outpatient, and that is ramping up very well. That is shown by the fact we are installing more linear accelerators. We have today 36 linear accelerators in the country, and it is increasing. All of that shows a significant growth coming forward.
Okay, so that's on the business, which is picking up quite a bit, right?
Yes.
Okay. I also wanted to understand a little bit about what's happening with CVC Capital. CVC Capital currently holds about 60.4% stake, and I know we always ask you this question, but I have to ask you anyway. Any plans on them exiting? What's the future plan with CVC?
I think as far as we are concerned, our board is concerned, we have not had any offer come from anybody on the table at this point. As I always say, the best thing would be to ask the CBC to give an answer to that. So I will not be able to comment anything more on that. But if there is any news, obviously you will definitely hear it.
I'm sure you are in the know of things, right? So I just want to understand, is there any truth to this report that Temasek may be bidding for the stake?
No, I really cannot comment, I doubt, but I cannot comment.
You cannot comment on whether you know Temasek is bidding, or you have doubts on Temasek having bid?
I have doubts on that, but that's all. I would like to end it. Okay.
All right. So, okay, because something was brewing, and it's there in all the papers, every publication which tracks these deals, etc. If not Temasek, I'm sure there's never any smoke without fire. So, wanted to understand whether there were any conversations that were underway, not necessarily Temasek, but someone else as well.
I have not had any contact with Temasek.
Okay. And others?
As I said, I don't want to comment. As far as our board is concerned, we have not had anything in terms of offer and no indication. And I am sure if you approach CBC, they can also clarify on this.
Okay, we'll try and get some details from them. But I'm sure if and when anything happens, we'll be the first to know. I hope so. So getting back to the business, sorry, you had a question?
No, I just wanted to know that if there is an exit, if at all, and I'm sure at some point there would be, it's not a question of if but when, what would be the best course of action? Would it be a strategic investor or would it be a financial investor? Because if it goes to a financial investor, then, there's again this overhang of them exiting at some point.
No, you are right. And I think I will, as far as a founder I am concerned, I'm going to keep an open mind. And if and when that happens, certainly I will discuss. And of course, even in CNBC, I will certainly give my views on that at that time. But I will definitely keep an open mind.
Okay. Coming back to the business then, I guess, that's something that you can tell us a little more about. How did some of your key regions like Bengaluru, Kolkata, Mumbai perform in this quarter gone by? You have a 30% market share in Bengaluru, which is your home market, right? What kind of growth do you hope to see there, and what is the overall growth in these pockets?
See, Bengaluru, we are very honed in on Bengaluru. We want to be a dominant force in Bengaluru. That is our center of excellence, and it is growing significantly. But most important thing is we are also establishing a center in Whitefield and North Bengaluru. With this and the infusion centers we have in Bangalore, which we hope to be at least close to 38 to 40% of the market share in the coming years in Bangalore. That is our goal. As far as Mumbai is concerned, as you know, the two centers in Mumbai are doing very well. When you combine the two centers, they are really a center of excellence with high technology in South Mumbai, with CyberKnife and tomotherapy, as well as in Borivali high-end therapy with bone marrow transplant. All of this, and it's excellent doctors. We have doctors who are well-trained in subspecialties. All of this is going to make Mumbai a center of excellence for us, and the growth trajectory is good. We also plan to open several infusion centers in Mumbai in the coming months. So with all that, we want to be definitely an oncology dominant player. We know Tata Memorial is there. That is an autonomous government public sector, but in private, we intend to be dominant there. We are already reaching up to that level in our radiation therapy load. As far as Kolkata is concerned, as I said, we have definitely done well in the last quarter. We will continue to ramp up, particularly now we are going to see some international patients from Bangladesh. And we are now slowly becoming well-known center in that area with HCG brand, doing complicated surgery. We have also established robotic surgery there. So we see significant growth happening in Kolkata and surrounding area in the coming several quarters. And we will also establish, as we said, our model is to establish spokes with multiple infusion centers there.
All right. And what's the, targeted expansion plan in terms of the beds that you plan to add this year and the next?
I think what we want to do is to really, sweat our what we have assets significantly. For example, Cuttack is an amazing place where we are investing to further growth in Cuttack. as well as I said about Mumbai and Bangalore. And Ahmedabad is an area where we have almost doubled the bed strength, and significantly it is going to grow. So these are the areas we are focusing on this year to grow significantly. But we are also looking at, like what we did in Indore, a target we acquired. We are looking at other M&A targets also. We are in the process, and once we decide on something, we'll certainly make an announcement.
All right. Thank you so much for joining in. Once you've decided on an M&A, you will make an announcement. Once you've decided whether who acquires you, you will perhaps make an announcement then as well. Until then, we will, live with the 60-65% occupancy going to 70%, 8 to 10 RPOP growth and margins veering towards that 20%. Wish you good luck, but more importantly, wish all your patients good luck with their health as well. And we hope that, the kind of work that you're doing for society is great. Thank you for joining in. With that, we'll take a short break, but it's the markets that are calling for attention. We will keep an eye out on the way the Nifty moves. On the other side, Sudeep Shah, the head technicals and derivatives research at SBI Securities, joins in.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
There's been some amelioration from the lows for the Nifty. I mean, when we were speaking at the start of the show, the Nifty was much lower, 22,530 thereabouts. There's been a 30-point recovery, and that can be attributed to HDFC Bank. That's been pulling back, doing some of the heavy lifting. In fact, it's recovered a fair bit from the lows, currently closer to the higher end of today's trading session. So you just pull up HDFC Bank, that tells you that the Nifty is at 22,570, and 22,570 is an important mark for the Nifty. Why is that? Because the May series started with the Nifty at 22,570. When we started the show, the Nifty was actually negative for the May series, and it's been a long 5-week series, right? So even at current levels, the Nifty is actually negative for May series, and the May series was quite volatile as well. We saw lows of almost 21,821, and on the way up, it was 23,111. So give or take everything, this range of 1400 points was the kind of volatility that we saw in the series, and all of that comes to an end today with the May series expiry. The Nifty 20-day moving average is an important support level, 22,483, and the same for the Nifty Bank is much lower. Nifty Bank has been an outperformer there, so that's another mark that we will keep an eye out on. For the Nifty itself, we've seen active writing at the 22,600 call for today. So just pull up the 22,600 call and you would see that, there has been a lot of call writing activity, telling you maybe around 22,650 to 22,700, there would be some congestion. But at the lower level, 22,550 put has been equally active, telling you that maybe 22,500 or levels closer to the 20-day moving average would see some support for the frontline index. As of now, we have, the Nifty just about negative for the May series.
Okay, Nifty negative for the May series. Sudeep Shah, who's the head technicals and derivatives research at SBI Securities, is joining us on the show. Sudeep, hi, good morning. How are you feeling about this market now? It has, been a bit volatile in the last couple of days. But post-elections, what is the prognosis and, what are the individual stocks to look at?
Good afternoon, Sonia and Mangalam. What we have seen in case of Nifty is that post marking a high of 23,100, we have seen Nifty correcting over 500 points now from the peak. And in the last 4 sessions, it has formed lower top, lower bottom formation also. So what we feel is from here on, Nifty is now very close to its support zone at 22,480, 22,500 mark, which is the 20 DMA zone. And I feel only if this is broken, we could see a further acceleration on the downside. Else, this 500, 600 point correction, I think we are done with, and we could now see Nifty consolidating between 22,450, 22,500 mark and 22,800 mark on the upside within the next few trading sessions as we go into the election results. So 22,450, 22,480 would be the all important number that I would be watching out for the next few sessions in case of Nifty.
All right, and individual stocks, what would you do?
A couple of them I like. Now the first one is Bharti Airtel. If you see the charts of Bharti Airtel, the stock is in a consistent uptrend and is a safe bet in such a volatile scenario. The stock has formed higher top, higher bottom formations for the last 4 weeks, and it's holding well above its 20 as well as 50 DEMA. So this indicates that the momentum here in this stock is quite strong, and even from a relative strength perspective, while we've seen Nifty correcting over 3% in the past 3 sessions, this stock has gained 1%. So this could be bought with a stop loss of 1365 on the downside and 1425 targets on the upside. The second stock that I like is Indian Bank. Now, within the PSU Bank basket, where we've seen in the last several weeks, a lot of stocks have witnessed selling pressure from higher level, and they are trading below their February, March, and April highs. This particular stock is trading above all those swing highs and is showing higher relative strength. And as well as in the last 4 or 5 days, the stock was consolidating around 560, 570 mark. Today, we have seen a breakout at higher levels from that consolidation, and the stock on all time frames is looking good. So I think from the current levels, Indian Bank could be bought with a 575 stop loss on the downside and a 605 targets on the upside.
All right, so Indian Bank and Bharti Airtel are the 2 positive buys that you have, or buy calls that you're making right now. Thank you, Sudeep, for joining in. Let's move on. The big changes that are expected to happen in the Indian infrastructure area if Modi government continues to stay in power. These are not my words. These are the words of veteran emerging market investor Mark Mobius, who's also the founding partner of Mobius Capital. In conversation with CNBC, he also gave his take on S&P's recent upgrade that came in on India. Let's hear him out.
I think the election results will be good. Modi will be back in, and he'll be able to continue his policies. The big question mark is whether he can get a number of seats to change the Constitution. I tend to doubt that happening at this stage, but it could happen. If it does, then you can see another big push in India for big changes taking place. And of course, particularly in the infrastructure arena, which is why we are particularly interested in infrastructure-related stocks in India. That's going to be a big push going forward. I think, the B ratings are just too low. You've got to have a higher rating, I believe. Well, they tend to look backwards instead of looking forwards. And Of course, you can't blame them for doing that. They're looking at the numbers and say, okay, this is the situation that happened the last 10 years, so to be safe, let's keep it this way. But if you look forward, then the rating should be higher, should be better. I like the power sector to begin with. One of the things that people don't really realize is the incredible demand for power, not only in India, but globally, which is why I mentioned many of these Indian companies are global in the sense of starting power plants in different parts of the world. But India needs more power. And of course, that is not only coal-fired, but sun-fired, wind-fired. In any way you can get more power, it's going to be necessary. So you need to have probably a doubling of power capacity in India going forward. Consumers all have cell phones. They have to power up these cell phones. All the chips, high-powered chips, need more power. And of course, consumers are consuming more, and that means more and more power. So this is going to be a big, big growth area in my view.
All right, power, infrastructure, big growth areas in the views of Mark Mobius. What we'll do is talk about that itself. On the other side, we have PP Gupta, who's the MD at Techno Electric and Engineering, joining in to discuss not only the fourth quarter numbers, but the outlook going ahead as well.
Way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all investing.
Welcome back to Halftime Report on CNBC TV18, where Alchem Labs has slumped in trade post its Q4 numbers. Sudarshan is here with the conference call takeaways and some fresh brokerage views as well. Sudarshan, over to you.
So today, Alchem Lab is amongst top mid-cap losers and has turned negative for 2024. And the reason for this major fall is more than the earnings. It was muted outlook that company gave in its con call that happened post-market yesterday. And in the con call, company says for FY25, revenue growth is seen at current level of 10%, and even gross margin, EBITDA margins are seen in the current range. And it's optimistic about biosimilar business, but refrains from giving any guidance. Now, after this, most brokerages have turned negative on the stock, and JP Morgan has a neutral call, and it has cut target to 5,445 from 5,640. It said there was a big miss on revenue, and even guidance appears lackluster, and it has reduced FY25-26 earnings estimates by 3 to 4%. 4%, and it believes tax rate will inch higher to 25% by FY27 from current level of 13 to 14%. And for JP Morgan, even valuations at current levels appear expensive. BofA Securities has an underperform call and target is 4,130 per share. And it says FY25 guidance implies consensus earnings cut. Macquarie has an underperform call and target is 4,500. It said there was an all-round miss in Q4 and guidance for FY25 is muted. Jefferies too has an underperform rating and it has reduced target to 4,200 from rupees 4,470 per share. And after this, it has cut FY25-26 EPS estimates by 5% to 6% on subdued FY25 guidance. So overall, earnings were below estimates and even guidance for FY25 was muted. That's the reason brokerages have turned negative on the stock.
All right, Sudarshan, thanks a lot for that. That's about Alchem under pressure today. But just pull up a couple of stocks. We have Ajanta Pharma, which has moved higher. In fact, from the lows, Ajanta Pharma is up almost 13%. Alchem is down about 5%, as Sudarshan pointed out. But, you know, there you see it was in the red for most part of today's trading session, now recovered. And the other one is Page Industries. That too has inched higher, up around 2%. The street perhaps likes, you know, their foray into the athleisure segment and increased revenue coming in from athleisure, along with revenue coming in from, you know, women as against men's products, is something that the street eyes on Page Industries. That stock up at the high point of trade. But the stock on top of our mind this hour and this day has been Cummins. The company posted a strong set of earnings. However, it was the management commentary that dragged the stock lower, now languishing with a cut of almost 5%. Vamakshi joins in. Vamakshi.
Well, absolutely. There's no doubt that it was a strong set of numbers. Revenue came in nearly 6% higher. EBITDA was also nearly 41% higher and net profit 58% higher as compared to our own expectations. Gross margins also surprised positively, coming in at 23.5%. But apart from the numbers, it is more important to now focus on the commentary that came through from the management. They highlighted that they expect double-digit growth in FY25. On transitioning to CBCP4, they say that 1/3 of the sales in Q4 already come from the products with the new norms, and they're seeing very good traction out here. They do not see impact of pre-buying for CBCP2 products to continue as it has played out for them in the past. And as a result, we did see their volumes surge up by almost 30% in FY24. So this is not expected to play forward in FY25, and therefore resultantly they're expecting volume growth less than 30%. On margins, they say they did face a one-time advantage of 60 crores in this quarter. The profit was better due to better mix as well as better cost efficiencies. The gross margins could continue to hold at FY24 levels, but this seems rather challenging as metal prices have surged higher. They aspire to improve margins with the new CBCP4 products, but they will have to wait to see how the competition plays out in September to October. On demand, they say that data centers, infra-related growth, investments in power gen all bode well. They see reasonably strong demand coming in across the segments. In fact, for data centers, they believe that the contribution to the top line could go over 10% going forward. However, on exports, they sound a bit cautious. They're saying that Europe is at an all-time low. Africa is struggling mainly on account of the currency issues there. The demand may remain weak until one quarter, and they do not see bottoming of the market yet, but they see a correction in exports until the recovery kicks back in. The percentage of exports as contribution to sales will remain stable in FY25, and they expect to revert back to the 30 to 35% mix beyond FY25. So overall, yes, it's a good set of numbers coming in from Cummins, but the commentary on margins as well as exports driving the stock down lower.
Okay, thanks a lot for that. Let's slip into a quick break. But before that, a small programming note for our viewers. Join us live on the 31st of May from 5:30 p.m. onwards for CNBC TV18's Future Female Forward, the Leadership Circle, which is a transformative platform where leaders from diverse fields will venture beyond the traditional discourse and share stories of grit and determination on the roads less traveled. This Leadership Circle is not just about business strategies and professional accolades. It's about delving into the depths of the personal journeys these trailblazers have.
The car. We are in fact here at Yerwara police station. There are 3 FIRs right now which have been registered in the Pune Porsche drunk driving case. One of the FIR is by the driver's family, who would allege that that he was kept illegally confined inside the staff quarters at the family household. He was, in fact, he had also mentioned that he was kidnapped and was not allowed to speak to his family for a very long time. Now, this car is the car which was used to pick up the driver. Cops have now taken this vehicle into their custody. In fact, my Vijay Vasant will show you visuals of how there is a notice that has been put in the car as well. In this very car was where the driver was taken, following which he was kept illegally confined. Now, cops have taken this very vehicle. They've seized it and kept it in the custody at Yerwara police station. Along with that, the Porsche car also, in this case, has been kept just a few cars away from this vehicle. Yesterday, at this very spot was where technical analysis of the car had taken place. This is a part of the investigation, so this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station, but parallel...
Welcome back. You're here on Halftime Report. We're seeing markets not doing too much in terms of front lines, but we have Dixon Tech, which has moved higher. We have Sun TV, which has tried to recover from the losses that it saw on the first day of the week. So now it's still lower by about 0.5% for the week, but it's done a fair amount of good from the lows. And then we have PFC as well, which has now inched slightly into the green. The biggest recovery of the day, however, has been from Bata. The company reported softest set of fourth quarter numbers, but from lows, the stock is up 5%. Maybe the street eyes some recovery ahead in terms of demand and sales for them as well. But earlier today, we spoke with Adrian Mowat, who's obviously a Hong Kong-based investor. He spoke about the markets and the investing situation right now. Let's hear into the excerpts that we had from the conversation that we had with him.
I'm a little bit cautious on India at this point. We've had a very good move over the last couple of years. Valuations were up to 23 times forward if you look at the MSCI India level. Incumbent government will win a majority. Maybe the size of that majority has been moderating in terms of expectations. But it sort of looks like an event that probably wouldn't generate much upside if the consensus view comes through, and perhaps would have an asymmetric downside if the BJP majority was very narrow, which I think is very unlikely. Look at HDFC Bank, it's about 2.4 times tangible book value. Its forward PE multiple is significantly lower than it used to be. But on a price to tangible book value, it remains one of the world's more expensive banks. Perhaps you find some of the faster growing Indonesian banks with similar price to tangible book levels. I think there's a broad global story here that even the top quality banks with high return on capital employed are struggling a little bit when it comes to deposit growth. I wouldn't say it's a disenchantment specifically with India. The emerging markets as an asset class have been extremely disappointing, and a lot of that has been due to the weakness in China. But we've also had significant weakness in markets like Brazil, South Africa, which also has elections at the moment, has been very disappointing. That's all going on while the S&P and NASDAQ have continued to make new highs. And I think what we've seen is this global equity money moving out of emerging markets.
All right, that's Adrian Mowat. But moving on, S&P has revised its rating outlook for 6 Indian banks to positive on sovereign action. Abhishek is joining in with details on that. Abhishek, over to you.
Well, as you mentioned, outlook on 6 Indian banks has been revised by S&P, given the fact that sovereign action has also been revised by them. So ratings have been affirmed. ICICI Bank and Axis Bank, the standalone credit profile over there, the rating has been upgraded. They say that India's economic expansion is having a constructive impact on the sovereign credit metrics. Hence, India's banking system continues to ride the good economic growth momentum, which is well supported by the structural improvement that they are seeing in the banking sector. So Indian financial institutions' resilience has therefore been built up over the last few years. So they expect India's banks to maintain their strong financial performance over the next 1 to 2 years, that is 12 to 24 months. They have revised rating outlook on 6 Indian banks to positive from stable, which includes the like of Axis Bank, ICICI Bank, State Bank of India, HDFC Bank, Kotak Bank, as well as Indian Bank, who are all up in green today. So they have affirmed the rating of BBB A-3 issuer credit ratings on these banks as well. Upward revision of assessment of the standalone credit profile, that is SACP, of ICICI Bank has been revised to BBB plus from BBB, and Axis Bank has been revised upwards to BBB from BBB minus that they had earlier. For IRFC as well, the rating outlook has been revised to positive from stable that they had earlier for them. Back to you.
All right, Abhishek, thanks a lot for that. S&P turns positive on banks. The Nifty Bank actually has been doing extremely well as we speak. You know, it's closing in on that 48,800 mark. That dip has almost been bought into, and the Nifty Bank is veering towards the higher end of today's trading range so far, which was closer to that 48,920 mark as well. And it's led by some of its biggest weights. We have the HDFC Bank stock, which is doing extremely well. So if you pull up both the Nifty Bank as well as the HDFC Bank chart side by side, you would realize the congruence in the shape of both these charts. And then you have ICICI Bank, which is putting its hand up as well. It's crossed an important level, the 50-day moving average. So both HDFC Bank and ICICI Bank together putting their hand up for the Nifty Bank, which is in turn helping the Nifty stay around that 22,570 mark, which of course is the level at which we started the May series. Take a short break, come back, get you more on the stocks and the markets.
For the blood samples, crime branch is looking at that case. Details in this very case emerged, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. So that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom the father of the accused had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out who that middleman actually is.
Well, it's the 30th of the month, and today we will get macro data from the US. The most important data point that comes in, apart from the jobless claims, is the first quarter GDP from the US. But that's not as important for India. What's important for India is what happens, you know, for us tomorrow. The GDP data for the fourth quarter, the last quarter of the financial year, will be out tomorrow. And brokerages are painting a mixed picture, but majority are expecting growth for the full year to meet the government's projection of 7.6%, if not beat it. Sapna Das joins in with what the street is expecting and what's likely to happen. Sapna.
Well, there are mixed reports that have come in from various brokerages as far as India's Q4 GDP print is concerned and what the final number for FY24 could be. For instance, Citi and ICRA's growth forecasts are a bit subdued. In comparison, JP Morgan, Morgan Stanley and of course SBI Research are comparatively bullish. So, for example, JP Morgan, what it says is the fact that, on the back of stronger than expected manufacturing exports as well as domestic public investment, they expect the Q4 GDP print to be around 7%. This would also push the entire financial year's outlook up to 7.9%. Morgan Stanley too expects the Indian economy to expand by 7.9% in the previous financial year, and the growth outlook, of course, is positive. SBI Research is one of the most bullish. They expect the Q4 number to come in at 7.4%, and this will take the entire year's number to 8% growth. Citi, of course, is the most subdued among the lot. Citi expects a considerable, fall in the Q4 GDP print, almost by 2% from, from a high of 8.4 in Q3 to 6.5% for Q4. They also expect the GVA to be slower at 6%, and for the full financial year, this will bring the number to 7.7%. That's how much they expect the Indian economy to grow by. But let's keep in mind, this is still 10 basis points higher than the NSL's estimate of 7.6%. ICRA, of course, they expect the Q4 number to kind of moderate to 6.7%, but they expect a big fall in the GVA from 6.5% to 5.7%, and they expect the full year's growth estimate at 7.8%. Of course, this now brings us to what the government's view has been. Well, the CA has been pretty much clear that on the back of strong Q1, Q2 and Q3 numbers, for instance, the first 9 months of the current financial year, India has grown by 8.2% in the previous financial year, and so the CA says that this is going to help, maybe bring the full year's number to 8% growth level. Again, in the current year, a lot of estimates have already come in, right from MDBs to a number of brokerages, and their growth forecasts are anywhere between 6.6 to 7% for India. Of course, RBI and ADB at 7%, World Bank lowest at 6.6%, and the government's view as of now is that this could be an underestimate, but that would be dependent on geopolitical factors as well as how the monsoon progresses. And beyond FY25, the chief economic advisor himself expects India to grow at a steady pace of 6.5 to 7%. So that's going to be the normal going forward.
Incredible. Thanks a lot for that. It's not just India. I mean, it's the election year in the US as well. Many countries in the world actually going for elections. But from a GDP standpoint, from a global importance standpoint, it's India, US, and the UK that we'll be talking about. But the US, just talk about that. CNBC's Steve Leisman talks about how the Federal Reserve moves during elections.
We found, our analysis finds the Fed is plenty active during presidential election seasons. It hikes and it cuts, but it does so with little discernible bias for one party over the other. We looked at 34 years of data. It shows the Fed moved 23% of the months during the presidential election season, which we count from January through October of a presidential election year. It moved 30% of the time outside of the election. 2/3 of its actions were cuts during the election season, but those relate back to mostly the pandemic and the great financial crisis. And that compares to 50% of the time outside of cuts, outside of election seasons. Many moves happened during the election season as part of something the Fed was already doing, like the 100 basis points of cuts when George Bush Sr. ran against Bill Clinton. The Fed had already been hiking under incumbent President Bill Clinton when Al Gore ran against George W. Bush, and the Fed launched a hiking program while incumbent George W. Bush ran against John Kerry. The hikes would continue for several years, but the big moves came in 2008 in response to the great financial crisis, part of more than 500 basis points of overall cuts. 300 took place during the election season, and the Fed, of course, cut by 150 basis points down to zero in March 2020 when then President Trump ran against President Biden in response, of course, to the pandemic. None of this says the Fed hasn't been or won't be political. Fed Chair Arthur Burns famously caved to President Nixon in the 1970s. President Trump's tweets, by the way, according to one study, had an impact on the Fed lowering rates in 2019. But the analysis shows no reluctance on the part of the Fed to move during presidential election seasons and no particular party bias over time. What can't be known, I'm sorry to say after crunching all this data, is whether the election will matter if it's a close call. That is, will the Fed steer clear of cuts to avoid the perception of bias if the case for moving is marginal?
All right, interesting data out there, Steve. Thank you for that. Let's talk about the world of commodities as well. Now, as we speak, oil trades steady at levels of around $83.50 per barrel. Worries over a weak U.S. gasoline demand and the PCE data, the personal consumption expenditure data, due on Friday, as well as the upcoming OPEC Plus meeting will continue to be on top of investors' minds as well. Moving on to the shiny metal, gold prices dipped to levels of around $2,300 per ounce, dragged by the strength that we saw in the US dollar and higher bond yields, which topped around 4.6% in yesterday's trading session. But 23.35 thereabouts is a small drip in an otherwise big rally that we've seen in gold as well. Silver prices steady, still steady around that $32 per ounce. And the big corporate development that took place in the commodity world was the mining giant BHP Group saying that it has withdrawn its near $50 billion plan to take over rival Anglo American. So that's something that will have its bearing on the commodity market, and that's something we'll keep an eye out on itself. And ahead of the OPEC meeting that I spoke about would be an important data point to track, or important development to track for the oil markets and the oil prices. Jeffrey Curry of Carlyle Group spoke about his take on where he sees the oil prices and also weighs in on the probability of rate cuts going forward. Let's hear him out.
You look at positioning, it is at a 13 low right now. And if you look at, let's take Brent, it's sitting at, $84 a barrel, WTI just shy of 80. The high recently was somewhere around 90. Think about, we're down maybe $5, $6 a barrel, and you took positioning from a relatively high level to one of the lowest on records. It goes to your point about, the dovish view around oil. But the underlying fundamentals are still there. By the way, near-term fundamentals on oil are better than the near-term fundamentals on copper. I think the view for oil is, hey, they're probably going to maintain the cuts going through June. Demand is likely to rebound seasonally. We are in those shoulder months between the summer driving season and the winter cooling season, so you expect demand to be relatively weak. As it accelerates in 3Q, that should push us well above $90 a barrel once again.
All right, and as we take your leave on halftime report, would just like to point out a couple of stocks which are doing well. RHI Magnesita, we spoke to the management this morning, results and the outlook. That stock up around 7%. So some of the stocks in broader markets are still outperforming the otherwise wobbly trend that we have. The Midcap index, when we started the show, was down by almost 0.8%. Now that has also cut its losses from 450 points to about 350 points. So there are signs of some life coming in from the lower levels in the market. The question is, in the second half, do we see this recovery being sold into or being used as building on gains itself? The Nifty 2 closing in towards that 22,600 mark, ably led by the Nifty Bank, which is now currently closer to the higher end of today's trading range. Take your leave, and on the other side of this short break, you will have the team of Business Lunch taking all the market action and news forward.
ಮೊದಲನೇದಾಗಿ ನನ್ನ ತಂದೆ ತಾಯಿಗೆ ತಾತಂಗೆ ಹಾಗೂ ನನ್ನ ಕುಮಾರನಿಗೆ ಮತ್ತು ನಾಡಿನ ಜನತೆಗೆ
that is coming back, is going to cooperate with the law enforcement agency. That's a way forward. Everybody should respect the law of the land, and by complying with the law of the land, the truth will come.
Stocks trade soft with declines far outstripping the advances following the weak global cues. Consumer durables as well as metals are the big losers, even as financials and capital goods buck the trend.
Tata Steel turns in a healthy performance with in-line revenues and higher margins, even as it holds the line on debt. But the stock slips on profit-taking after the recent run-up.
S&P revises its rating outlook onto six banks to positive from stable on the back of a revision in India's rating outlook. It also revises up its standalone credit profile for ICICI Bank and Axis Bank by a notch each, and the revision boosts the sentiment in the market.
Hero MotoCorp's 41% owned financial services associate Hero FinCorp eyes a fresh equity issue of 4,000 crores and an offer for sale via an IPO. The move gives the stock a fillip.
A sharp increase in interest earned on foreign securities and deposits combined with a significant reduction in the provisions despite an increase in contingent risk buffer to 6.5% leads to a 140% jump in surplus payable to the centre. Hello and welcome to Business Lunch. I'm Nisha Podar. With me, as always, is my co-anchor Sonia Shenoy. So, Sonia, a lot of global factors as well as the time and the waiting time ahead of the elections. Both are putting pressure on our markets today. But one pocket which really stands tall and is really shining bright today is the banking space, also because of the upgrade coming in from S&P. Let's take stock of the market. A Nifty 50 closer to the lower end of the trading day today, over 0.5% down right now, and 22,580 levels. Sensex too is losing about 335 points. Midcaps are also down in line or slightly higher than the key indices, 0.6% down in the midcap universe. But as I said, Bank Nifty, that is really zooming ahead, 0.7% up in trade. Advanced decline ratio and market breadth definitely is affected because of a broader base of stocks being on the declining mode, especially the broader market universe. But banks, let's talk about that. ICICI Bank is the biggest gainer and also the key contributor on Nifty 50, and led by also SBI as well as HDFC Bank. Apart from the big banking stocks, it's also Bharti Airtel which is adding to the momentum. But on the flip side, big boy Reliance Industries is the biggest dragger along with the big IT names and even ITC. Sonia.
Okay, yes, absolutely. No, I think at the end of the day, it's just pre-exit poll jitters, right, that the market is seeing. It's been 3 days now, actually. The Nifty's come off quite a bit from the highs that we saw, last week, and so has the Bank Nifty. But today, let's see how the rest of the day goes, because today is not such a bad session. We've actually picked up from the lows. But the RBI in its annual report for FY24 says that despite various global headwinds, India looks well placed to step up its growth trajectory over the next decade. Ritu joins in with details. Ritu.
Well, Sonia, yes, very gung-ho on the outlook for growth from this RBI annual report. But a quick word on that bumper surplus that RBI transferred to the government that has been the talk for a while. And now we have the reason why we saw this huge surplus. And that largely has to do with the much lower expenditures that we saw from the Reserve Bank of India's balance sheet for FY24 compared to the previous year, and that was because of lower provisions that last year, primarily on account of the forex assets. So that is why RBI was able to provide this 2.11 lakh crore kind of a surplus to the government this year. Now, apart from that, of course, on the outlook for the economy, the RBI says the outlook for FY25 is brightening, although it does express concerns when it comes to inflation trajectory, largely because of the uncertainty in the food price inflation. It says the real GDP growth outlook is solid on the back of a good investment demand and a pickup in consumption demand as well. It says geopolitical tensions, fragmentation, the commodity price fluctuations and erratic weather development. These are some some of the risks that could derail the growth and the inflation trajectory as well. There's lots of interesting data, across this annual report, but I'd like to point out what it says on frauds. Very interestingly, the number of frauds that have been reported in FY24, increased almost 3 times in terms of volumes compared to FY23, but in terms of value, it has come down by almost half. So there were 36,075 frauds that were reported in FY24 compared to 13,564 in the year before. And in terms of value, it has fallen down to 13,930 crores in the year from 26,127 in the year before. Most of these frauds in the last 3 years are largely coming from the private banks, much more than the public banks in terms of volumes. Most of them also in the digital space, specifically with credit cards and internet banking and so on. In terms of group-wise, the lowest amount of frauds, like I said, has come, of course, from foreign banks as well. So, what is important also is to note that while the fraud reported for the year in terms of volume may be higher, not all of the frauds occurred in FY24. There's a significant lag, with RBI saying that nearly 90% of the frauds that were reported this year came from the past years. So keeping all of that in mind, of course, are not very alarming figures overall, and very bullish, of course, on the economic outlook.
All right, Ritu, thanks so much for giving us all those important details. Now, after a 7-phase, month-long polling season, well, the general election results will be announced on the 4th of June. Now, the verdict is being keenly watched out for by the market, which usually cheers continuity in the economic growth and policies. Earlier, we got in touch with the Hong Kong-based investor Adrian Movat to understand his expectations from the next government and also what he thinks will be the implications for the Indian market from the election results. Listen in.
I'm a little bit cautious on India at this point. We've had a very good move over the last couple of years. Valuations were up to 23 times forward if you look at the MSCI India level. Incumbent government will win a majority. Maybe the size of that majority has been moderating in terms of expectations. But it sort of looks like an event that probably wouldn't generate much upside if the consensus view comes through, and perhaps would have an asymmetric downside if the BJP majority was very narrow, which I think is very unlikely.
All right, meanwhile, Mark Mobius, who's a founding partner of Mobius Capital Partners, told CNBC that he expects big changes to happen in the Indian infrastructure sector if the Modi government continues in power. Take a look.
I think the election results will be good. Modi will be back in, and he'll be able to continue his policies. The big question mark is whether he can get a number of seats to change the Constitution. I tend to doubt that happening at this stage, but it could happen. If it does, then you can see another big push in India for big changes taking place. And of course, particularly in the infrastructure arena, which is why we are particularly interested in infrastructure-related stocks in India. That's going to be a big push going forward.
All right, some very big and global commentary coming in on expectations from the election results in India. With that, we'll slip into a short breather on Business Lunch. We'll get you more on the markets as well as stock-specific action for the day on the other side. Stay tuned.
Who created the video, who distributed the video, all these truths should come out, but we can't expect from this SIT. Instead of this, SIT should be monitored by a court. Court-monitored SIT or CBI is the only way forward for us to get justice.
Welcome back. You're watching Business Lunch on CNBC TV18. Well, let's get you an exclusive now. Sources are telling CNBC TV18 that the insurance regulator IRDAI has proposed a new framework to calculate surrender value for life insurers. Yash is here with the details. Yash, over to you.
Well, Sonia, it was only in the meeting which happened between the IRDAI chairperson and the CEOs of various life insurance companies that the point on increasing, raising, mandating and fixing it through a formula on special surrender value was discussed between the regulator and the industry. In fact, CNBC TV18 on April 30th, 2024 had reported on the insurance regulator's intention to increase the special surrender value, which will take the total surrender value a lot higher than where it exists today. Now, in a fresh set of development, what we've been given to understand is that the insurance regulator, after multiple rounds of back and forth between the industry and itself, has sent a proposal on how it sees the special surrender value should be increased going forward. Life insurance companies are expected to submit their response on this proposal from the regulator by as soon as tomorrow, that is May 31st itself. Now, just to give out a few lines on what the proposal says, it says insurers to ensure that special surrender value is at least equal to the expected present value of paid up sum assured and paid up future benefits. It also says that rate of interest to calculate expected present value of paid up sum assured shall not be more than the 10-year GSEC yield. Also, it says that the special surrender value shall be provided from the first policy year itself. Now, of course, if you just go to read these lines on their face value, it might seem very complicated. But just to give you an example with numbers in terms of how the special surrender value basis this formula would increase. Now, if I talk about any life insurance policy with a sum assured of 1 lakh rupees, policy term of 10 years, policy bonus of 50,000, policy returns on maturity of about 1.5 lakhs, and interest rate for calculation to be at 7%. Then in that case, the first part, that is paid up sum assured, that amount as per the formula given by the IRDAI would be about 10,000 rupees. Add 5,000 to it more, because 5,000 rupees would be the bonus which the insurance company would pay. Now, imagine if the policy is surrendered after paying the first annual premium itself, then in that case, the balance 9 years of the policy will have to be discounted for, and as per IRDAI formula, that would give you a special surrender value of about 8,196 rupees. Now, imagine on a 10,000 premium which has been paid by the policyholder, he would be eligible to get 8,196 rupees as surrender value. This bases the formula suggested by the regulator. December, there was a draft paper where the regulator proposed increasing surrender value significantly. That would have meant about 83% of the total premium received by the insurance company would have to be paid back as surrender value. The insurance companies are obviously spooked. In March 2024, there was another set of regulation which reduced this 82% to 30%, and the insurance companies took a lot of relief out of it. But now again, as this new proposal has been sent, it again takes the surrender value to the levels of 82%, and could be a big negative for life insurance companies if it indeed comes through.
All right. Thanks so much, Yash, for explaining to us about the conundrum on the surrender value for the insurance companies. Moving on then, the Reserve Bank has announced supervisory action against Edelweiss Finance and Edelweiss ARC, citing material concerns. Now, the central bank has restricted the entities from undertaking any structured transactions pertaining its wholesale exposures. So Ritu is joining us with a lot of details on that one. Ritu, it's a tough stand for the RBI on the regulatory non-compliance of these two entities. Take us through the details.
Indeed, the regulator continues to take a very tough stance against non-compliance, and it has now imposed business restrictions on two Edelweiss Group companies, and that is ECL Finance, which is their SME NBFC financing arm, and Edelweiss ARC, which is the asset reconstruction arm, because of material supervisory concerns. Now, RBI has asked ECL Finance to immediately stop undertaking any structured transactions relating to the wholesale exposures, and also directed the ARC to immediately stop acquisition of any financial assets, including security receipts. Now, RBI found that these entities engaged in structured transaction with the purpose of evergreening the stressed exposures of ECL by using the ARC and connected AIFs to bypass regulations. Now, what were the regulations that have been bypassed? ECL Finance acted as a conduit for loans from non-lender group entities which were sold to Edelweiss ARC, thereby circumventing rules that permit ARCs to only acquire assets from banks and financial institutions. Apart from this, there were breaches in KYC, loan-to-value norms, and so on. In the case of Edelweiss ARC, RBI said it failed to place RBI's FY22 supervisory letter before the board. It shared non-public client information with group entities and so on. And despite many opportunities for remediation, RBI said these entities continue to find new ways to circumvent regulations, which prompted this action. However, the restriction will be reviewed once they rectify the concerns. Now, both ECL Finance and Edelweiss ARC have said in their individual statements that this action is not going to have any material impact on their business, with ECL Finance adding that it had discontinued that wholesale business in FY24 and that the wholesale exposure will continue to come down in the normal course of business.
Okay, thanks a lot, Ritu, for that. Let's take a short break. When we return, we'll get you the latest updates on the weather as North India has touched record high heat levels. Stay tuned.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on...
Welcome back. You're watching Business Lunch. Now, as temperatures soar, North India sees no respite from the scorching heat. But in some relief, the IMD has predicted that there could be light showers in the next 2 days. In fact, they have also issued a clarification on a temperature reading error. Abhimanyu, our colleague, reports from the national capital on this.
The northern plains are scorching and the national capital is no exception. While it may be unbearably hot in the national capital, but the IMD has clarified that the maximum temperature of 52.9 degrees Celsius, which was recorded yesterday in Delhi's Mangeshpur, may be due to an error since automated weather stations are often prone to errors. The IMD is currently analyzing the data, which currently seems like an outlier compared to the other weather monitoring stations located in different parts of Delhi, which had recorded temperatures between 45 degrees Celsius and 49 degrees Celsius. As far as relief is concerned, there is some possible relief in the offing after the 30th of May, as the IMD has predicted some western disturbances and moisture coming in from the Arabian Sea, which may bring in some relief in form of rain, which may decrease the temperature. As far as the monsoon forecast is concerned, the onset of monsoon in Delhi is slated to be around the 29th of June. And this year, it's an above normal monsoon, which has been projected for the
entire country. However, for northwest India, it is projected to be a normal monsoon. It's projected to be a below normal monsoon for northeast India and an above normal monsoon for parts of central and peninsular India.
Okay, the heat is on. It's a very, very tough situation. But amidst heat waves across the country, peak power demand in India has hit a new high as well, especially, of course, in metros, I'm sure. Rachna is joining in now with more details on that. Rachna, over to you.
Thank you so much for that. India's peak power demand hit a record high of 246 gigawatt on Wednesday. Now, this has come at a time when the entire country is going through a heat wave, not just in the northern part, but of course the most affected areas are northwest and central parts of the country. Now, this comes, as I said, it comes at a time when we're going through a heat wave. So overall, including power shortage, the peak power demand stood at a record high level of 246 gigawatt, up from last year's high of 242, which we witnessed in September. This year's initial expectation of peak power demand was around 236 gigawatt, but it was later revised to 260 by the Power Ministry. The record high in peak power demand was recorded for many states like Uttar Pradesh that hit a peak power demand of 228 gigawatt, along with Maharashtra and Gujarat that stood at 27 gigawatt. Delhi, that also recorded highest temperature ever, yesterday saw a peak power demand of over 8,000 megawatts, surpassing its expected limit of 7,000. It is also the first time ever that peak power demand surpassed 7,000 megawatts for 12 days in a row this month in Delhi. Rising power demand has also had an effect on coal stocks as well. As many as 184 thermal power plants with a total power generating capacity of 211 gigawatt have about 68% of normative stock, as demand for electricity is also on the rise. And that has not been the case just since yesterday, but since the start of the month of May, and is likely to be the case till the onset of monsoon, which is expected in about 2 weeks.
That's right, Rachna. Thanks so much for detailing the power demand with soaring temperatures. And also with that, let me add, soaring will be all our electricity bills, and household budget is going to be pinched because of this. All right, moving on then, veteran investor Mark Mobius is bullish on the power theme in India and says that it will be a high growth area. Listen in.
I like the power sector to begin with. You know, one of the things that people don't really realize is the incredible demand for power, not only in India, but globally, which is why I mentioned many of these Indian companies are global in the sense of starting power plants in different parts of the world. But India needs more power. And of course, that is not only coal-fired, but sun-fired, wind-fired. In any way you can get more power, it's going to be necessary. So you need to have probably a doubling of power capacity in India going forward. Consumers all have cell phones. They have to power up these cell phones. All the chips, high-powered chips, need more power. And of course, consumers are consuming more, and that means more and more power. So this is going to be a big, big growth area in my view.
Okay, that is Mark Mobius, legendary investor Mark Mobius, talking about different things that you can look forward to in terms of different sectors. But counting is underway in what is said to be South Africa's most fiercely contested elections since the end of the apartheid. Results from 10% of the polling stations so far puts the ruling African National Congress in the first place with 42.3% votes. However, the party is set to lose majority in the parliament for the first time in 30 years. South Africans voted in one of the most pivotal elections yesterday with a turnout of 66%, higher than the turnout in the 2019 election. South Africa's benchmark index fell over 1.8% in trade, on track for its worst day in 6 weeks. The national currency, the South African rand, fell as much as 1.6% against the dollar following the early leads.
All right, to another important global development, to some updates coming in from West Asia. And Israeli forces seize control over Gaza's 14-kilometer-long border with Egypt, now giving Israel full operational control over Palestinian territory with the Houthis' continual attack, and Israeli Cabinet Minister Gadi Eisenkot really blaming Netanyahu for Israel's lack of security. In fact, all this put together, CNBC's Dan Murphy gets us the latest developments from the region.
Israeli forces have seized Gaza's entire border with Egypt, giving Israel effective authority over the Palestinian territory's entire land border. The IDF also continued its raids across Rafah in southern Gaza, defying an international court of justice order to end attacks on the city, where over 1 million people had previously taken refuge. Chief military spokesperson Daniel Hagari said in a televised briefing that Israel had gained operational control over the Philadelphia corridor, Israel's military code name for the 14-kilometre-long corridor which marks the Strip's only border with Egypt. Knesset member and former military chief Gadi Eisenkot has accused Prime Minister Netanyahu's coalition of, quote, failing miserably as political divisions in Israel over the war in Gaza continue to deepen. Eisenkot, also an observer in the war cabinet, said Netanyahu failed on security and the economy and called for elections by the end of this year. Meanwhile, Yemen's Houthis have attacked 6 ships in 3 separate bodies of water, according to the Iran-backed group. In a televised speech, the Houthis said they targeted the Morea and Sea Lady in the Red Sea, the Alba and Maersk Hartford in the Arabian Sea, and the Minerva Antonia in the Mediterranean Sea. Forces confirmed to Reuters that bulk carrier Lax was also damaged off the Yemeni coast. Maersk said their Hartford container ship was not the subject of a drone or missile attack. The Houthis have launched repeated drone and missile attacks in the Red Sea and its surrounding region since November. They described their attacks as acts of solidarity with Palestinians in Gaza.
Okay, that's all the time we have on Business Lunch, but Midcap Radar comes up next, so don't go anywhere.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com.
The car. We are in fact here at Yerwara police station. There are 3 FIRs right now which have been registered in the Pune Porsche drunk driving case. One of the FIR is by the driver's family, who would allege that that he was kept illegally confined inside the staff quarters at the family household. He was in fact, he had also mentioned that he was kidnapped and was not allowed to speak to his family for a very long time. Now this car is the car which was used to pick up the driver. Cops have now taken this vehicle into their custody. In fact, my Vijay Vasant will show you visuals of how there is a notice that has been put in the car as well. In this very car was where the driver was taken, following which he was kept illegally confined. Now cops have taken this very vehicle, they've seized it and kept it in the custody at Yerwara police station. Along with that, the Porsche car also in this case has been kept just a few cars away from this vehicle. Yesterday at this very spot was where technical analysis of the car had taken place. This is a part of the investigation, so this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station. But parallelly, when you speak of the blood samples, crime branch is looking at that case. Details in this very case emerged, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. So that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, banks are shining today, but we cannot say that for the benchmarks. All of them down today. Midcaps too participating in the weakness that we are seeing. So ahead of the big day, which is literally in 2 trading days.
2 trading days.
So we'll see these actions or these moves become more volatile.
You're absolutely right. In fact, pharma, IT, some of the defensive today, I think quite a bit of selling pressure. But we have a lot lined up on the show. We're in the midst of the very thick earnings season as well. So first up, the main headlines. Stocks trades off with declines far outstripping advances following weak global cues. Pharma and healthcare are the big losers, even as banks buck the trend. Midcaps underperform.
Imami surges in a strong fourth quarter and extended winter 8 sales while margin expands by 270 basis points. Brokerage Jefferies issues a buy rating with a target of 630 rupees a share, citing improving outlook and attractive valuations.
Alkem Labs slumps on a weak fourth quarter. Brokerages Jefferies, Macquarie and Bank of America all issue underperform rating and lower price targets.
IRBI Infra and Tata Technologies slump after large block deals, while Kabel surges after 5% equity changes hands. TPG Asia is the likely seller in this block.
Sources tell CNBC-TV18 that the insurance regulator IRDAI has proposed a new framework to calculate surrender value for life insurers. Stocks like Max Life, HDFC Life, ICICI Prudential Life and SBI Life come under pressure.
Okay, all right. Those are the top headlines, but we've been talking about the weakness that we are seeing in mid-caps. So before we talk about all the market action, let me go across to my colleague Hurmaz. He's here with all the mid-cap movers that are moving in trade.
It's an extremely choppy day, as you can say. The banks are doing very well, but the same can't be said for the broader markets. The mid caps and the small caps are participating in the downside today. The mid cap index almost at the lowest point of the day, and we'll start off with the top losers, and Alkem Labs is one of those, as you highlighted in the headlines earlier. 6.5% lower now. At the day's low is Alkem Labs. Some sluggish commentary from the management of Cummins as well, and that stock is taking a knock despite some very good earnings, but the management commentary is leading this downslide. Century Textiles and JB Chemicals also sliding around 3% each in today's session. The day belongs to another day of block deals, and as you highlighted, IRB Infra is down 9%. It was down almost 11% at one point. Some recovery there from the lows. KFin Tech 6% lower, and Kabel has also given up all of the gains that it had at the start of the trading session. Some stocks that reported earnings and they are reacting as well. SJVN is down 3.5% after margins fell below 50%. Bata is at the highest point of the day now, 2.5% higher, and RHI Magnesita is also trading with gains of 6.5%. And lastly, some stocks doing well on the back of volumes and bucking the trend as well in an otherwise weak market. KNR Constructions is up 10% at the day's high. Imami as well, the earnings impact there, commentary impact. Linde India up 7.5% at the day's high, crossing 9,000 now. And CG Power, after the UBS price target raise, is also doing well today. Back to you.
Well, thank you so much for highlighting those stocks, Hormal. Some of them clearly outstripping. Now, if you're looking within the FNO space, have a look at names like Indigo. Axis Capital went ahead and upgraded the stock last evening, and on the back of that, that particular stock trading near the highest point of the day, almost 3.5% higher. Also, have a look at Motherson Sumi, seeing some follow-on buying, after the strong set of results that the company delivered, and also the commentary in terms of what the management guided in terms of the Europe business is something that the street is actually liking. Sun TV is another stock. Stocks are quite a bit of a sell-off post what was essentially a mild or a muted Q2, Q4. After that, today, the stock seems to have come back to its winning rates, up almost 2.5%. But moving on, a very important management, Tata Steel reported a good set of fourth quarter numbers. EBITDA per ton is higher than expected, while loss in the European business is the lowest in 6 quarters. Our colleague Nigel spoke to TV Narendran, the CEO and managing director of the company, and began by asking him about the European business. Let's listen in to that conversation.
A couple of things have happened in Europe. Last year, we had a bad year in Netherlands because one of the 2 blast furnaces was down for relining, which took longer than we thought. That blast furnace is back in operation since February, and we are pretty much back to normal production. So you saw some impact of that in the Netherlands numbers, but starting this quarter, we expect Netherlands to be positive EBITDA. So that's not a one-off, that's a trend which will continue. You'll have a positive EBITDA starting this quarter and for all subsequent quarters in this year. In terms of UK, we had a one-off, which was roughly about £50 million, which was more an adjustment on the carbon credits that we have and the set-offs that we need to do and the hedges that we have, etc. So that 50 million will not be there for this quarter, which was there for Q4. And but going forward, in UK, we expect Q1 and Q2 to continue to be tough because of the fact that we are winding down our operations. We have the coke ovens already closed in March. We'll close one blast furnace in June, and we'll close the second blast furnace in September. But we expect the second half of the year to be positive EBITDA in UK as well.
Okay, all right. So you're saying that the European business on the whole then will turn EBITDA positive from the second half of the year, or is there a possibility in Q2, since Netherlands will already turn around, that we could see a positive EBITDA number?
So Netherlands will clearly be positive starting Q1. Okay, in UK, since we are going through this transition, we have a lot of closure costs. We have an unstable operation because you're closing it one by one. While I have a set of numbers, I just want to make sure that I don't guide wrongly. So Netherlands will be positive. UK will be positive in the second half.
Okay, got it. Well, Mr. Narendran, coking coal costs, that seems to be the joke on the pack, right? Because in the past quarter, it would hurt your operations. While at current prices, it could help in the coming quarter. That's Q1. So could you tell us what was the hit? What was the increase that we saw in coking coal costs for the past quarter? And what kind of a relief will you expect in the coming quarter, both for the India as well as for the European business?
So both for India and Europe, the coking coal costs went up in Q4 compared to Q3, maybe less than what we had guided. So in India, if I remember right, we had guided a $10 increase in coking coal consumption. We ended up at some $5 increase, and similarly in Netherlands and UK. Going forward, coking coal is not an issue for UK because we've already closed the coke ovens. Netherlands, we expect the coking coal consumption cost to go up by about 20 euros this quarter compared to the last quarter, largely because of the inventory that is there. But the purchasing is currently going on at around 20-25 euros per ton lower than the previous quarter. In India, the coking coal is being bought at about $35 per ton lower than what we bought last quarter. Consumption will see a benefit of maybe about $10 per ton this quarter, and the balance will flow through in the subsequent quarters.
So safe to say that the India EBITDA per ton improves because you'll have the benefit of lower coking coal costs, and also give us some color about how much higher are prices today in India in comparison to the past quarter.
So we expect prices in India as we stand today to be about 300 to 400 rupees higher in Q1 compared to Q4, because while prices have gone up in the last few weeks, it had gone down till March. So, there's a climb back which is happening. In terms of margins for this quarter, I wouldn't say that it will get better, simply for the reason that this is a quarter for shutdowns in India. So we have a lot of shutdowns, so the volumes are going to be a bit lower. So while the spreads will look a bit better, the volumes will be a bit lower, and hence a little bit of fixed cost distribution over a lower volume will happen. So you will see some drop in EBITDA in Q1 compared to Q4, but on a full year basis, you will see, you'll start seeing at least flat, and if the prices improve, then we'll see an improvement.
Okay, got that. It makes perfect sense. What about the debt number? You've done quite well actually in maintaining the debt number on a sequential basis in spite of having a 4,500 crores of capex. So what is the capex plan you've lined up for this year? That's for FY25. And what happens to the debt? There's no scope to reduce debt from here because you'll be having the UK business alignment that you've been talking about, as well as the India capex as well will weigh. Your take?
So this year, our guidance is that the capex will be around 17,000 crores. About 75% of that will be spent largely in India. The net debt levels, we are expecting to be in the 77,000 to 80,000 crore range. We don't expect a significant reduction in net debt. We want to keep it as flat as possible. But the net debt to EBITDA will come down from the current levels of 3.3 to less than 2.5. Maybe we'll be at 2.3, 2.4 by the end of the year. So that's largely what we are guiding.
Okay, and about this capex plan, how do you see commissioning of the additional volumes coming on stream?
So the physical completion of the blast furnace in Kalinganagar will happen in June. Already the stove heating has started. The chimney heating of the coke ovens has started. We expect the blast furnace to be in production by September. So the second half of the year, you will start seeing the additional volumes come in from Kalinganagar. We have a blast furnace relining in Jamshedpur starting January. So that will take out some of the overall volumes, but net, we expect the volumes in India to be about 1.4 million tons more this year than the last year.
Okay, that's a fair bit of color then. What about some inorganic growth post the elections? The NMDC steel plant could come up for divestment, and there's talks about RINL as well. What's your view on either of these two assets?
No, I think we've said it in the past, our focus will be on organic growth, and we have enough headroom in the existing sites to build 40-45 million tons of capacity. So, so we have enough to do in the existing sites. As of now, we are not looking at new sites, but obviously, if there's something very attractive, we'll think about it. But I think just now we're focused on existing sites.
Well, Mr. Anil Agarwal says that in the coming 2 quarters, he's going to sell his asset. Any talks with them?
Not really, because honestly, for long products, I think for us, the best place to grow is Neelachal, where we've bought an asset which has enough land. We are at 1 million. We are running full out in Neelachal as we speak, and we want to take it to 5 million and then to 10 million. So we have enough headroom there to add long products capacities where we want. We also have the Usha Martin plant that we acquired running full out, and we'll be adding a rolling mill there, so that will add another 300,000-400,000 tons of additional volume. So I think we are quite comfortable in long products as compared to where we were when we originally bid for what was then Electro Steel.
All right, that's the word coming in from Tata Steel. The stock though lower by 4% in trade today. We'll do one thing, we'll slip into a break. When we come back, we'll be joined by the management of Tega Industries to discuss the quarter gone by and the outlook going ahead. Stay tuned for that.
Had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre, was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out who that middleman actually is.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Tega Industries, that's the stock in focus in the back of fourth quarter numbers. Revenue growth and margins surpassed the FY24 guidance, that is for the FY24 numbers. Net profit rose 16% on a YOY basis. Mehul Mohanka, the managing director and CEO of the company, is joining us now to take a few questions on the quarter gone by and the outlook going forward. Mr. Mohanka, good afternoon. Thank you so much for joining us. Well, I wanted to understand, you have surpassed your guidance for FY24, both in terms of revenues and margins. First, what led to that? And second, are you being a little conservative when it comes to FY25 guidance, 15% in both your segments? Do you think you can do better than that? What are demand trends looking like?
Thank you very much for having me on the show. So I think nothing extraordinary happened for us during the year. We just continued to execute our strategy in terms of not only our new product innovations being deployed across the world, but customer acquisitions and penetrating markets which we had planned for over the years. So that kind of played out for us to be able to deliver the kind of growth both in top line and margins as we did. In terms of our overall guidance, we've always maintained 15% growth in revenue year on year going forward, and we've done that not more out of conservatism, but making sure that we always exceed the expectations of the market. And we continue to believe that the way the business is poised, 15% is where we see our markets to grow from here on.
Mr. Monka, welcome to the show. You ended Q4 with EBITDA margins of slightly northwards of 27%. The guidance that you've given for FY25 is slightly underwhelming. You've also, mentioned, various worries that you're facing, especially in terms of inventory that you've had to carry due to the Red Sea crisis, etc. So, are you being conservative once again as far as EBITDA margin guidance is concerned?
I think what you're looking at specifically is the results of Q3 over Q4. But if you look at the entire, margins for the year, we've always guided that we'll be between, 21 to 22%, and we've been at about 22.5% for the full year. So our guidance is not off, actually, if you look at from an EBITDA margin perspective.
You've given a 20 to 22% guidance, right?
Yeah, and we did about 22.5 if you look at for the full year, of 24. So, so as I was saying, so 21 to 22% is completely where we're at the next year.
Correct.
For 25.
So 27.4%, what my colleague meant to ask is that 27.4%, that was the quarterly number that you saw in quarter four. That is not something that would be replicated. And also, what is the quarterly run rate for revenues that you're looking at? Generally asking because 507 crore rupees, this is at a multi-quarter high. Till last year, you were averaging at around 300 crore rupees on a quarterly basis. So do you think that revenue growth would come with higher margin expansion? Would that happen going forward?
Yes, our margins are going to continue to expand. If you look at Q4 in particular, but came off of a subdued Q3. So we had mentioned in one of our calls earlier that we, because of the logistical reasons, we had a bit of a subdued Q3, and we would make up in Q4, and that's exactly what happened. It kind of spilled out over from Q3 to Q4, leading to the numbers as you see of 511 crores on Q4.
Okay, just moving on. Talk to us about the Dynaprime lines range. You've mentioned in the call that it's progressing as per what the internal aspirations were. Can you quantify it for us? FY25, what is the outlook from that particular segment?
So Dynaprime for us has been growing at about 28% odd, 20 to 30% year on year, and we see those estimates to continue to flow through into FY25. We see some kind of an improvement going into FY25 because the product continues to gain a lot of traction globally. So Dynaprime is going to be one of our mainstay products driving growth, along with other product lines that we have that we've been working on as well as Tega McNally, which is coming back strong in the last year because of the turnaround.
Okay. I wanted to talk about the Chile expansion timeline. You said you will be starting the construction of the project very soon. It will be completed by June 2025. What is the kind of capex you've made here, and what is the asset turn on that? And once it does come on stream, will the margins improve? What kind of financial change will it bring it to your books?
Yeah, so we're going to be spending about close to $30 million in the capex. It's a greenfield project. It will come online by I would say end of quarter one of FY25-26. We see that delivering an overall growth of about $100 million at full capacity. Of course, we will ramp it up over the next few quarters once we go into commercial production. And Latin America itself has been a good market for us. A lot of growth is being delivered through our Latin American customers, and I think margins will continue to be sustainable at the levels that we mentioned, about 22% and 21 to 22%, and that will come through the expansion of capacity as well.
Okay, let's talk about the order book and the order inflow. Order book currently stands at around 630. It was around 480 at the end of last year. Also, what is the order inflow pipeline looking like? Where will you end FY25 at? And also, if you could give us some more specific in terms of name and, what is the kind of revenue potential from the large European order of around 690 crore, spread out over the next 5 years. Could you give us more details on that in terms of the revenue potential?
Yeah, sure. So as of March 24, we ended, the quarter with an order book of 630 odd crores. And the same period last year in 23 was 480. So order book has grown over 30% for us in FY23-24. We continue to see the trend going forward. We have been, as you were aware, that of the large contract in Europe, it's a copper mining company, and we will see those revenues starting to come through in this year itself, and starting Q1 of this year. And it's a 5-year contract, so there are customers similar in size and range that we are in discussions with to see if those similar contracts can be replicated.
From that particular order, would you be able to quantify quarterly, the approximate amount you would be able to book?
I think estimates are around anywhere between 30 to 40 crores a quarter.
Okay.
Okay, all right.
Revenue will fall through.
Okay, all right. And last question before we let you go. Wanted to understand the update on trade and export situation. We've been seeing a lot of volatility in geopolitical due to geopolitical concerns. How much is export as a percentage of revenues? Are you seeing freight rates going higher or pricing change because of that, or orders getting moved to say the next quarter or getting delayed?
Yeah, so supply chains have been impacted because of the geopolitical issues. We're not seeing as much stress on the pricing of freight, but we are seeing delays in terms of shipping times. For example, Europe would generally take us about 6 weeks today. We're sitting at close to 12 weeks of shipping time to Europe. So those are some concerns which could lead to slippages of revenue from one quarter to the other. But in terms of cost, we're not seeing as much stress as of now.
Okay. All right, Mr. Mohanka, thank you so much for joining us today and giving us all those details. So that's the word coming in from Tega Industries. Very strong Q4. They have also surpassed FY24 guidance, and they're expecting 15% revenue growth in FY25. We'll slip into another break. When we come back, we'll talk about markets and focus on Techno Electric. This is our Midcap Spotlight segment. Stay tuned for that. Welcome back. You're still tuned in Midcap Radar, and this is our special Midcap Spotlight segment. Techno Electric, that is the stock doing well in trade after it reported a strong set of Q4 numbers. The revenues are higher. Everything actually is looking good here. Vivek, tell us more about this set.
Everything is looking good. But I'll give you a little bit of a context. In terms of FY24, it's slightly underwhelming into what the analyst community was working with. But very interestingly, they had the con call last evening, and the guidance there was very, very encouraging. So let's, number one, have a look at the Q4 results itself. So revenues higher by 40.5%, coming in close to the 440 crore mark. Talking about the core EBITDA, up 7.5 times on a year-on-year basis, coming in over the 50 crore mark. Margins very strong, 12.2% versus 2.2% on a year-on-year basis. 1,000 basis points jump as far as margins are concerned. Profitability coming in at 77.5 crore versus 60.8 crore. But again, this looks optically, the growth looks optically slightly lower, but actually the base quarter had an exceptional gain of close to 68 crore. Now, talking about FY24 and how did the company actually pan out? FY24 guidance, the company gave a revenue of close to 1,500 crore, slightly underwhelming against what the analyst community was working with. They were working with a top-line guidance of close to 1,700 crore. They did around 1,300 crore from the EPC business is what they were expecting, and they managed to do close to 1,492 crore. Now, coming to what brokerages are saying, post a very, very encouraging con call that the company did, JM Financials maintains a buy rating on the stock. They have a target price of 1,485 rupees a share. They're saying that the order inflow for FY24 came in very strong at 7,000 crores. Along with that, the orders were largely driven by the order wins that the company saw #1 in the transmission segment and also in the smart metering segment. Commentary was very encouraging in terms of what the management said for the data center business as well. Order book very strong, almost 5.5 times FY24 revenue, coming in at the 9,200 crore mark. Order pipeline, the company said, is very strong with orders expected from the T&D segment and also from more orders coming in from the smart metering space. The FGD segment also is doing quite well. And this is something that the analyst committee will look at quite favorably because this particular segment, that is the flue gas desulfurization segment, was muted since the last couple of quarters. This is also quite positive as far as the peer set is concerned. Management maintained its revenue guidance of 2,500 crore for FY25 and 3,500 crore as far as FY26 is concerned. EBITDA margins expected to be around the 13% mark. Now, very interestingly, on the EPS front, the management appears to have gone ahead and revised its guidance upwards to 50 rupees a share from the earlier 45 rupees. Now, if you pull up the intraday stock of the chart of the company, almost 8% higher. And in fact, if you look at a longer time frame of close to 6 months to a year, this particular stock has done exceedingly well. But that's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBCTV18.com.
The car. We are in fact here at Yerwara police station. There are 3 FIRs right now which have been registered in the Pune Porsche drunk driving case. One of the FIR is by the driver's family who would allege that that he was kept illegally confined inside the staff quarters at the family household. He was in fact, he had also mentioned that he was kidnapped and was not allowed to speak to his family for a very long time. Now this car is the car which was used to pick up the driver. Cops have now taken this vehicle into their custody. In fact, my Vijay Vasant will show you visuals of...
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today, we are going to put spotlight on top mutual fund performance, the returns that have been in last 1 and 3 years. And of course, returns are not the only thing that we see in a mutual fund performance, but there's been some interesting data. Let's talk about that now. Quant Small Cap Fund, that has been shining. It has outperformed its peers in the small cap category in the last 3 years with 36% returns, while Nippon Small Cap has closely followed it with 35% return. Franklin Smaller Companies comes next on the list, and that has also done well with 33% returns. The list will come up for you on the screen as well. Let's go to mid-caps now, because now Motilal Oswal Mid-Cap Fund is the star performer here in the last 3 years with 37% returns. Quant is again in this category, has delivered 36% returns in this one. And if we talk about the Flexi Cap now, JM Flexi Cap and Quant Flexi Caps are the top performers in the space, while Parag Flexi Cap fares better with 22% returns, and this is a fund that everyone wants to understand and talk about as well. Summing it up with large caps, wherein we have Nippon India Large Cap clocking in 25% returns, JM Large Cap comes next with 23% returns. What is the point of this exercise? We want to analyze individual mutual funds to make sense for you whether it's a good time to invest here, because we've been seeing a lot of volatility, but which is the particular fund and what are the characteristics and what is the fund manager profile looking like, and generally how have they performed in up and down markets, what explains the fund's performance and more. We have with us two experts on the show today, Udayan Adhir, the founder at Udayan on Money, and Prableen Bajpai, the founder at FinFix Research and Analytics, joining us now. Thank you so much for joining us today on the show. And you know, usually we have very specific queries, so we thought let's make it more specific and try and understand more about individual mutual funds for the benefit of our viewers as well. So Prableen, let me start with you. Let's take the small cap category performance and let's talk about the funds that you think are decent enough in the list that we've just shared. There are two of them that you have given us. One is the Bandhan Small Cap Fund, and the second is the Nippon Small Cap Fund. Can you talk about both of them individually?
Good afternoon, Sonal. Great to be on the show. And first of all, congratulations for featuring in the top 40 under 40 list as a young achiever. Okay, yes, the two small caps. I was curious to understand, of course, Nippon is one of the largest schemes in the space. And it's got a huge AUM, and it yet continues to deliver great performance. And the scheme was launched, Sonal, in the year 2010. So it's a fairly old scheme in terms of rolling returns as well as trailing returns, SIP returns. The scheme has been in the top 3 performers mostly. The approach here is to have a very diversified portfolio with over 250 stocks because it's a huge AUM that now they manage, although they have certain restrictions on the inflows. It's interesting to see how the fund is positioned in terms of its assets in the large, mid and small cap space. So they hold about 15 and 12% in the small cap and large cap space with about 73% purely in the small cap. Sorry, 15 and 12 in the mid and the large cap space. The top sector allocations here are currently industrial products, electrical equipment. And what we've seen is with the changing cycle, they have changed allocations pretty aggressively. For example, electrical equipment, which is now around 8.5%, was as low as 2.25 and 4.2% a year and 2 years back. So they've made those changes. A very interesting sector, which is chemicals and petrochemicals, they are just about 3.65% there, which was as high at 8.5% around 1.5 years back in their portfolio. So they've been agile. They've been able to manage a very huge AUM. And the fund manager has been managing, Mr. Samir Raj has been managing this since 2017. So, of course, the big AUM is one of the slight negatives here, but I think as the market size is becoming larger and larger, that has been managed beautifully by the fund house. The second one on the list is Bandhan, a small cap. Sonal, I was curious to see because this fund has again performed phenomenally in the recent past. It was launched at a very interesting time of 2022. So they got the benefit of the COVID fall. So I would say the performance in the first 1.5, 2 years was largely due to the right allocations probably, which they got to make during the dips of COVID. And there has been a shift in the fund management. The fund manager underwent a change. And now the CIO of Bandhan is actually managing this fund, Mr. Manish Gadwani, and who was with Nippon and has had experience, for a very, very long time. He's managing this fund. It's again very diversified. It's got over 150 stocks. It's a very small, compact AUM of about 5,000 crores. And it's interesting to see how the allocations within the fund are different from that of the benchmark. So the top 10 stock allocations are kept just about at 30%. So it's nicely diversified, a lot of focus on the quality growth and valuations. So I think this is again a fund which investors can keep their eyes on. But because there has been a change in the management and a new fund manager came in only in January 2023, which has proved great for the fund, I would say that it would require a bit more tracking.
Okay, and it is so important, right? As I was pointing out earlier, it's not just the returns. There are other factors that make up a fund, and that's exactly what we wanted to understand from you. Udayan, let me come to you, because small caps, that has been the talking point in last 1 year. Some talk about maybe the rally will fizzle out, but that is not something that we've seen. What is your view here? What are some of the funds that you would pick out from the list that we shared?
So, Sonal, first of all, thank you so much for having me. Wonderful to be here. And with regards to small caps, right, they have been the buzzword, because if you look at the past 2 calendar years, small caps have returned the highest amongst other categories in terms of market cap. So now, keeping that in mind, whenever there's euphoria in a particular category, you want to approach it with safety. And that is also in many ways how I want to analyze mutual funds and how I have been analyzing mutual funds. So the couple of funds that I would specifically look at in this category are, I look at the Nippon India Small Cap Fund. I think that is something that we've already spoken about. But what attracts me towards it, apart from everything else that has been mentioned, is that it has a very low down market capture ratio. So it's at 49 currently, and the up market capture ratio is 139. So what are these capture ratios, right? When, let's say, one particular index goes up by 100%, how much of that 100% has been captured by that particular fund? And similarly, when it's going down, how much of that downside has been enjoyed or guarded by that mutual fund? So ideally, you want the down capture to be low and the up capture to be high, which is exactly what is happening with Nippon India Small Cap. So the ratio, that is the key here. Generally, a ratio of about 1.4, 1.5 is supposed to be very good. For Nippon India Small Cap, it is 2.86%, which is fantastic, especially in the small cap category. So I think that becomes very essential, because the downside risk, if you capture it, when the markets start recovering, you're recovering from a higher point. So it obviously helps you out in that aspect. And the second fund, which I am looking at, which is a slightly left field choice, is the Invesco India Small Cap Fund. Now, one of the reasons I am specifically also again looking at Invesco India Small Cap is because a relatively new fund, about 6 years old, launched in 2018. And if you remember 2018 was the time when mid and small caps started taking a beating. So it has gone through that entire cycle, right? When it wasn't in a category that was doing well, and the last 3-4 years since the COVID crash, that category has done well and funds in those categories have done well. So the Invesco India Small Cap has an AUM that is relatively smaller compared to heavyweights like Nippon India Small Cap Fund, an AUM of under 4,000 crores. And once again, if you look at the capture ratios, the down market capture ratio, which I think becomes very, very critical for the small cap category, is about 67%, and the up market is 131%. So very similar to Nippon India Small Cap in that category. And then the capture ratios are very close to 1.96% currently. So apart from that, you also have the CIO, Mr. Tahir Bacha, who is a very reputable investor, has got a wonderful pedigree that comes along with his name. He's personally looking into this fund, and that just adds confidence to whoever is investing in it. So I think that small AUM relatively, plus the market capture ratios, plus Mr. Bacha himself being involved in this, those are the factors that really draw me to this fund right now.
Thank you also for explaining these ratios to us. Capture ratio, up market capture ratio, down market capture ratio, not something that we use so often. But Udayan, just a follow-up, now that we are talking to you, coming to mid-caps, you have one fund that you've liked out of the list, that is Motilal Oswal Mid-Cap Fund, that has delivered 37% returns in last 3 years. What is your view on this one, the overall performance of mid-cap funds? But of course, specifically, this one is what I would like to know.
So mid-caps are at a very interesting juncture, because if you plot mid-caps against large caps, if you look at the ratio, that is the highest it has ever been. So generally, when ratios are high, again, there's no one magic formula, but when ratios are high, that is a category that you want to be careful about. So with regards to the Motilal Oswal small cap fund, once again, I keep highlighting this right now, which is the down market capture ratio of 48%. And that again becomes vital because when a particular category starts heating up, you want to make sure that your downside is protected. And this fund has done that very, very well. And it's also had a fantastic rolling return, which I believe is much, much more important and much, much more effective than simply calculating absolute returns. Because with rolling returns, you're looking at point-to-point returns, right? So let's say, for example, you're looking at rolling returns for the past 6 years and you're looking at 3-year average rolling returns. So for every 3-year date, so let's say from 1st January 2016 to 1st January 2019, what are the returns looking like? 2nd January 16 to 2nd January 2019, how are the returns looking like? So they give you a very good idea as to how consistent a particular fund has been. And that is what, again, drew me to the Motilal Oswal mid-cap fund. Comes with a solid management as well, solid research team. That's what Motilal Oswal is known for. Just one thing that I would like to specifically highlight here, right, is that obviously none of these are recommendations. Do your own due diligence. But at the same time, while we're talking about mid and small caps, which have tended to perform well over longer periods of time, at times like these, when markets have run up, it's important to go back to the basics, which is focus on asset allocation, focus on rebalancing, which are not at all the attractive things to talk about, which no one really likes to say that, okay, I sold some of my small cap because I wanted to rebalance my portfolio. But I think at times like this, what is not popular in terms of investment and investing practice becomes the critical part, because these small practices can really set you up for longer gains, sustainable gains in the future.
I think that's a different conversation, a different episode that we have to do on this one, Udayan. Asset allocation and also when to, reallocate your portfolio or sell some part of your portfolio as well. Prableen, I want to come to you on the mid-caps because I think everything has performed well. Mid-caps were the flavor, right? What do you pick from the list?
Sonal, I think because we're discussing small caps and mid caps, I think a word of caution here that investors first shouldn't expect the same returns that they've seen the last 3 to 4 years. And also, I think a staggered approach at this stage is much better. Looking at a STP or SIP lump sum should be avoided. And in the mid cap category, I have picked one mid cap. I wanted to see how this fund has been doing, understand the philosophy. It's interesting. They pick stocks, which are placed at different stages of the business cycle. So they are looking at growth as well as trying to bring in stability at the same time. It's got about 71% in the mid cap with almost 25% in the large caps currently. So I think, again, an attempt to bring more stability and keep the liquidity intact for the portfolio. It's a nice 7,000 odd crore AUM. And it's headed by Mr. Ankit Pandey, not by Mr. Tandon, actually. And the top holdings, of course, it's a concentrated portfolio, as the fund house has about 60% allocation to the top 10 stocks. What is interesting is how they differ from the index, because it's been really hard to beat the mid-cap index. Just about 5 to 6 schemes on a rolling return basis will have beaten the index over the last 5 years to 10 years. And for example, PSUs, they almost have an allocation of 30% as compared to roughly 13% in the index. So the way they have positioned the fund is quite different from the index, and I think that has worked in the favor till now. Current holdings would be, they have Reliance Industries, they have highest allocation to PSUs, they have financial services as the top sector, healthcare. So I think this is one of the funds which investors can look at. And the second one is the Mahindra Manulife Midcap. This fund, again, I think it was interesting because it has been able to beat the index on rolling return basis, launched in 2018. So it's been there for some time now. The approach has been the key, again, how it differs from the index. It's currently overweight on metals, mining, oil and gas, telecom, and underweight on capital goods, IT, reality. The fund manager, Mr. Khandelwal, has managed to bring in a lot of good stocks, timely selections in the portfolio. It's a compact portfolio of just about 2,500 crores of AUM. And I think this is again a fund, but slightly more volatile than the standard mid caps that we've seen. And so again, investors shouldn't take very high allocations, Sonal, to funds which have performed very well in the recent past. They must do their due diligence and go slow in these two segments, mid caps and small caps.
Of course, and this is a word of caution from both our experts. Whenever you're investing in any small and mid cap funds, it's very important to do your own due diligence, and very important to be very aware whenever you're investing in this segment. We have to take a quick break, but on the other side, we'll continue our discussion and continue analyzing individual funds for your benefit. Stay tuned for that.
Is a notice that has been put in the car as well. In this very car was where the driver was taken, following which he was kept illegally confined. Now cops have taken this very vehicle, they've seized it and kept it in the custody at Yerwara police station. Along with that, the Porsche car also in this case has been kept just a few cars away from this vehicle. Yesterday at this very spot was where technical analysis of the car had taken place. This is a part of the investigation, so this car would also be used for further investigation in the case. So this is the progress of the investigation so far at Yerwara police station. But parallelly, when you speak of the blood samples, crime branch is looking at that case. Details in this very case emerge, show how the sequence of event that took place on Sunday. At around 11 a.m. on Sunday was where the blood samples had reached Sassoon Hospital. Both of the accused in this case were using iPhone. So they had made a WhatsApp call so that the call cannot be traced. So that WhatsApp call is where the conversation took place. It was Dr. Ajay Tavre, whom the father of the accused had spoken to, asking for the blood samples to be changed. On the recommendation of Dr. Tavre was where the CMO, Dr. Halnoor, ensured that the blood samples are changed. There's a middleman that could possibly be involved. Cops are trying to investigate and find out who that middleman actually is.
Welcome back. You're still tuned into MF Corner. We still have with us Udayan Ade and Prableen Bajpai. We are talking about strong MF performers or strong returns from some of the mutual funds, and we're analyzing individual ones on that. And one on my list that everyone talks about is Parag Parikh FlexiCap Fund. So let me come to you first up, Udayan, because you take that name and everyone's like, oh, it is the best fund, you must invest. It has performed well, of course, over a longer period of time as well. But what is your view on this particular fund? First up, if someone's starting fresh, should they still invest in Parag Parikh FlexiCap Fund?
So when someone's investing for the first time, everyone wants to know which fund to invest in, because that is the question, that's the $1 million question, right? But at the same time, I'm sure Prableen, also has the conversations with her clients that where to invest becomes the last question. So if it's a first-time investor, you want to first understand what are your goals. Do you want this money in the next 1, 2, 3 years? If yes, then an equity fund, whether it's the Parag Parikh FlexiCap or any other equity fund, becomes not the ideal place to park money, because equities are obviously volatile in the short run. Now, let's say someone wants to invest for the long term, right? And they still want to perhaps talk about and invest in the Parag Parikh FlexiCap, because it's literally the talk of the town. Everyone you speak to around you perhaps owns the Parag Parikh FlexiCap or one of the Parag Parikh funds. And it's performed, again, 25, 26% 3-year average rolling returns, which is, again, fantastic. And what is unique about it, which, again, has helped it perform well over the long run, is it has an international exposure. And because it keeps the international exposure to a certain amount, then the taxation becomes favorable. You're not taxed as per international taxation, you're taxed as per Indian tax laws. So that is something that has helped it diversify a bit. There's this big question that everyone again asks, is Parag Parikh a glorified multi-asset fund? Because it has all these different, it holds all these different kinds of stocks, different regions it's investing in. So once again, what I like about this particular fund is that at times, when you're investing, there are different funds that perform well at different times. And what helps you stay invested is your confidence in a particular fund house or a fund manager. So with Rajiv Thakkar, he's become this, again, legend in the Indian investing space. Even if the fund at times does not perform well, which there was a small instance a couple of years ago with the Parag Parikh FlexiCap, because there is so much trust in the fund house and the fund manager, it just helps you stay invested. So purely from that perspective, again, it helps you ride the downturns, it helps you stay invested for longer. And that's one of the reasons, again, I like this fund, because it just becomes easier to stay invested. And the best investment is the one that helps you stay invested, even when it's not going in your favor as much. So that's why it becomes one of the go-to funds for me.
Okay, interesting answer there. So the best fund is where it helps you stay invested. Prableen, what is your take? Do you agree with Udayan? And do you think somebody who's starting out now, Parag Parikh FlexiCap Fund, the famous fund, is still the place to go to? And is there anything else in the FlexiCap category?
Parag Parikh, there's a line written on their website, we value investing. So, and it's so true. That has been the foundation of the fund. Sonal, current allocation is very interesting. They have, of course, about 70% in equities, Indian equities. They're holding about 14% outside India. And they're holding 14% in debt money markets. And I think that's the amount, they can actually deploy if in case some opportunities arise. So in terms of their transparency, I think it's a 10 on 10. In terms of their approach, they pick companies which are low debt, which have high cash flows. And again, they mentioned this, that they're looking for companies which are investor friendly. So not only it's investor friendly AMC, but I think they're also looking at companies which are very transparent. So transparency at both levels. So definitely it can be an addition for a new investor, and FlexiCaps is a good space, but it's broadly large cap tinted. So you have to be sure that though you're investing in a FlexiCap, it's not one of the FlexiCaps which is very agile and which will move into mid caps and small caps. The other fund I would like to talk about here is JM FlexiCap. Again, the spectacular performance sometimes sort of brings you to study the fund, because you should see why the fund has outperforms. And I think JM's reason has been its agility in terms of holding the right proportion of large, mid and small caps. Even now they're holding about 42% in large caps and 19% in mid caps, with 37% in small caps. So they've been very agile. Despite of being a flexi cap, and they can probably have a higher allocation, the top 10 sectoral allocation is just around 25 to 30%. So the concentration risk is not there, Sonal. And this is again a fund house, which is, a scheme which is actually managed by the CIO of the fund house, which is Mr. Satish Ramanathan, who moved, he has been with the Sundaram managing their select mid-cap, and then Franklin. So he has a spectacular track record. I think this can be one of the funds which investors can definitely keep on their radars.
Okay, all right. So Parag Parikh FlexiCap Fund and GM FlexiCap Fund, these are the two funds from the FlexiCap category that Prableen likes. I cannot discuss large caps now because of paucity of time, but both of you have liked ICICI Pru Blue Chip Growth Fund in this category. And this has been an outperformer for a long period of time. And as per Udayan's data, the up market capture ratio is 122% and down market capture ratio is around 78%. And the capture ratio is 1.56%. So these are the new terms as well that we learned today. But thank you so much for joining us today, Udayan and Prableen. Always a pleasure speaking with the two of you. And, it's very important to analyze individual funds, because as you all have been pointing out, we have discussed on the show umpteen number of times, it's just not the returns, the pedigree of the management. And as Udayan mentioned, that keeps you comfortable. You can stay invested even when you're not comfortable for a long period of time. And the other points that Prableen mentioned as well. So thank you so much, and we'll speak to you very soon again.
Thank you so much.
Okay, all right. With that, we'll take your leave on this edition of MF Corner today. But stay tuned for Closing Bell to take you through the last hour of trade.
ತಂದೆ ತಾಯಿಗೆ, ತಾತಂಗೆ ಹಾಗೂ ನನ್ನ ಕುಮಾರನಿಗೆ ಮತ್ತು ನಾಡಿನ ಜನತೆಗೆ
that is coming back, is going to cooperate with the law enforcement agency. That's a way forward. Everybody should respect the law of the land, and by complying with the law of the land, the truth will come out. Who created the video, who distributed the video, all this truth should come out. But we can't expect from this SIT. Instead of this SIT should be monitored by a court. Court monitored SIT or CBI is the only way forward for us to get justice.
It's not looking a very good screen on the Asia Pacific because all the indices have opened low.
What's heartening though is take a look at that Europe number. The losses have come down drastically. Concall happened post-market and takeaways are looking muted.
Revenue saw an uptick of almost 20%. This is 6% higher than what the street was expecting.
Because we're starting at those levels where the supports kick in. With the Nifty down about 40 points.
AI has proposed a new framework around what it thinks special surrender value should be.
Down close to about 0.5% on the benchmark indices. The Nifty down for the 5th day in a row.
Dermicool and summer products, we expect a substantial growth.
Business restrictions on two Edelweiss Group companies, and that is ECL Finance, which is their SME financing NBFC arm, and Edelweiss ARC.
Outlook on 6 Indian banks has been revised by S&P.
But the IMD has clarified that the maximum temperature of 52.9 degrees Celsius, which was recorded yesterday in Delhi's Mangeshpur, may be due to an error.
In fact, pharma, IT, some of the defensive today are seeing quite a bit of selling pressure.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, that is the day so far. You're with us here on a fresh new edition of Closing Bell Thursday afternoon, and it's a repeat of what we've had for the last, I think, at least 4 trading sessions now. Market, finding it difficult to sustain. We are now actually, as we start the last 60 minutes, down 200 points on the Nifty. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good afternoon.
Hi, afternoon. The only thing that's different from yesterday and the day before is that today banks are doing well.
Yeah.
Well, that's right. And, I think actually, with this kind of a downtick that you're seeing from the recent peak, it may not be such a bad thing if the outcome is good, because you're already pulled back close to 600 points in the top. The markets are very, very light. And one of the reasons why the Nifty Bank is higher is because the rollovers were so light. So positions are light in the Nifty Bank. So let's see how this goes. But for the time being, the last tick is at the low point of the day. No sign of recovery at all, whether it's, any of these frontline names as well. Tata Steel is down close to 4.5%. Yeah. And we'll discuss that and more later on in the trading session as well.
The low which the market hit, right, when the polling started, when the elections had started, was 21,932 or so. I think that was the low. Then, there was a recovery. There was an all-time high about 23,000. That was 23,110. And we are now kind of retraced almost 50% of the entire move up. So, we're kind of sort of swinging from one extreme to the other extreme, although this is not an extreme yet. There is a little bit of course, nervousness and a bit of caution, which has been constantly being built into the system, which is actually not a bad thing at all, provided, there is, of course, the market's base case is what is actually sort of comes through. We'll see. Now, the major support, these hourly averages, etc., have all gone. The 20-day comes into focus now. And for the Nifty, that number actually now stands at 22,478. Right? That's the big one, at least from a short-term perspective, which is not very far away, 20 points away as we speak on the Nifty, the 20-day moving average. I must point out that the RSI, which is a good indicator of whether the market is oversold, overbought, at least on the hourly charts and maybe in a day on the daily charts as well, is oversold, clearly oversold. The swing has fallen quite a bit. Bank Nifty is, as we've been discussing, doing much better. We'll talk more about this. Here, we basically need a cross of the hourly averages in the upside, the 20 hourly, which is at 48,913, and that's about 1% away, less than 1% away on the Nifty Bank. And, you know, as I said yesterday as well, is it really a whole deal that you can take away from these sort of last few sessions? Not really, because, you know, metals did very well yesterday. It's the top loser today. Pharma did very well last 2 days. It's the top loser today. And IT is under pressure as well. So it's a bit of a flip-flop, which we're seeing all over the place. Rima.
Well, you know, the only Nifty stocks which are in the green are 5 banks. Outside of that, all 45 stocks are in the red. So the top banking gainers are ICICI Bank, Axis Bank, State Bank of India, HDFC Bank, Kotak Mahindra Bank. These are the only Nifty stocks, large caps, which are managing to hold up in the green. But outside of that, it's, you know, all the other sectors are under pressure. Metals down 2.5%, IT is down over 2%, Pharma is losing ground, CPSE index is seeing a fair amount of profit booking. The Nifty CPSE index is also down 1.5%. And now the correction from our all-time peak levels is about 2.5% on the mid and on the Nifty.
All right. Markets at the low point of the day. And in fact, you know, last few minutes, you've seen some additional selling that's come in there. Metals, yeah, as Rima mentioned, Hindalco is down close to around 1% now. IndusInd Bank as well, that suddenly pulled down considerably. And Tech Mahindra as well has pulled down. I think Tata Steel has moved lower post, you know, those comments that came in that interview we just had with the management. So Tata Steel has moved to the low point. A bit of a bounce is what we saw, but that one has got sold into. How do you position yourself, though, in the final hour of trade? We have our expert who joins in on the show. Let's get a view going on. We have Rajesh who's joining in. Hi, Rajesh. Good afternoon and good to see you in. Tell us, what do you make of today's trading action? You know, as we speak, we're at that very crucial mark, 22,480. Your view on the Nifty? Rajesh, I think you'll have to unmute yourself. We can't hear you.
So it's good to be on your show on CNBC-TV18. Yeah, we are on a crucial mark. We are continuously seeing profit booking in Nifty. And the main reason for today's profit booking has been the high call writing. And even at 22,600, we are seeing a stiff resistance. So for 22,600 to be crossed seems to be a daunting task. But having said that, we are now placed at a key support levels. As you highlighted, 20-day DAMA is placed around 22,470, 450. So it would be crucial how we sustain here. If the market continues to sustain here, then we can expect a bounce back, similar to what we have we have seen in Bank Nifty today. So Bank Nifty, if any trade has to come, it would be on the Bank Nifty side. Any dip towards 48,600, 48,500 can be bought, with 48,300 as a stop loss.
Okay, what about your stock recommendations, Rajesh? What would you advise?
Yeah, so since we are bullish on the banking stocks, I have a positive view on the Indian Bank. Indian Bank, we are seeing a continuation uptrend, continuously moving in a higher top, higher bottom formation, and we are also seeing a flag pattern breakout with strong volumes. So Indian Bank, which is currently trading around 584, can be bought with a stop loss somewhere around 569. One can expect the stock to move towards 620 levels. My second pick could be Bata India. This stock has been an underperformer, but today we are seeing some base formation in this stock with strong volume formation. From higher levels, it has corrected a bit, but as monthly candle is about to form, we are seeing strong formation in Bata India. Bata India can be bought around 1360, 1370 with a stop loss somewhere around 1330 and target around 1450.
All right, Rajesh, we'll leave it there. We'll have you back on for more on the market. We are very, very close to the 20-day moving average, and we'll see if that goes and it goes and then sort of we end below it, or is does that manage to act as a bit of a support here? Imami has got no such problems. It's surging. Mangalam is here with the fine print of the results, and the management commentary and what the street is making of it? Are there upgrades in? Mangalam, over to you. Good afternoon.
Well, extremities of the weather are doing extremely well for Imami, and a lot of other things are coming together for the company as well. Remember, in the fourth quarter, we had winter extend all the way up to middle of January, and in some parts of the country, even February. So that did extremely well for their winter portfolio, which is a little over half of their overall sales. And now the way forward looks extremely strong for them as well. Because of the heat waves, the summer portfolio for the company is doing well as well. So for the fourth quarter, they saw domestic business growth of almost 8% with a 6.5% volume growth, which again is in the top decile of all the FMCG companies that have reported numbers so far. And the company did see an improvement in their gross margins to the tune of around 270 basis points, but they plowed back some of their money into ad spends, and that came to around 20% of sales as against 15.5%. On an overall basis, the company reported revenues of almost 7% growth, and the margins were largely stable. The net profit also grew in low single digits itself. The important part for them, Boro Plus as well as the healthcare business, grew extremely well because of the winter that I spoke about. Navratna and Dermicool, which did not grow as much, just 1%, actually saw secondary sales growth of 20% in the March quarter. And this heat wave is likely to do well for them. And that's what the management said to us as well. So that's something that we'll be watching out for. The D2C brands are doing well, now account for 5% of their sales, growing in high double digits. So those are factors that the street will be watching out for. In terms of the things that the management said to us, double-digit revenue growth is what they're targeting, which would be led by volumes largely, and price would be just about 2 to 3%. They maintain their gross and EBITDA margins at current levels, and at the same time, they are looking to expand their D2C businesses a lot more as well. Importantly, Dermicool, which will have a first full-fledged summer this time around, will see big growth as well. Substantial growth in their summer sales is what the management has been speaking about. Brokerages have taken note of that. Over the last few quarters, the company has seen multiple things come together for them in terms of management changes. Also, the company having sold their hospital and the promoters' pledge reducing. And Jeffrey says that at 28 times FY25 earnings, this is a lot more value attractive than all the other FMCG companies. So they have their buy rating and a target price much higher as well.
Okay, thank you very much for that. The stock hit a fresh 52-week high today, but it's still not at its all-time high level, which is about 682 rupees. Deven Choksi is now with us on the show. Deven, would you, Imami is, not very expensive relative to what couple of the other, stocks in the market is trading at, but this is a company which is going to see a double-digit kind of a revenue growth, stable margins. So would you bet on Imami at these levels?
Yeah, good afternoon, everyone. Well, I think 7-8% kind of a growth at this point of time is probably, I think, suggesting that most of the things are on track for the company. And the portfolio of personal care product particularly, I think they remain relatively, I think, promising from the point of view of generating the steadier return. Whether at 28 or 29 times, I think, price outlook ratio, I do not know, I think, whether immediately, I think it becomes a buy opportunity. Because in the rest of the cases, I think when you look at particularly likes of ITC and its FMCG portfolio, you find that I think this particular portfolio has far better visibility also in form of, I think, the larger amount of growth that it is talking about. And should they end up monetizing this particular portfolio, this could be, I think, a better opportunity. But however, as said, I think the particular company right now, Imami, so we don't have the coverage to make the recommendation, but we believe that I think there is scope for some improvisation in the rating for this particular stock.
Okay, all right. Deven, I wanted your view on Tata Steel as well. But first up, let's run our viewers through the basic details then and why the stock is actually lower. So first look at it, the EBITDA number on a consolidated basis was better than what we were working with. And there was a beat on both the India operations as well as the European operations. But despite of that, the stock did see some kind of selling pressure. All those numbers should come up for you actually on the screen. First look at it, it appeared like a good setup number. What was the issue then in the past quarter's numbers? Well, UK had a £50 million of one-off benefits due to carbon cost credits. Now the read-through is, basically the European EBITDA per ton loss is at $70 per ton. Earlier, we were working with around a loss of around $40 per ton, which the street was very, very excited about. They've also given us a guidance for Europe turnaround. For Netherlands, they're saying it will turn EBITDA positive in the first quarter itself. That's because production is back to normal post the realignment of their blast furnace. The Netherlands coking coal consumption cost, though, will go up by 20 euros per ton in the first quarter, though currently their purchasing cost of coking coal is much lower. So that positive impact will come in Q2. Short point is Netherlands turns positive in the first quarter itself. The UK EBITDA per ton will be negative in the first half of the year. That's because of the closure costs, also sketchy volumes, but it will turn positive. That will be EBITDA positive in the second half of the year. On the India operations for the first quarter, well, the coking coal consumption cost will be $10 lower. Though currently they are buying coking coal at $30 lower. So that benefit as well will flow through in the next quarter. They also said that the steel prices are up by 300 to around 400 rupees on a quarter-to-quarter basis. So the spreads will improve, but the EBITDA per ton will not improve in the first quarter because they're going to be taking a shutdown, which will impact their volume. So negative operating leverage will play out there. The good news is, though for India operations, the volumes will be higher by around 1.4 million tons in this fiscal. That compares to last fiscal. On the capex front, they have lined up 17,000 crores of capex. 75% of that will be spent in India. But they have said that there's not going to be any big net debt reduction. And that's why their net debt will continue at around 77,000 crores to around 80,000 crores odd. On organic versus inorganic growth, they're saying they're going to stick to organic growth, no inorganic growth. They're not interested in Vedanta. They're not interested in NMDC steel assets as well. So those are the big takeaways out there. First look at it. It looked beautiful. But then that fine print told us that there was a one-off in the European operations. So not as good as earlier thought about. Deven, what's your view? Tata Steel, it was appearing to be like a darling at around 175, 180. Everyone thought Europe is turning around. The problem was the street was a buzz in the last 1 month or so. Europe could start moving towards profitability. That happened, but it came with a one-off. What do you do at around 165?
So Nigel, I think don't write off the possibilities that the company has basically made an announcement of. On one side, I think they're talking about by the second half of this financial year, bringing down the loss in the UK business, I think by way of closing down the blast furnace route and subsequently, I think getting into the electric arc furnace. So that is where probably I think the fortunes are being written. At the same time, the brownfield expansion at Kalinagar, I believe that I think he's adding the capacity by at least another 25%. And part of it, I think, should get benefited in the course of time in these quarters and subsequently. So from a perspective of looking at the company, also from the point of view of volume-based growth coming in largely from India, and also from the point of view of, I think, saving the cost, definitely, I think, is suggesting that all is not written off as far as, I think, the business of the company is concerned. On the contrary, I believe that with the steadier prices for steel and if the steadier, I think, the margins by the company, I would like to believe that I think possibility of improvement in the steel prices because of the higher demand and the consumption, particularly from India government. I believe that I think this is going to be probably, I think, one silent factor which will invite the traders back into the stock from the perspective of little long term from now on.
Okay, all right, Deven. So a little bit optimistic actually on the prospects of Tata Steel. Don't throw in the, don't give up so fast. That seems to be the word that's coming from Deven on Tata Steel. Well outlined there, Deven. I wanted to ask you about GMR Airports as well. That's the other play. You have Interglobe Aviation that's doing very, very well. In today's session, in fact, it's holding strong, though the markets are at the low point of the day. And GMR Airports as well, a play on the traffic. The numbers look good actually, but the stock is at the low point of the day. Is it a buying opportunity at around 82 rupees?
So since I don't have the coverage, I will not be able to spell out exactly, I think, the valuations. But as I understand, I think the number of footfalls, the traffic is basically increasing. Passenger traffic is increasing. And that is a good news for even the business of Adani Airport as well as, I think, for GMR. I believe that, I think, numbers are likely to remain steady and at the same time, I think, going to grow gradually. So from that perspective, I think one should be keeping a positive eye on the stock. But since we don't have the coverage, won't be able to speak anything on the valuation and the price at this point.
You know, the market is, by the way, taken a turn for the worse. So we were down about 180 points when we started at 230. It's lost another nearly 60 points then since that point. And we are now below, I mean, actually, we can maybe put out an alert. We are under the 20-day moving average or maybe just at the 20-day sort of average. As of yesterday's close, that number was 22,478. So we are at 22,468 right now. So that's the fall that we've seen. Actually, even the Nifty Bank has seen a bit of a, a drop off from the high was made at about 150 or so. And from 220-ish kind of levels, there has been a drop off there as well. I mean, we were trading at about 48,865. And here also, we've come off about 100 points, 120, 130 odd points or so. So that's the overall kind of picture. Just a broad, thought in terms of sort of approaching trading positions, portfolio positions as we head into the next couple of days. Devin, what's the advice going out from you guys? I mean, you've seen many elections, many of these things come and go. Just your thoughts.
Yeah, Prashant, I think well said. I guess at this point of time, I think there is no need to keep any super anxiety at this point of time. There are two classes of people, one who believes 300 and below 300 seats, and one who believes 350 to 400 seats. Nobody has factored in possibility of, I think, above 400. So should, I think, that number comes up, the market would be definitely positively taking that particular number forward. It is understood. Another good thing which is happening that most of the traders are preferring to stay light at this point of time. And somehow or other, I think everybody is trying to keep the cash in the books ready. So that it is also giving an indication that whatever will be the outcome, ultimately, I think people want to deploy that cash back into the market. So that's a good indication that we are getting. At this point of time, given the kind of event, also at the same time coinciding with your derivative market expiry today, I think all of these things put together, I would think that I think stay a little bit muted on the trading position. Maybe I think you get a good chance to get into it. I think if you are holding on cash, maybe a good chance to buy into the market in the given volatility that we may experience here after the next few hours.
Devin, thank you very much for joining in. By the way, one of the big losers today is Titan Industries, and that's down close to about 3.5%. There is an analyst meet scheduled tomorrow. And remember, Titan Industries, Titan had disappointed the street in their Q4 numbers, particularly on the margin front. The jewelry margins were under pressure due to competitive intensity. So Titan's analyst meet tomorrow is going to be very crucial. Goldman Sachs has raised some questions. One, they're saying that the jewelry margin, the decline that we've seen, the pressure, is it cyclical or structural? For Tanishq, do they still have substantial store expansion headroom from current levels? Third, is CaratLane growth moderating? And four, watches and eyewear are underperforming. Is there a recovery likely? So these are some questions that Goldman Sachs has, in this Titan analyst meet tomorrow. Get into a break. On the other side, we'll invite Ronak Omkar of PPFES Mutual Fund. Stay tuned.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Welcome back. Let's get to the other important story. S&P has revised its rating outlook for 6 Indian banks to positive on sovereign action. Abhishek joins in with the details. Abhishek.
Well, as you mentioned, outlook on 6 Indian banks has been revised to positive on sovereign action that S&P has taken with respect to India. So, ICICI Bank, Axis Bank, their individual rating has also gone up. So, India's economic expansion is having a constructive impact on the sovereign credit metrics, is what S&P has written. So, they say that India's banking system continues to ride the good economic momentum, which is well supported by the recent structural development that is there in this system as well. So Indian financial institution resolution has therefore been built up over the past few years. They expect Indian banks to maintain the strong financial balance sheet over the next 12 to 24 months, that is 1 to 2 years. They have revised rating outlook on 6 Indian banks to positive from stable, which includes the likes of Axis Bank, ICICI Bank, HDFC Bank, State Bank of India and Indian Bank as well. So they have affirmed triple B minus A minus 3 issuer credit ratings on these entities as well. Upward revision of assessment of the standalone credit profile, that is SACP, of ICICI Bank has now been improved to triple B plus from triple B that they had earlier, and Axis Bank to triple B from triple B minus that they had earlier. IRFC rating outlook has been revised to positive from stable. Back to you.
All right, Abhishek, thanks very much for that. Let's welcome in, that's banks, by the way, and there's a positive view coming in. Ties in nicely, of course, with the overall belief and sort of perception that, this is a sector which is still not very outrageously valued. And the building blocks are there for the space to do well over a period of time. Ronak Konkar is with us, co-equity fund manager and head of research at PPFAS. Ronak, good afternoon. Good to have you with us here. Prashant this side. I just want to start by sort of talking about not equities and what you're doing here, but on the option side. I mean, you guys bought December call options, right? And you'd explained that in your fact sheet and your earlier communication to investors, etc. as well. So just wanted a sense of what that is about. I wanted to ask you, that's the last time you were on, because I think this is now about at least 20-25 days old, what you've done. So just talk to us about that. What is, because this is looking through elections and budget and everything else. Go on.
Hi, Prashant. Good afternoon. Definitely. So we took a very small position. We bought calls for the Nifty. And the simple funda is that if the market goes up, then the calls are valuable. We can sell them at a profit. If the markets stay where they are or they are flat or go down, all we lose is the option premium that we have paid. And the trade essentially, that like Rajiv has mentioned in the fact sheet, is the downside risk is protected where the upside is up to us as how far the market can go. So it's a very simple trade. It's a very small position. It's a other way of deploying your cash because otherwise we don't have a directional view of the market is. But this just gives you a little bit of optionality on the upside and locks in the downside for you.
And you explained, right? When the interest through money market investments perhaps would pay the premium for this one. So that actually is pretty simple but smart in that sense. But is it also a directional kind? Does it talk to the directional view that by market should be, not meaningfully, but it should be higher from where we are by the end of the year? I mean, that's of course the bet, really, right?
It's very hard to predict. That's the reason you do the bet, right? Because if you see the implied volatility on that option, it has been very low. That means the market expects to be flat, but it's very difficult to predict. That's the reason you get into such kind of a trade where you take the upside if it works in your favor and downside is protected to that extent.
Ronak, afternoon. Have you increased your cash holding in your portfolio in the flexi cap?
It has been about 15% for a while now. As per the April fact sheet, it is the same.
Okay. So it's not that you've turned incrementally cautious in the markets. You're just looking to hedge it.
Yeah.
Any changes that you've made in your portfolio in the last 2 months, considering the volatility that we've seen?
Not too many changes, but incrementally we have added to some of the stocks where we found valuations to be attractive, which includes the banks, which includes things like Bajaj Holdings. But again, there are few and far places between now to invest. Valuations have been creeping up for the past couple of years, and we aren't comfortable at deploying a large amount of the cash today as well. So we remain cautious, but although we are deployed in companies where we think the valuations are still reasonable.
Interesting new look as well, Ronak. After a while, sporting a new look. Interesting. Pretty much suits you, I think so. But, talking about deploying some money, someone who's ready in case there is volatility post this election verdict is y'all. Y'all are sitting on 15% cash and, y'all are ready to deploy. So that's good news for y'all. But where y'all have deployed money has been Kotak Mahindra Bank. It got a bit of a rap on the knuckles, in the last couple of months or so, 45 days or so, within the last 45 days. And y'all have actually bought into that stock. And now I believe banks is closer on 20% of your total mix. So you're betting on the private sector names, and some of these names that haven't really performed, you expect them to outperform, I'm guessing.
So private sector banks, if you see, say pre-COVID to today, not much has changed in the valuations of these banks. However, these banks have grown. And it's been a long-term trajectory for growth for private sector banks, or well-run banks, that I should say. And they have performed on spot wherever we see that the loan growth is concerned. The only debate is whether how fast they will grow. That's anybody's guess. But I think the valuations where they are, I think any upside in growth that comes in through either loan growth or even the fee income that they earn, I think it's positive for private sector banks.
Interesting, because both these two banks, HDFC Bank and Kotak Mahindra Bank, you'll have both of them in there, and valuations, are the cheapest you've seen in multiple years because the stock prices haven't moved at all. So let's see how that call goes. The other, sector that I'm looking at is some of these stock market plays, so to call it, Motilal Oswal, UTI AMC. I think you'll have offloaded or you'll have trimmed your stake at least in both these two holdings. Tell us more.
Yeah, we have to be cautious about such capital market exposed businesses because they tend to be very cyclical. And we don't know where the cycle will be, but if the valuations become stretched very fast in a short period of time, we have to be a little cautious. So we have trimmed them at the edges just to prevent a large exposure to these sectors.
Is this on the back of, some have spoken about potential regulation which may maybe aimed at generally tempering down all of the activity, especially on the F&O side. Is that something also that you have in mind when you do this?
Not really, but over a period of time, we have seen the market go up such sharply in a short period of time. So I think it's better to be cautious when you're dealing with such cyclicality. If you're looking at a broking business or an AMC business, they actually are cyclical. The yields will be very, very cyclical because the AUMs can shuffle, the market volume can go down if the market falls. So it's better to be cautious at peak market, or if you think that the market has run up very fast. That's the only reason. We still own some of these positions. So it's not like an entire sell-off.
Although, this is, you ask anyone, this is structural bull market, right? Cyclical companies in a structural bull market. The hope is, this is, what we're seeing here perhaps will continue to do very well over a period of time. Anything else that you've added? Anything else that at the margin that you are starting to like? And also, what will you buy with the cash in case there is some volatility, in case opportunity arises? Will you add on to existing positions, or is there something else?
What we will buy actually will be revealed in the fact sheet when it comes out. See, in the last bull markets, if you've seen, when we were sitting on cash, it really helped us to double down when the markets corrected. The recent example is the COVID crash. Before that, if you go back even till December 2017, Jan 2018, we were sitting on 30% cash because that time the market was at such a peak valuation. And that time we were fully deployed in our global portfolio as well, up to 30%. So yeah, these things are, because the valuations dictate, we have to make sure that we guard ourselves by not chasing these high valuations. So cash will be deployed. So a couple of good ideas we come across, the cash will suddenly go down and you will see that 2 new names are added, or existing names have gotten additional allocation because the valuations were very attractive. So yeah, it depends on what is really attractive at that point in time. Can't really commit in advance as to where we will invest.
But Ronak, the inference from this is today you have a 15% cash holding, but at times you've even had a 30% holding in a cash position when you anticipate a bigger crash. So it doesn't mean that, so the takeaway could be that you don't see a big correction in the market, which is why you've got a average level of cash holding?
We are not anticipating any crash, to be very fair. If you look at the portfolio, these are reasonably priced companies. The whole point is to not chase very, very steep valuations. The company's earnings may not grow. Like Prashant said, it's very easy to forget a cycle, right? We might think everything is a structural story, the long-term growth, but there are these in-between cycles to achieve that growth. Sometimes we'll have to face a down cycle and sometimes it will be an up cycle. So because keeping the cyclicality in mind, you have to be very cautious as to how much you pay for the same opportunity of growth. So we are not denying that the market will not grow, the companies will not grow, earnings will not grow, but we are just being cautious because we are not very comfortable with the valuations we have to pay. And that is the way the market is. It's not going to be always in your favor. You always will have market areas which are very expensive, and some areas will be reasonably priced or very, very cheap. So we will stay where the cheapness is, and we will sell where the expensive valuations are.
And I think you're still bullish on one of those stocks that has done pretty okay, Power Grid. I think that's the second largest holding that you'll have, right? So you'll continue to build on to that position.
So power sector theme, if you have seen over the past couple of years, has been going up like crazy. You've seen capital expenditure, little businesses also doing very well because on the back of large order books. But Power Grid is a different business. It essentially gets its cash flows from consistently keeping the grid on and expanding the grid over a period of time. So it's more of a disciplined growing player. It has had a good history and track record of execution. They have good cash flows. They pay out good dividends. As long as you're not overpaying for the opportunity, I think a utility like Power Grid is a very decent business to own.
Okay, all right. Ronak, thanks a lot for joining in. So key takeaways, then you're sitting on some cash of around 15% odd. In case opportunity provides itself, you look to get in. Private sector banks is something that you like. Power Grid is one of the top positions over there as well. And you've taken some money off the table on Motilal Oswal and UTI AMC. Thanks a lot for joining in, Ronak. Prashant.
No, I mean, actually, on the power thing, Najal, that you're talking about, we're going to talk about power. And power demand is hit a new all-time high, right? I mean, this is the daily peak power demand that we're talking about. And ties in, of course, nicely with what Ronak was talking about. And, of course, the overall expectation that this is a sector which needs more investment, both on the thermal side and, of course, renewables as well. But the data first. Rachna is standing by with just that. Rachna, over to you.
Well, India's peak power demand hit a record high of 246 gigawatts on Wednesday. This comes at a time when the entire country is going through a heat wave. However, it's the northwest and central parts of the country that are most affected. But overall, including power shortage, peak power demand stood at a record high level of 246 gigawatts, up from last year's 242, which we witnessed in September. This year's initial expectation of peak power demand was around 236 gigawatts, but was later revised to 260 by the Power Ministry. The record high in peak power demand was recorded for many states as well, like Uttar Pradesh, that hit a peak power demand of 28 gigawatts, along with Maharashtra and Gujarat at 27. Delhi, that also recorded highest temperature ever yesterday, saw a peak power demand of over 8,000 megawatts, surpassing its expected limit of 7,000. It is also the first time ever that peak power demand has surpassed 7,000 megawatts for 12 days in a row this month in Delhi. Rising power demand has also had an effect on coal stocks as well. As many as 184 thermal power plants with a total power generating capacity of 211 gigawatts have about 68% of normative stock value, as demand for electricity is also on the rise. And that's not been the case since just yesterday, but since the start of this month of May. And this is likely to be the case till the onset of monsoon, which is expected in about 2 weeks.
Okay, and we're watching the onset closely. Rachna, thanks very much for that. This is veteran investor Mark Mobius, who's actually talking about the power theme in India and how he believes this will be a big one. I mean, for investors to be able to make money as well. Listen in.
I like the power sector to begin with. You know, one of the things that people don't really realize is the incredible demand for power, not only in India, but globally, which is why I mentioned many of these Indian companies are global in the sense of starting power plants in different parts of the world. But India needs more power. And of course, that is not only coal-fired, but sun-fired, wind-fired. In any way you can get more power, it's going to be necessary. So you need to have probably a doubling of power capacity in India going forward. Consumers all have cell phones. They have to power up these cell phones. All the chips, high-powered chips, need more power. And of course, consumers are consuming more, and that means more and more power. So this is going to be a big, big growth area in my view.
All right, on that note, we'll slip into a very short break. As always, on the other side, we get you a few BTST calls from our technical experts.
last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on...
Welcome back. The expiry-related phenomena is playing out. Just pull up the intraday chart of the Nifty. There's a big recovery from the low point of the day. A few of those stocks, well, they're bouncing back. HUL, just pull up HUL. You know, in the last few minutes, you've seen a bit of a recovery on HUL. So that stock has cut its losses a little bit. Just take a look at that. Some of these larger, heavier stocks as well would be seeing a bit of a recovery. Sun Pharma, let's see that. That was down close to around 2%. I think it's down only around 2% right now. So a bit of a uptick is what we're seeing on that stock. Dr. Reddy's as well. I think the pharma index itself has cut its losses a little bit. The index was down close to 2.5%, I think. So that one, in fact, has cut its losses. Keep an eye out on a couple of these names. Now we've seen a bit of a recovery, which as we speak is getting sold into. Rajesh Bhosle is back with us. Rajesh, what are the BTST calls you have for us?
Yeah, so if we see TVS Motor, this stock hasn't moved downwards, even though market has corrected significantly. This stock is already in a inverse head and shoulder breakout, and we expect that from tomorrow onwards, we can expect the positive traction to continue. So one can buy TVS Motors. It is trading around somewhere around 2230 odd levels. One can buy with a stop loss of 2190 and can expect 2320 in a very near term.
Okay, Rajesh, I mean, just a quick word on the Nifty as well. We are sort of around the 20-day right now. What's your sense? I mean, do you think this holds? Is there more downside? Just very near term, what are your views?
So this 22,400 to 450 is a very key level because, as you highlighted, we have a 20-day moving average. Also, if we see it is last week's low. So if we have to neglect the bearish engulfing on the weekly chart, market has to sustain around these levels. And if we see Bank Nifty is supporting markets. So yes, if we sustain here, we can expect a bounce back in tomorrow's session.
Thank you very much for that. Let's move on. MSCI had announced a list of additions, deletions as a part of the May index review. The adjustments come into effect tomorrow. Vivek is here to give us a recap of all the changes announced in the MSCI Global Standard Index and the MSCI India Small Cap Index. Vivek.
Well, that's right. So at least for a day tomorrow, you might feel a selling pressure actually a bit, given the fact that India's weightage as far as the MSCI Emerging Market Index will now rise to a historically high level of 18.8%. Tomorrow, expect to see inflows of over $2 billion just in the last hour of trade, on the back of these MSCI ETF flows. Now, we've already highlighted this list of stocks, earlier in terms of which are the ones that are entering. But since tomorrow is the day when the actual adjustments will take into place, highlighting them once again for the benefit. Now, talking about the list of stocks, 13 additions and 3 deletions from the MSCI Global Standard Index. So Bosch, Canara Bank, Industar, all of these stocks also come in. Jindal Stainless, JSW Energy, Mankind Pharma, NHPC, PB Fintech, flows of almost $232 million in PB Fintech. Phoenix Mills, Solar Industries, Sundaram Finance, Thermax and Torrent Power. All of these stocks enter in. The highest flows coming in as far as PB Fintech is concerned. On the other hand, 3 stocks will be deleted. So Berger Paints, Indraprastha Gas, as well as 197, that is Paytm, come out. All of them will see outflows in the range of $50 to $100 million. Apart from that, in the MSCI India Small Cap Index, there are almost 28 additions and 14 deletions. So those stocks too will be in focus. There will also be some rebalancing in terms of weightages. So on account of all of that, total net inflows that India could see tomorrow in the last hour would be a little over $2 billion in the session.
So this is all as if closed yesterday, right? As tomorrow.
As of closed tomorrow. Vivek, right? That's right. Last hour.
And in terms of stocks that you mentioned, have usually there is pre-positioning and stocks run up and they correct. I mean, all of that has happened here, or is it anything you would like to highlight in terms of a name or two?
Let's just look at the process, that actually is undertaken. Now, this particular review, happens every quarter. So a little over 2 months before this particular event takes place, quant analysts already start making their analysis and they start pitching it to their clients. So a certain amount of pre-positioning already happens. After that, there is an MSCI cutoff date, which will be at least a week or so before the actual date in which MSCI announces the review. After that, there is depending on the stock price, the list is further pruned, and post that, MSCI announces this also well in advance to the actual date of adjustment. So in most cases, it's very safe to assume that the pre-positioning is already done, and tomorrow will be the day in which the actual ETF flows comes in, but the active funds, that play for this particular event would probably be already out of this particular trade by then.
Well explained. Thank you, Vivek, for that. Let's move on and talk about Cummins. That's one of the big drags today, despite posting a strong set of earnings. Vamakshi joins in with the details on this. Vamakshi.
Well, absolutely. There's no doubt that the company has posted a very strong set of numbers this time around. Revenue has come in nearly 6% higher than our estimates, while EBITDA and net profit has come in 41% and 58% higher, respectively, as compared to what we were expecting. The surprise this time around was on the margins front as well, but it is more important to focus on the commentary that came through from the management. The management said that they are expecting double-digit growth in FY25 as well. They posted double-digit growth in FY24, so that is expected to continue. And as far as the transition to CPCB4 norms is concerned, they have highlighted that nearly 1/3 of the sales have come through from from products that adhere to this new emission norms, and they're seeing very good traction here. They do not see an impact of pre-buying for the earlier norm products, that is CBCP, to play out anymore, and there will be some turbulence as the new norms now come into place, but they do not expect a significant impact. But on margins, they said that they did have a one-time advantage of 60 crores this time around. Profitability was better in this quarter, mainly on account of a better mix as well as cost efficiencies. They also highlighted that the gross margins may hold at the levels that were seen in FY24, but maintaining these gross margins is a challenge given the higher metal prices. They aspire to improve margin with the new products coming in, but they will have to wait and watch as to how the competition plans out. Apart from that, demand remains quite robust. They have highlighted that data centers, infra-related growth as well as investments in power gen are expected to continue, and therefore they expect to see broad-based demand across all segments. They have also highlighted that data center contribution to the top line for power gen revenue could exceed 10%. And as far as exports is concerned, they're a bit cautious out here because they're highlighting that Europe is at an all-time low. Africa is struggling mainly on account of the currency issues out there. The demand, therefore, could be weak for another quarter. They are expecting, however, after some recovery to kick in after there is a correction in the exports. The percentage of exports contribution is expected to remain stable in FY25 and is expected to revert back to the levels of 30 to 35% beyond FY25. So overall, a good set coming in from Cummins, but the commentary on exports as well as gross margins putting the stock under pressure today.
Okay, all right. Thanks a lot for that, Vamakshi. That makes two of those stocks, right? Cummins as well had a couple of one-offs in there, and the commentary wasn't very encouraging. So explains why that stock has sold off. And pre-positioning, the street was bracing for a good set of numbers. And Tata Steel as well, they as well had a bit of a one-off in the European business. So both those two actually are down under pressure. Well, let's get to Nimesh. He's joining us to tell us what he's picking up in terms of dealing room action. Nimesh, we're at the low point of the day. It's expiry day, so part of it could be attributed to that. But how are the flows looking?
Absolutely, and Nigel, because of the expiry as well, we are seeing this kind of pressure in the market. But again, there are some technical factors as well. I understand a lot of clients have not been allowed to roll over their positions, or for that matter, even the cash market, they've been asked to square off. So maybe that also explains that the broader markets are also under pressure today. I guess, all eyes will be on the election outcome. That's going to be a big trigger for the markets to watch out early next week. So that's something to track. But I guess two things to watch out for. One, after today's fall, the PCR has technically fallen to 0.6 to 0.63, technically around 0.6. No, market tends to bounce back, so watch out for that particular thing. And also tomorrow, because of the MSCI rebalancing, there's going to be an inflow of close to $2.5 billion. So both things to monitor as to what happens, starting tomorrow in the fresh series. So that is something to track. In terms of today's numbers, the institutional data again will look a bit skewed because of the three large block deals worth 3,700 crores. Remember, the same thing happened yesterday as well. So for the last couple of days, nearly $1 billion is what a lot of Ps and promoters have sold in the open markets. Even that's sucking to a bit of liquidity in the market as well. I guess from a sector point of view, the big sector outperformance has come in the bank names today, largely on back of that S&P upgrade on few select names. But broadly, don't account for too much into today's FIDI data because of the MSCI rebalancing, because of the expiry as well as the blocks. But PCR at 0.62 is an important trigger to watch out for.
All right, Nimesh, thanks for that feedback. In terms of specific stocks, what's on your list?
Well, the first stock is IRB Infra, a big cut in that stock, down 10%. It was part of my charter list few days back that expect a large block deal. Got executed today. Promoter sold close to 4.5% stake. But interesting to understand, one of the domestic mutual fund was an anchor investor in today's block. The stock is under pressure because I understand there is a bit of slippage element as well. But in terms of buyers, almost 60-70% of the book was from long only. That's the overall feedback. The second name is Cipla. Been under pressure today, but largely I understand a leading long only fund has become active buyer and has been accumulating as well at these levels. Pharma in general has seen some bit of buying interest back, but particularly to Cipla, a very long only fund is an active buyer there. The third name is Tech Mahindra. The entire IT is under pressure today, but Tech Mahindra stands out purely on back of self-flow. So some bit of profit booking or whatever, but there is selling pressure. So expect high delivery volumes in Tech Mahindra today. And the last one is ZF Commercial Vehicle. Again, very, very thin stock. Promoter, the parent owns 75%. Domestic mutual funds close to 10-12%. So not much of a float, but the indication is there could be a large block in ZF Commercial very soon. Again, there has been a trend of parents selling a stake in India for buybacks in the global market. So maybe on similar lines, you could expect a large block in ZF Commercial very soon.
Okay, thank you very much for that. Let's also invite Ambrish Baliga on the show now. Ambrish, the correction over the last 2-3 days is a good time to go shopping. So any stocks which have entered into attractive levels appears to be promising to buy at current levels?
See, there's one stock which I would recommend buying at these levels because it has anyway corrected decently well. That's Easy Trip Planners. It's the second largest online travel platform with more than about 2 crore customers. Fastest growing and most profitable online travel platform in India. Gross booking revenues have been growing at a CAGR of about 38% in the last 5 years, and EBITDA margins is about 38%. They have about, both online as well as offline model with about 61,000 agents. And recently, they've started the international expansion with operations in the UAE, UK, and Thailand. Recently started, offline franchisee stores in India, and currently they have about 12 stores in the last few months. Q4 to the earning momentum continued with a 24% growth at the PBT level, but there was an exceptional write-off because of the Go Air dues, and that resulted in a loss. But I'm looking at a revenue CAGR of about 30% and EBITDA CAGR of 24% over the next 3 years, and expecting an EPS of about 1.75 for FY26. And my target for the stock is 62.
Okay, okay, all right. That's sort of ease my trip with that is the pick from Ambrish right now. Now there is an insurance story as well, right? I mean, we all thought that this entire surrender value business was settled. Now surrender value is nothing but what you as a policyholder gets, has to be paid by the insurer if you surrender before the end of the the term of the policy. So if it's a 10-year policy, you surrender within 2 years. How much you as a policyholder needs to be paid by the insurer. The rules were first proposed by the IRDAI, the insurance regulator, back in December. That was harsh to insurance companies. There was another set which made it so that it perhaps is almost unchanged. And now there is another proposal which has gone to insurers, which is almost as tough as what was proposed in December. Stocks were down yesterday. They're down today as well. Yash is here with details on what this means. Yash, over to you.
Well, Prashant, it was only in the last meeting which happened between the insurance regulator chairman and the insurance CEOs, where the chairman did mention the fact that the special surrender value paid to the policyholders by insurance companies need to be increased. Since then, over the last 20-25 days, multiple discussions between the industry and the regulator on this particular topic, and it was just day before yesterday when the regulator sent a particular draft proposal to all life insurance companies, essentially telling them how the regulator thinks the special surrender value element should be increased in the future. As far as the wordings of that draft sent by IRDAI to insurance companies is concerned, I will just read out 2 lines and then I'll explain what that exactly means with numbers. The draft says insurers to ensure that special surrender value is at least equal to the expected present value of paid up sum assured and paid up future benefits. The second point that it says is that the rate of interest to be calculated, for present value of paid up sum assured shall not be less than the 10-year GSEC yield. Now I'll tell you with an example exactly what this means with numbers. Take an example of an insurance policy where the period of the policy is about 10 years. The sum assured is 1 lakh rupees. There's a bonus element of about 50,000. And when the policy reaches its maturity, the policy holder gets about 1.5 lakh rupees. Take GSEC yield as about 7%. Now, assuming that the policy is surrendered after the first year itself, which means after paying an annual premium, which would be about 10,000 rupees. First, one needs to calculate, this is as per the formula suggested by the regulator, one needs to calculate the paid up sum assured value. Now, the formula, if the numbers are inserted in that formula, will give you a paid up sum assured value of about 15,000 rupees. Once this value is arrived, then one needs to get the future benefits, paid up future benefits of this particular policy. Once these numbers are put in that formula, then you'll get the special surrender value, which in this particular example comes to about 8,159 rupees. Now imagine a policyholder has paid about 10,000 rupees, policy is surrendered after that, and he gets 8,159 rupees as surrender value. Compare this to the last 2 drafts which the regulator had put out. The one that you spoke about in December, that suggested 83% of the premium paid has to be returned at surrender value. Of course, there was a lot of resistance. The regulator mellowed it down, bringing it to 30%. Now this new draft again takes it to about 82%, again bringing uncertainty on that entire topic of surrender value.
All right. Well, the regulator is not surrendering yet on surrender value. Yes, thanks very much for that. Very keen, pushing hard to so that the policyholder gets a higher surrender value. But I'm sure insurers have till tomorrow to provide feedback, and they'll push back as well. Ambrish, we'll come to you for a quick comment on this one, but we have to take a quick break, so we'll do that and see you on the other side.
As technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night.
Welcome back. Well, struggling to find any winners, but the Nifty, at least in the low point of the day, it's cut some of its losses. Hero MotoCorp has seen a bit of a fight back. ICICI Bank as well and Tata Consumer, they have pulled back. Amrish, I just wanted to ask you one question before we let you go. Page Industries, any view out there? That's one of the few winners actually in the last 30 minutes or so. Page Industries or Sun TV, either of them?
Nigel, in fact, both these stocks I don't track very closely. But coming back to the life insurance, thing which you're discussing, I think the problem out there lies with the sort of expenses which are incurred in onboarding of the new policy. Because in the first year, quite a few of them pay 35%, even LIC pays 27%. So I think going ahead, in case this goes through, the commissions and the onboarding expenses will have to come down very sharply. Otherwise, most of them would make losses in, any of these policies being returned.
Okay.
Right. We got, 3 minutes to go for the market closing. And we have the indices absolutely, actually there's a bit of a recovery which is coming through, right? 177 points is what we are down by, 22,530 or so at this stage. Amrish, just a quick word, if you will, on these, some of these other companies which have been selling off. Metals, for example, names like Vedanta, etc., which have corrected, which were going one way, have come off sharply now at about 443 or so. Would you look at it positively? Right. There is a tailwind of uptrend in underlying commodity prices, although there also we saw a bit of a break. Your thoughts, Amrish?
No, because I don't think these are very sector-specific sell-offs. Since we are getting so close to the election result date, I think people are just looking to book out to a certain extent and stay on cash. So wherever the stocks have done extremely well or the sector has done extremely well, we are seeing some sort of a profit booking happening there. So I wouldn't take it as negative for a stock like Vedanta. In case it comes down, I think it's a buying opportunity, because I've recommended this in the past and I continue to be bullish on the stock.
Okay, all right. We'll just wrap up things here, Amrish. Thank you very much for joining us, but we'll continue our chat a little later post-close. We've got 22,547 as far as the Nifty is concerned, so about 160 odd points lower. And the Sensex is down 450 odd points, 74,060 coming through right now. So just a quick run through of what's happening. 1,900 stocks are lower today. Advanced decline actually almost, not almost, 3:1, more than 3:1. So many more names lower as compared to stocks which were higher. Banks, of course, the only in a way, bright spot, 0.7%. So Nifty Bank also sold off very sharply at one point in the last hour, but then there was a very sharp recovery as well, which means it's a very respectable close, 0.75% on the Nifty Bank. So it's the 5 large banks on the Nifty which I think have saved the day. Otherwise, even the Nifty would have been down a whole lot more. Rima.
Well, but we're off quite a bit from the day's low. The day's low today was 22,417. So from that level, the Nifty has managed to recover close to about 130 points. And we had also dipped below the 20-day moving average, which was below 22,500. But the final tick, the recovery that we saw in the last 1 hour, has helped us close above 22,500 and above the 20-day moving average. Banks were higher, but on the way down, you had metal names like Tata Steel, in fact, was the top loser. IT names like Tech Mahindra, Wipro under pressure. Grasim, Bajaj Finserv, Power Grid, Shriram Finance were some of the big losers.
Okay.
All right. I think that gets us to a close on what has been a tough day, arguably, over the last couple of days. And I think that trend continued into today as well. Risk aversion, a little bit of profit booking, creating a buffer, whatever you want to call it, or just people simply staying away. I think that basically is what went on. Well, that's market close. But in an exclusive conversation with News 18 Network, Finance Minister Nirmala Sitharaman shared her view on the Indian market and also the recent upgrade coming in first from S&P. Listen in to some of that conversation.
Undoubtedly, it's a big good omen, and big good omen for Prime Minister, for the country, for the economy. The consistent emphasis of the Prime Minister that we should spend money in building infrastructure, putting more money for that, and ensuring quality expenditure happens. You've given money and you don't care how it is getting completed. So it has so many different governance message. And these are not my explanations. S&P themselves have said as a justification to why they have changed the grade, and also have shown that in the next 24 months, every chance of us being given a better grade. Probability of, volatility is very high when there is no single majority government in place. Indian people have been in the last 2 elections giving that single majority for Prime Minister Modi, and as a result, a stable government has been in place, which gives predictable policies, predictable and consistent tax framework. All these matter to the stock markets. So if there is going to be, and there will be, that's my confidence, a good result coming for BJP on the 4th, it indicates stability, people standing by a good majority infused government, and that will mean good message for the stock market, and therefore it can really go up. It will be a solid bulls market then.
With me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBCTV18.com.